Alright buddies, so let's begin with income from capital gains. Important chapter, definitely they will ask in the exam, no doubt about it. There is no income tax paper without questions from income from PGBP, income from capital gains. Right. So for income from capital gains to happen, there has to be a capital asset. Such capital asset has been transferred and there are gains or profits from such transfer. So Finance Minister Nirmala Madam has made some changes in the Finance Act 24 budget that has come, which means the last time those rates etc. in the in the examination for 24 and Jan 25, the last time they can ask all those things will be these two attempts, September 24, Jan 25, like that. Afterwards, Finance Act 24 will apply for May 25 and November 25 and onwards, May, June, whatever, May, September and January. So what I am trying to tell is May, September, November, January. So what I am trying to tell is it is important for us to understand that these things are mandatory. You need to understand it carefully. There are certain rates which have been changed by the budget. I will not obviously talk about what changes are there. That is not relevant for our attempt. But at least you should know that since it has already changed, that this last time it can come only in the next couple of attempts. That's what I am trying to tell. Cool. So let's see. What do you mean by capital gains? For that there has to be a capital asset. Such capital asset has been transferred. There are gains or profits from such transfer. Right? First of all, there must be a capital asset. Second, that capital asset has been transferred. Third, there are gains or profits from such transfer. Computation. So capital asset transfer, yes. So when a capital asset is transferred, you will get something called as FVOC, full value of consideration. Then you subtract the expenses, what you get is capital gain. So capital gain, on capital gain there will be tax that is imposed based on the rates. And based on the type of capital gain, there are two types: short term capital gain, long term capital gain. And what is short term, what is long term depends on the period of holding, POH. POH, period of holding. 45(1) says, any gain or profit arising from transfer of a capital asset shall be taxable under the head capital gains in which year? In the year in which transfer took place. So there has to be a capital asset, there has to be a transfer. In which year? In the year in which transfer took place. So when is the taxability of capital gains? In the year in which transfer took place. The year you sold it, that time capital gains will be taxable. But there are 4 exceptions to this rule which we will see later. First, what do you mean by capital asset? 2 clause 14 defines what is capital asset. Capital asset means, it's an exhaustive definition, property of any kind. Property of any kind. Any kind means what? Movable, immovable, tangible, intangible, any kind. Held by the SSE, whether connected to business or not. Whether connected to business or not. Means property of any kind held by the SSE, whether connected to business or not. Movable, immovable, tangible, intangible. But excludes what? Stock in trade, because it comes under PGBP. Movable personal assets, except these things: jewelry, drawing, painting, sculpture, archaeological connection, any other piece of art. So if I draw a Mickey Mouse like that and sell it for 10 rupees, it is a capital asset. Movable personal assets. What is movable personal asset? Mobile, fridge, chappal, utensil. Correct? All these things. As far as utensils are concerned, So movable personal assets are not, except these, means jewelry, drawing, painting, sculpture, archaeological collection, any other piece of art is a capital asset. But mobile, fridge, chappal, utensil is not a capital asset. As far as utensil is concerned, if it's a steel utensil, it's a personal effect. If it's a silver utensil, then it is a personal effect as per Supreme Court judgment. Even though silver has jewels in it, it's a jewelry at the end of the day, still Supreme Court has told no problem, since it's come from, it's a family heirloom. Silver utensils is not a capital asset, it's a personal effect. Gold on the other hand, it's a capital asset. Gold phone, gold studded watch, anything sewn into the garment, everything would be a capital asset. If I am buying a car, BMW, car, if it is 1.5 crore, it's used for personal purposes, not a capital asset. Car used for business, it anyway goes into the block of asset in PGBP. Third one, rural agricultural land in India is not a capital asset. Rural agricultural land outside India is a capital asset. Urban agricultural land in India is a capital asset. Gold bonds under 1999 and gold monetization scheme are not capital assets. Right? So coming back, stock in property of any kind is a capital asset, but does not include stock in trade, personal effects of movable nature, agricultural land, and gold deposit bonds. And what else is capital asset? The other two. Any securities held by foreign institutional investor is a capital asset. Any unit-linked insurance policy where exemption under 1010D does not apply will be a capital asset. On this, there has been an amendment which we will see. Now coming back, what do you mean by agricultural land? Agricultural land means any agricultural land situated in India. If the population is 10,000 or more, if the population is less than 10,000, definitely it's rural land. The population is 10,000 or more up to 1 lakh. Within a radius of 2 kilometers, it is not rural land, but beyond 2 kilometers, it is rural land. More than 1 lakh up to 10 lakh, more than 1 lakh up to 10 lakh. Up to 6 kilometers, it is urban. More than 6 kilometers, it is rural. If the population is more than 10 lakhs, up to 8 kilometers, it is urban. More than 8 kilometers, it is rural. Population less than or equal to 10k, no problem. Greater than 10k up to 1 lakh, up to 2 kilometers, no problem. Beyond 2 kilometers, rural. More than 1 lakh up to 10 lakh, up to 6 kilometers, no problem. Beyond 6 kilometers, it is rural. Greater than 10 lakhs, up to 8 kilometers, no problem. Beyond 8 kilometers, it is rural agricultural land. Everyone with me, yes or no? Online peeps. Right. That is a capital asset. Next, what do you mean by a transfer then? Sale of capital asset is a transfer. Exchange of capital asset is a transfer. I'll give you one asset, in return I'll take one more asset from you, it's a transfer. Relinquishment means giving up of an asset. Surrender of an asset is a transfer. Right? If I surrender, if I say I don't want this asset, I'm giving it to you, yes, it's a transfer. Extinguishment of rights therein. For example, I have the right to buy some extra shares called right shares. I have the right to buy. I have the right to buy shares, right shares. But later I will say, no, I don't want that right. You only buy that right. So I have some 100 shares. The company gives me a right to buy 10 more shares. That's a right that I have. I am giving up my right. I am extinguishing my right, saying that I don't want to buy. I will sell it off to somebody else. Am I giving up my right to buy the share? Yes, that is also definitely transfer. Conversion of capital asset into stock in trade. CA has jewelry in his house. He will open a shop in 2023. In 2021, he has jewelry he has bought. In 2023, he will open a shop. Even though he just took it from his house and opened a shop, Nirmala madam says that is transfer. You need to pay tax on that. When you will pay tax, that is later, but you will have to pay tax on that. Compulsory acquisition of a capital asset. So you have a building, part of the building is demolished or taken over by government to build the metro. So when part of it is taken, it is called as a transfer. Even though it is not voluntary in nature, it is a transfer. Allowing possession of a immovable property, that is also transfer. This is in case of a, what do you say? Let's say, for example, you have an agreement for sale on 16th July. You enter into an agreement for sale to buy a house. He will give you possession on 17th September. And registration happens on 22nd February. So technically speaking, on registration, transfer is happening. But as for the Transfer of Property Act, TOPA, on 17 September only, since the possession is transferred to you, you are now a, that is called a transfer, and then you will become the owner. Similarly, in a cooperative society, for example, you will have an apartment building. That entire apartment building, you have one unit in that. That one unit, you actually own a house. But generally, the entire apartment building will be registered in the name of a cooperative society. And you will just get shares of that cooperative society. That's all. You will not get the house, but you will get the shares. Shares represent the house. Tomorrow, when you want to sell the house, you will not sell the house because house is now owned by the cooperative society. What will you sell? Shares. Is that a transfer? Yes. When you are giving to the cooperative society and cooperative society is giving you shares, that is a transfer. Then similarly, zero coupon bond is also transfer. For example, I am selling a zero coupon bond by issuing it at 70 and the redemption is 100. What is the interest portion? 30. Is that 30 zero coupon bond? Is it a transfer? Yes. What are the types of capital asset? Any security other than units listed in a recognized stock exchange. Any security other than units listed in a recognized stock exchange, NSE, BSE in India. That is ABC, you should remember this. Any security other than units listed in a recognized stock exchange, NSE, BSE in India. Yes, for up to 1 year it is period of holding. Less than or equal to 1 year, short term. More than 1, 2, 3, long term. Units of Unit Trust of India, units of equity oriented mutual funds and zero coupon bonds. You need to remember this. This will be what? Up to less than or equal to 1, 2, 3 years short term. More than 1, 2, 3 years long term. Point number B, immovable property. Next, shares, equity or preference. Shares of a company other than one covered in part number A. So up to 2 years, it is short term. Beyond 2 years, long term. Any other asset, 3 years. So less than or equal to 1, 2, 3 short term, more than 1, 2, 3 long term. So its house property, period of holding will be 2 years. Jewelry, 3 years. Equity shares of Reliance Industries listed in BSE, 1 year. Preference shares of Infosys listed in NSE, 1 year. Shares of PJ Private Limited unlisted, 2 years because it's unlisted. Unlisted units of Unit Trust of India, 1 year. Debt-oriented units of Sheila Mutual Fund listed in BSE, 3 years. Why 3 years? Because it is listed in BSE, doesn't matter. Debt-oriented, it's not equity-oriented. Shares of Tesla Incorporated listed in US Stock Exchange, 2 years. ADR of Infosys Limited in Nasdaq, because it is ADR, it is neither of this, none of those things which are there, 3 years. Equity oriented mutual fund of KSA mutual fund unlisted, because it's equity oriented, it is 1 year. Just examples, practical examples. So ultimately when I am computing the capital gain, it is either short term or long term. If it is short term, I will take full value of consideration minus transfer expenses, less cost of acquisition, cost of improvement, that's it, short term capital gain. But if it is long term, I will, since there is time value of money involved, I will also include something called as cost of acquisition. So you will have what? Index cost of acquisition, index cost of improvement, transfer expenses, everything will be there. Then you will have your long term capital gain. So you have full value of consideration minus transfer expenses, net consideration you will get, then index cost of acquisition, index cost of improvement, you will get long term capital gain. So index cost of acquisition will be what? Cost of acquisition into index for the year of transfer divided by index for the year of purchase. And index cost of improvement is also what? Cost of improvement into index for the year of transfer divided by index for the year of improvement. Everybody with me, online people? Understanding? Yes, yes, all of you? Good. Now, if the property, basically the entire, what do you say? If you see the indexation, it started only in 2001, 2002, and for our previous year it is 348. For our previous year it is 348. One second, let me see. Till now whatever we have done, let me see if we can find some illustrations so that we can revise quickly whatever we have done till now. Anyway, nothing is there of significance. Leave it. Right. Next. So guys, I told you indexation began only in 2001, 2002. Cost of acquisition. So what is if the property is acquired before 1/4/2001? Property is acquired before 1/4/2001. The cost of acquisition or FMB as on 1/4/2001, whichever is higher. The cost of acquisition or FMB as on 1/4/2001, whichever is higher, that only will be what? Taken into account. Right? Cost of acquisition or FMB, whichever is higher, will be taken into account as what? As the, cost of acquisition. When I am selling the property today, I have acquired that property way before 1/4/2001. I will take the cost of acquisition or FMB as on 1/4/2001, whichever is higher. For example, I have acquired the property in 1990 for 20 lakhs. And in the year 2001, the fair market value was 30 lakhs. In 2023, I am selling it for 2 crore. So, full value of consideration is 2 crore less cost of acquisition. I should take cost of acquisition or FMB as on 2001, whichever is higher. FMB is something which is given by a valuer. On the other hand, the government rate or a circle rate is called SDV. Let's say SDV is what? 30 lakhs. FMB is what? 30 lakhs. What people were doing, I'm telling you. That is why an amendment came in 2020. Nirmala Madam gave an amendment in 2020. What she did was, what people were doing was, they were paying the valuation officer and making it 60 lakhs. Because standing in 2023, when I want to sell it, no, to figure out the cost, I would go to a valuation officer. And valuation officer will make it 60 lakhs by paying some bribe. So they were taking the cost at 60 lakhs. Lot of revenue leakage was happening. So in 2020, Nirmala Madam said, the FMB should not go beyond the SDV. Deadly. FMB should not go beyond the SDV. Are you understanding? FMB should not go beyond the SDV. Which means what? From that 1st April thing. See. So you should do FMB as on 1/4/2001 cannot be more than SDV where SDV is available. So 2 steps. Step number 1. FMB as on 1/4/2001 or SDV as on 1/4/2001, whichever is less. What is FMB? That valuer, corrupt valuer, 60 lakhs. What is SDV? 30 lakhs. 60 lakhs or 30 lakhs, whichever is less. Which one? 30 lakhs. Next, cost or step 1, whichever is high. What is cost? Cost was some 20 lakhs. No, cost or is step 1. Step 1 is what? 30 lakhs. 20 or 30, whichever is high. Which is high? 30 lakhs. So that is what was taken into consideration. Got it? So that was the amendment. Everybody understood? Yes or no? Right. Cost of improvement before 1/4/2001, we have to ignore. Cost of improvement before 1/4/2001, ignore, will not be taken into account. Next, guys, as I told you, capital asset. Here, when will you pay the taxation? Only on the date of transfer, but there are 4 exceptions to it. 4 important exceptions. Generally, in these 4 exceptions, general rule, capital gain tax will come in the year of transfer. But in these 4 things, it is taxable in some other year. Some other year. What are they? (45)(1)(a), damage or destruction of capital asset. Conversion of capital asset into stock in trade. Compulsory acquisition of capital asset. Immovable property transfer in joint development agreement. So, for example, Sheila auntie, capital asset. Previous year 2001 2002 she had jewelry. Cost is 20,000 rupees. Cost is 20,000. Transferred to stock in trade year. Transferred to stock in trade. To P. Atesh Jewelers. Basically, whatever she had at home, she transferred as a stock in trade year. This is previous year 18-19. And then this was sold in the year 23-24. We discussed already, this is a transfer. But actually you should pay tax here. But no, in this example or in this exception, it is transferred. When is it transferred? Eventually it is sold in 23-24 for 80,000. So during this year 23-24, two things will come. One, PGBP will come. PGBP will come, that is 80,000 minus FMB as on the date of transfer 60,000. For 20,000 PGBP will come. And capital gain will come between these two, 60 and 20. But when will it be paid? It will be paid in the year 23-24. So general rule, 45-1 in the year of transfer. But 45-2 year of transfer, ignore conversion of capital asset into stock in trade. Tax is when the jewelry is sold. So you will get PGBP 80 minus 60, 20. FEOC, that is your 60,000, will be your full value of consideration for capital gain purposes, less transfer, net consideration 60,000, for which I will give you indexation for cost of acquisition of 20,000. And here the indexation will be provided till the year of transfer, which is 18-19. 18-19. Very simple. Got it? Everybody with me, guys? Yes or no? Cool. So just take a quick 5-minute breather. One more hour of class. 5 minutes breather right now. Just 5 minutes. It's 3 o'clock we'll meet actually. 3 o'clock. 3 to 4, one more hour. Cheers. Yes, buddies. Come on. Right. So we were discussing the 4 exceptions to the rule. What is the general rule? Whenever the year of transfer happens, the same year you will have to pay capital gains tax. But in certain cases, 4 cases, the taxability is postponed beyond the year of transfer. Because when the stock in trade, for example, is capital asset is converted to stock in trade, that is the year of transfer, but tax is not paid that year. It is paid later when the stock is actually sold. And if part stock is sold, then partly you will have to go and all those things. That's fine. So solve this question. Okay, we'll come to that. We'll see the other one. So general rule, taxation is an year of transfer. Exception, tax paid some other year. 45-2, conversion of capital asset into stock in trade. 45-5, compulsory acquisition of capital asset. 45-1A, damage or destruction of capital asset. 45-5A, joint development agreement. Compulsory acquisition. You see, in 2001-2, cost is 3 lakh. Right? In 15-16, it was compulsorily acquired. According to you, what is the year of transfer? 15-16. But this compensation you received from them only in the year 22-23. So when is the year of tax? 22-23. Cost is 3 lakh. 15-16 it was compulsorily acquired. 22-23 compensation received was 30 lakhs. Compensation received was 30 lakhs there. Initial compensation. Then in 25-26, let's say additional compensation was received, 20 lakhs. We'll see that. First, let's stick to the initial compensation, right? Now, when will you be taxed? In the year of tax will be the year when you receive the compensation, simple 22-23. So 30 lakhs you will get 22-23, very simple. So compensation, general rule, initial compensation, FVOC, cost of acquisition, index cost of acquisition, cost of improvement, index cost of improvement, then short term gain or long term as the case may be. Now I am not happy with this 30 lakhs. I wanted 50 lakhs actually. So I have sued the government for 2 lakhs extra. I have sued the government for 20 lakhs extra. That additional compensation I am receiving it in 25-26. I may receive, may not receive. This one 30 lakhs is taxed in 22-23. But when is the additional compensation of 20 lakhs taxed? It will be taxed later whenever we receive the money. In parts means in parts we need to see. So year of transfer 15-16, year of tax 22-23. FEOC 30 lakhs, must transfer nil, net consideration 30 lakhs, index cost of acquisition 7 lakh 62, LTCG. Compensation, general rule, initial FEOC, cost of acquisition, cost of improvement, index cost of improvement, fine. Now for additional, I told you not extra 20 lakhs that I am demanding, I will have to put a legal case, which means legal expenses and all will be there. So FEOC, additional compensation, less litigation charges. Then short term, long term. The period of holding will be the same as before, date of acquisition to date of transfer. No cost of acquisition will come in additional because already taken in initial. So if the initial compensation is received in installments, this 30 lakh is the initial compensation, short compensation. Government has given short. Court has agreed for short compensation. But it is actually given as 25/5. When will you tax this? 25/5, when will you tax this? Tell me. 30 lakhs, 25/5. So even though I received 20 lakhs in previous year 22-23, full 30 lakhs and the next 5 lakh is in 23-24, next 5 lakhs in 24-25, full 30 lakhs is taxed in the first year only, 22-23, because this 30 lakh is a short compensation that is receivable by me, short. 25/5. How much will be taxed in 22-23? Full 30 lakhs is taxed in 22-23, even though only 20 is received. Next, additional compensation received in installments, enhanced compensation. Initially they gave off 30, remaining 20 I am gonna get later. I don't know whether I will get properly or not. No, see, 30 lakhs is short. Remaining 20 lakh I don't know. In that 20 lakh, some court will order 10 lakh once, 6 lakh later, 4 lakh later. This will be taxed as and when I receive it. Go through this. Go to this. Right? So initial compensation everywhere taxed. Additional compensation ten, 6, 4. So in this, as and when I received 10 lakh, 6 lakh, 4 lakh, I have to pay tax. If interest is received on delayed payment, I receive interest. It is taxable still as IFOS, but I'll get a standard deduction of 50%. It is interest received, not accrued. So these are two variations. There is a variation 3 to this. Now they will say something called temporary order, interim compensation for that enhanced portion. For that enhanced compensation of 20 lakh, there is something called interim order. So I had asked for 20 lakhs. I had asked for 20 lakhs. I had asked for 20 lakhs, but then the court has ordered 5 lakhs interim. Interim means temporary. And final order is remaining pending for 15 lakhs. See, initial compensation 30 they received, chapter close. Now I have asked for 20. In that 20, the court is telling, okay, boss, just pay 5 first. Remaining 15 is still pending. Now that 15 may or may not come. In that 15, only 5 may come, 6 may come, 7 may come, we don't know. Interim order was passed in 1920, compensation granted 5 lakh. And final order was passed for 12 lakh. It's not additional 12 lakh, overall only 12 lakh. In overall 12 lakh, I claim 20 lakh. Interim order 5 lakh, overall 12 lakh. So overall how much I got? 12 out of 20. So interim order 5, extra 7. Overall 12 out of 20, that's it. So final order passed for 12 lakhs in 22-23. 5 lakh received in 1920. I remember, I told you. 6 lakh received in 22-23. 1 lakh received in 23-24. Now these two things is the same, guys. Variation 2. It is taxable in the year of receipt. Final order. Whenever they use the word final order, it is taxable in the year of receipt. 6 lakh and 1 lakh. But only the interim order 5 lakh. Interim order 5 lakh. This, there is variation number 3 overrides variation number 2. It is taxed in the year when final order is passed. It is taxed in the year when final order is passed. So even though I received it in 2019-20, I will tax it where? Only in 22-23 when the final order is. So on full 12 lakhs, I will charge tax. 561. Yes or no, guys, all of you? Okay, good. 45(1)(a), destruction of a capital asset. When a capital asset is damaged or destroyed, and if it happens due to natural calamity, enemy attack, fire, rioting, etc., volcano, landslide, avalanche, whatever it is, then insurance compensation, though it is destroyed that day, that is a transfer, but whenever the insurance compensation is received by me, it is taxed in that year. Whenever you receive the insurance compensation. And lastly, you have the joint development agreement, JDA. So joint development agreement, I have a land, I will sell the land to the builder. Builder will pay cash to me and he will build a entire apartment and give me 4 flats. The transfer happens the moment I hand over the possession of the land, obviously. That only transfer happens. But when is the taxability postponed? Taxability is postponed when, not when he gives the cash or 4 flats. Taxability is postponed to the date when they get something called as the completion certificate. When they get something called completion certificate, that will also get postponed. So that's regarding that. So you see here, Mr. Kunal, owner, he had acquired the land in 2001-2002. Cost of acquisition was 2 lakh rupees. This was sold to XYZ Builders. Joint development agreement, date of transfer of possession is this day. XYZ Builders constructed on 14/7/23. They received a completion certificate. 3 flats in the project they were handing over to him. So what is the computation of capital gains is based on the SDV of the flat, 40 lakhs. So 40 lakhs into 3, 1.2 crore, less transfer expenses, nil. Net consideration is 1.2 crore. Less indexed cost of acquisition. 2 lakh into 280 by 100, 5 lakh 60 you will get. So LTCG 1 crore 14 lakhs 40,000. That's what it is. This is the SDV. SDV will be taken as FEOC. So I will get the indexation from what? This year of transfer is 18-19. From 2001-2002 to 18-19 I will get the indexation. And later when I sell it off, Mr. Kunal sells one of the flats for 90 lakh on 13/6/24. Computation of capital gains, FEOC 90 minus 40, that is this next year only, that is short term capital gain. Because period of holding will be now what? 14/7/23 to 13/6/24, 14/7/23, the day, this day, completion certificate to whenever I sell it, 13/6/24. And whatever is the FEOC, that is only deemed to be the cost of acquisition. Very, very simple. So here I should look at what? Completion certificate. Got it, guys? Completion certificate. Done. All right. So guys, okay, so in the previous session we were discussing, close the door, no problem. In the previous session we were discussing what? Capital gain, and we had done good stuff, right? So for the next 3 attempts, that is your September, then November and January attempts, the new budget will not apply. So please do not worry about it. Please don't think about it. Please don't think that you have to sit and study all those things. It will not apply. Okay, so you can be free and you can just concentrate on whatever we are discussing. There have been changes in the capital gain rates, etc., and all in the budget. So capital gain chapter becomes very important, because the last time ever they can ask these old provisions will be September, November and January 25, right? Those of you are writing in September, November, January 25, do not worry. So you can watch this video, no problem. Okay, yes. So we saw yesterday with respect to, in the last class, with respect to what are transfer, what is not transfer, etc. And sorry, rather than what is not transfer, we saw what all is transfer, and generally capital gain will be in the day, capital gain will be charged in the year of transfer, but there are exceptions. There are 4 exceptions which we discussed very, very clearly in the previous class. Now we'll have to go to other areas, very interesting areas. Let us go ahead. Right. So special provisions, section 50C. So in 50C, 50C is a section where the stamp duty value is treated as FEOC. So very, very simple. Generally, I should follow the rule. Basically, the stamp duty value. So there is a particular thing that I need to look at. And what should I look at? Very, very simple. Stamp duty value, if it is less than or equal to 110% of the consideration, then consideration will be the full value of consideration, FEOC. Similarly, if SDV is greater than 110% of the consideration, then my SDV will be the full value of consideration, right? So if SDV is less than or equal to 110% of consideration, then consideration is equal to FEOC. Similarly, if SDV is greater than 110% of the consideration, then SDV will be the FEOC. This is what we need to see. So in every particular question, we need to check this 110% rule, and then only we can move ahead. Very, very simple. So on the other hand, let us say this is the normal rule, no problem. But on the other hand, let us say I have a property of 3 crore. I had bought it for 3 crore, and the fair market stamp duty value is around 5.6 crore. But the problem is, stamp duty value is what? The value as per the register, the sub-registrar. It's also called as a circle rate, etc. Market value need not be similar to SDV. Generally, it is same, and sometimes it is higher also. But that's okay. But there can be a scenario where SDV is 5.6 crore, cost was 3 crore, but my fair market value, because of, land always appreciates, we know. But what happens if you are in an area which is prone to flooding, which is prone to landslides? If these things happen, nobody would want to live in that property, right? So if there is an area where landslides are happening, for example, though the stamp duty value is, let's say, 5.6 crore, the stamp duty, the fair market value sometimes will be 4 crore. Correct? Now, if my market value only is 4 crore, but the stamp duty value is 5.6 crore. So what is 110% of consideration? 4 crore plus 10%, 4.4 crores. So is 4.4 crores more or SDV more? SDV is more. So I will go to Nirmala madam and say, madam, you are telling me that though I got money only 4 crore by selling this property, I have to pay tax on 5.6 crore. Now how is it fair? It is not fair only. Ideally, I would have paid. I am not cheating. See, if the SDV was 5.6 crore, but what I did, I just showed 4 crore on paper, 3 crore I have taken cash. Then you charge me tax on 5.6 crore, no problem. That's no problem. But now, genuinely, the rate in the market only is 4 crore because of landslides and other things in this market. So now you are asking me to pay tax on 5.6 crore. How is it fair? So in these scenarios, I can actually go to a valuation officer. Correct? Valuation officer. So in my example, what did I tell you, dear friends? In my example, I told you just 3 crore was the cost, 5.6 crore was the actual stamp duty value, but the market value, that is the FMV, is only 4 crore. General rule, if I put that 110% of consideration, it will become 4.4 crore. And SDV is only more than 4.4 crore. I'll have to end up paying tax on SDV, which is of no use because I'm not trying to cheat. I did not take any cash. Genuinely, the rates have reduced. So I will go to the valuation officer and tell him, sir, this SDV is not matching, sir. Your FMV should be something else, sir. Just please fix the FMV. It's not 4.4 crore. I mean, it's not 4 crore, sir. Actually, it is. I mean, the thing is, you please fix this properly, sir. And then if you fix this properly, then SDV also will be adjusted accordingly, sir. Kindly do the needful. What is the real market value, sir? According to you, what should have been the stamp duty value? Please tell me, sir. Is what I'll go to the valuation officer. Now, valuation officer may be one mental fellow. He may tell, no, 5.6 crore only is wrong, it should be 8 crore. I went to reduce, that fellow increased, mental fellow. Or he may tell, no, it is only 3.5 crore. Both are stupid, no? If it is 8 crore, why the hell will I pay on 8 crore? I will pay on 5.6 crore. So if the valuation officer's value is more than the SDV, if the valuation officer's value is more than the SDV only, the lawmaker says take SDV only as FEOC. So I should take only what? 5.6 crore only as FEOC. On the other hand, if the valuation officer how much? That happens to be 3.5 crore. It's less. So the valuation officer's value is less than the fair market value also. What is the fair market value, guys? 4 crore. That officer's value is less than 3.5, less than 4 crore, 3.5 crore. Why would I pay tax on 3.5 crore when I've actually got money of 4 crore? Doesn't make any sense, yes or no? Why would I pay tax on 3.5 crore when actually my value that I've received is 4 crore, right? So here I will say no, my actual selling price or the consideration will be only my FVOC. How much is it? 4 crore. The only place where I will listen to the valuation officer is wherever the valuation officer's value is in between the two. In between what? In between 5.6 crore and in between 4 crore. He will fix a value somewhere in between 4.5 crore. Only then I should take this value. Otherwise, these two are a waste. Everybody with me, yes or no? I am teaching you practically, conceptually, no need of any mugging up, guys. No mugging up. Absolutely no mugging up. Because these things people mug up and go. Valuation officer greater than this, greater than that. It's so stupid. Please never mug up taxation. It is purely conceptual. Right? Yes. So that is regarding valuation officer. Done. Next, moving on. So we have like many sums on that. We will see the illustrations. We'll see for sure, buddies. Special point number 2. In case I have taken any advance money or called token money. Advance I have taken, token I have taken, and then now I am, what do you say, forfeiting it. What will happen? So for example, Mr. RCB had a house worth 70 lakhs and he wants to sell it to Mr. CSK for 1 crore. Mr. RCB had a house for 70 lakhs and wants to sell it to Mr. CSK for how much? 1 crore. And for that he has taken advance from CSK 15 lakhs. Advance he has taken. Now CSK did not buy. So RCB tell I will forfeit. Means what? I will not give you any refund of 15 lakhs. And tomorrow, many years later, RCB sold the house to some random guy. RCB sold the house to random guy for 10 crore. Now the question is, this 15 lakhs that you have received, is it taxable or not taxable? Even if it is taxable, will it be taxable as income from other sources or will it be taxed as capital gain only in another way? Which means, will you reduce the cost of acquisition of 70 lakh and will you reduce this 15 lakhs from there? Means will you take the cost as 55 lakhs? If you reduce the cost, it is as good as taxing on it, no? Because you will do 10 crore is where you are selling later. 10 crore minus 70 would be more than 10 crore minus 55. What I meant to say was 10 crore minus 55, 10 crore minus 70, the difference will be less compared to 10 crore minus 55 lakhs. So you will end up paying more tax if it is 10 crore minus 55 lakhs. So the question was, this 15 lakhs should I reduce from 70 lakhs or should this 15 lakhs be separately taxed under income from other sources? So that was the logic. So ultimately, what is the rule, guys? Yes, they changed the rule after 1/4/2014. Before 1/4/2014, there was a section called section 51. There they said you should be reduced from the cost of acquisition. But in our exam, mostly they will ask only after 1/4/2015, and after 1/4/2015, it should come under 5629. It should come under the heading of IFOS, income from other sources. Income from other sources. Advance money will be forfeited, income from other sources. Got it? Right. On the other hand, interesting part, if I mix it with IFOS, Sheila auntie, who has a house in 2002-2003, 1 crore is the house. She gifts it to, before she gifts it, she wanted to sell it to Mr. Atesh in 2009-2010. And in that regard, she took a advance of 10 lakh rupees. And she also now that got forfeited because Atesh did not buy. Now Miss Sheila gives it as a gift to Kaushik, and Kaushik sells it to Mr. Abu for 4 crore. The question is, advance forfeited by the previous owner, can Kaushik take that? Advance forfeited by the previous owner, can he take it? So as we know, gift is not a transfer, and the period of holding for Kaushik will not be from the date of the gift, that is 1415. Period of holding will come from Sheila, that is from 2000 to 2003. Cost of acquisition also will come from Sheila. What about cost of improvement? That also will come from whatever incurred by the previous owner. So basically, you should have taken, but very, very illogical point, advance money forfeited by previous owner. Advance money forfeited by previous owner will not be taxable. Advance money forfeited by this will not be taxable. Special provisions number 3, not considered transfer, exempt. So got it, guys? So there is an illogical point. Advance money forfeited by previous owner has to be ignored. All of you with me? Yes, good. Next, special provision number 3, 47. So guys, I appreciate all of you who are coming online and sitting almost the full day, because generally people go to YouTube and watch and all that, and they'll sleep. I mean, what I'm saying is, they'll not be like dedicated 4-5 hours they will not put, and because of which they will see one concept, then sleep off, then watch one concept. But you guys are sitting for the past 3 days, full day. So I truly appreciate. Good, very, very good. I'm very happy, because the thing is, you guys have the dedication to sit through the full day. That too, if it's online, I know it's very difficult, but still you're doing it. But maybe others will just be comfortable with YouTube lectures, but the thing is that dedication will not be there. So I'm happy. Good, guys. Very good. Yes. So HUF, now special provision number 3. What are the things which are not considered as transfer? Means what are exempt? First one, that is HUF transferring a family asset to the members. HUF transferring a family asset to the member, then that is not a transfer. Gift, will or inheritance. Gift, will or inheritance. If I gift somebody, if I gift something to somebody, is that a transfer? No, it is not a transfer. Yes. Next, gift, will or inheritance. Will means what? That it is transferred from one person to the other person, like father will transfer the property, mother will transfer the property to son, daughter, that is called will. Inheritance is the same. Similarly, however, if I have received any shares, like ESOP, shares if I have received, and that if I am gifting, that is obviously not exempt, and for that FMV will be charged as on the date of the gift as FVOC. That is an exception for ESOP. On the other hand, holding company transferring to 100% subsidiary or 100% subsidiary transferring to holding company would be not a transfer. So no problem, that will not be called as a transfer. These are some of the points. Then amalgamating company transferring capital asset to amalgamated company. Right? So if there's a company called Sheila Limited and Shri Ram Limited, if they come together calling Shri, then amalgamated company, that would obviously, it will not be called as a transfer. Same with demerger also, it will not be called as a transfer. That is what it is. So for example, IBM, there are two companies, IBM USA got demerged into hardware division, software division. Hardware division was called IBM India, that's called resulting company. Software division was into Sigma Incorporated, UK. So as per Income Tax Act, whatever the assets distributed is not a transfer. Conversion of bonds, debentures, deposit certificates into shares and debentures of that company. So if one company has converted their bonds, debentures, deposit certificates into shares or debentures of the same company, then that is also what? Not called as a transfer. It should be the same company. So for example, I have 10,000 debentures at 10 each, 2018-19. So now I will make 2 debentures. For every 2 debentures, I'll give 1 equity share. So now I will give you 5,000 equity shares. So 5,000 equity shares into whatever, 1,000 rupees, whatever it is. So 2024-25, is it a capital gain or not? Yes, it is a capital gain, but it is not called transfer. Preference shares converting to equity shares of that company, not a transfer. Sovereign gold bonds redemption issued by RBI. So that also will not be called as a transfer. Similarly, any reverse mortgage whereby the senior citizen's property is taken over by the bank and they will give them EMI sort of a thing. That is, the bank will pay them a monthly payment. So even that, actually, because you are transferring everything to me, and then I am the senior citizen, I am transferring my entire house to you, and you are the bank, you are giving me money. It's actually a transfer because I have transferred the capital asset to you. But still, it says, as per this section, it is not a transfer. It is not a transfer. And similarly, transfer of rupee denominated bonds or government securities by one non-resident to another non-resident outside India, that is also not a transfer. All these things. Then what is the treatment of bonus shares? I am giving you all treatments and then we'll go to the illustrations. What is the treatment of bonus shares? Bonus acquired before 1/4/2001, bonus acquired on or after 1/4/2001. Bonus acquired before 1/4/2001. Cost is, that said, actually cost is anyway nil, guys, but it said cost or FMV, whichever is higher, but that is also illogical. But anyway, now for our examination, generally it says what? Bonus acquired on or after 1/4/2001. For bonus acquired on or after 1/4/2001, cost of acquisition will be nil. Cost of acquisition will be nil. Very, very simple. So, however, if 112A applies and bonus is allotted before 1/2/2018, then FMV as on 31/18 benefit that will be available. That is an amendment which came 2-3 years ago. That's fine. Then if I renounce my right also, right shares, and I'm selling the right also, that also will be a short-term capital gain, because I told you I have 1,000 shares and they are deciding to give me 100 right shares. I am not buying the shares, but I am selling the right. I don't want to buy the shares, I'll sell the right to somebody. And I'm selling the right to somebody, they'll only give me around 30 days to sell. So it is always short-term. It is always short-term. So all this, right. And then for no indexation in case of debentures and bonds. There is no indexation in case of debentures and bonds because generally there is no fluctuation. But there are two exceptions: capital index bond and sovereign gold bonds. In these two things there will be indexation. Apart from that, absolutely no indexation anywhere. Now, the sovereign gold bonds which are issued by RBI, maturity period if it is 8 years. If you are an individual, if you are redeeming on maturity, it is not a transfer. Hence, capital gain will come due to section 47. It will not, no capital gain, sorry. Capital gain will not come because section 47 talks about exempt transfer. So, your sovereign gold bonds issued by RBI, if you are an individual and if the maturity period is 8 years, for example, if you are redeeming on maturity, whatever money you get, it is not a transfer. But if you are redeeming before maturity, you need the gold bonds, you need the money, yes. Redemption before maturity, capital gains will apply. Capital gains will apply. Capital gains will apply. Capital gains will apply. Other SSE. Redemption on or before maturity. redemption on or before maturity. And what happens? If you are redeeming on or before maturity, any other SSC, I'm talking about individual is separate. Any other SSC, whether you do it on maturity or before maturity, then is it a transfer? Yes. Will capital gain apply? Yes. Indexation benefit? Yes. Is it a transfer? Yes. Is it capital gain? Yes. Is it indexation benefit? Will it be there? Yes. So, individual, other SSC. Maturity period, 8 years, all that is there. Special provision number 5 is what? Slump sale. Special provision number 5, slump sale. So what do you mean by slump sale? Basically, when you are selling your entire undertaking, guys, slump sale means what? You are selling your entire undertaking. Undertaking can be a branch, joint venture, or what do you say, a unit in your division. For example, if you are ITC, you have tobacco division, you have FMCG, that is fast moving consumer goods, you have hotel, you have stationery division. So let's say you are selling off your hotel division, that is called undertaking. So that is called as slump sale. Selling of an undertaking, segment or division for a lump sum payment is called as a slump sale. So that is called 180. 1A of Companies Act speaks about the selling of an undertaking that you leave. As per this rule, slump sale rule, the full value of consideration will be the FMV as per rule 11 UAE. That will be given in the exam, no problem. So because you are selling as an entire undertaking, you are not selling individual assets. The entire block will be sold. So that valuation they will only give in the exam, no problem. So that minus transfer expenses, if you do, you will get net consideration. Net consideration you will get. Transfer expenses, obviously when you are doing a slump sale, there will be some expenses. That will be your net consideration, and minus cost of acquisition, that will be your net worth. So you sell it for 100 crore, but the net worth will be 80 crore. So that 20 crore will be your short term or long term based on the period of holding. Very, very simple. So how will you manage to figure out the net worth? Very simple. For assets, depreciable assets, it is WDV as per Income Tax Act. Non-depreciable asset is book value less liability. Whatever the book value, you will take the liability at book value. That will be your net worth. Very, very simple. That will be your net worth. So that is what it is. I'll do all the special provisions and we'll go to the institute material. Don't worry. We'll do all the special provisions and we'll go to the institute material. No issues. Central government in case of intangible asset. Central government in case of intangible asset. So in this case, the central government has a view with respect to intangible assets. What is central government's view on intangible assets? When I say intangible assets, I'm talking about capital gain on intangible assets. Central government was telling that in some case, I mean, basically the problem was what? Goodwill. Goodwill, can you measure goodwill, guys? Some say yes, some say no. I can do two things. What if I acquire somebody's goodwill? I acquire one academy, I acquire one, hotel. In that case, like one group of hotels, Reliance Hotels, assume, they acquire Radisson Blu Hotels. When they acquire, obviously they'll buy the brand name, correct? They'll buy the brand name. So that, if you think about it, you can value it, right? So central government was telling that, yeah, you can value. On the other hand, what about your self-generated goodwill? So you would have made a name. Let's say, for example, Reliance itself, it has made a lot of name in all these years. Now that brand value, the share price from 10 rupees had gone up to 10,000 rupees. That brand value has come within itself, self-generated. Can you value that? Some of you may say 1,000 crores, some of you may say 10,000 crores, very difficult to value. So central government was telling in those cases, we cannot value. So basically, whether the entire intangible asset is a asset which can be depreciated, all that in PGBP we said it has to be removed, right? So the thing is, the central government had different views on it, courts had different views on it. One case, BC Srinivasa Shetty, they told that the cost of goodwill etc. can never be determined. So they said it is indeterminable. So if I sell some asset, goodwill I sell to you, my name I am selling it to you. When I subtract cost I don't know how to make only, is what they said. BC Srinivasa Shetty said it is indeterminate. So cost is indeterminate. So when I'm selling the goodwill, that amount is what? Untaxed. So to reverse the decision of BC Srinivasa Shetty, section 55 was added, where they said in case of goodwill of business or profession, trademark or brand name, right to manufacture, tenancy rights, loom rights, route permits etc., they said cost of acquisition will be nil. Cost of acquisition will be nil. So guys, instead of indeterminate, what did they say? They said self-generated goodwill cost will be nil, and purchase goodwill, it will be purchase price. Very simple. Cost of acquisition is nil for what? Self-generated. So when I'm selling my own brand name, I sell it for 10 crore. Minus cost, I should take it as nil, which means I have to pay capital gain on the full 10 crore. Crazy. But if I have bought somebody's name and then selling that name to somebody, then I should take the purchase price as the cost of acquisition. What about cost of improvement? For goodwill, patent, copyright, right to carry on business or profession, etc., then it is nil. For goodwill, patent, copyright, right to carry on business or profession, it is nil. Other assets, capital expenditure on or after 1/4/2001. Capital expenditure on or after 1/4/2001, for that you will have the cost of improvement. So cost of improvement for goodwill, patent, copyright, right to carry on business or profession, for that it is nil. But for other assets, you will have capital expenditure on or after 1/4/2001. Definitely you will have the cost of improvement, so to speak. Got it, buddies? So these are all the points with respect to certain special provisions with respect to what? Capital gain. Yes or no, all of you? We will solve sums, but did you understand? All of you with me? Yes. Once for all we can solve. Next. Special provision number 7. Then, because rather than seeing each and every concept, everything will solve one by one. Capital gain in case of unquoted shares. Capital gain in case of unquoted shares. Unquoted shares means what? Shares which are not listed, shares which are listed but not traded regularly. So that if share value is less than the FMB of such shares, then FVOC is equal to FMB. Very, very simple. So for instance, if Sheela Limited has, I have bought 1000 shares from Sheela Limited, which is penny stock, cost of acquisition is 75,000, and I will sell it at rupees 100. So 300 rupees I will take cash. That will not work, guys. Now the rule says FMB, that is 400 rupees you should take. FMB will be the FVOC. What I will do, I will buy shares of 1000 shares, and today I will sell it at, though market value is 400, I will sell it at 100 because they are penny stocks, and 300 rupees I will take cash. They said nothing doing. If share value is less than FMB, share value, how much is it? 100. What is FMB? 400. They say FMB will be the FVOC. 50D, where the consideration is indeterminate. There are certain cases where consideration is indeterminate. So there, for example, if I am exchanging an asset, I am exchanging an asset worth 1 crore for an asset worth 2 crore. So what will be the FVOC? Whatever the asset I have exchanged, that will be the FVOC. That is the gist of the story. So FVOC is equal to FMB of the asset transferred. Then FVOC is equal to FMB of asset received in return. Special provision number 9. First proviso to section 48. Capital gain in case of shares and debentures transferred by non-resident. In all these cases, guys, very, very simple. So here also, whatever it is, I have streamlined everything. In computation of CG, what will I do? I will take here full value of consideration. I will take the average rate on date of transfer. less transfer expenses. And transfer expense also I should take average rate on date of transfer. Net consideration less cost of acquisition, no indexation benefit. So whatever it is short term or long term in foreign currency will be there. Convert into INR, that is on TTBR on the date of transfer. That is telegraphic transfer buying rate. So what is the average rate? TTBR plus TTSR divided by 2. That is in dollars or any other foreign currency is what I need to see. Very, very simple. These are all the sums regarding that. So before we move on to the tax rates, let us open our problems. Check this illustration to 3.375. A is the owner of the car. On 1/4/2023, he starts a business of purchase and sale of motor cars. He treats the above car as part of the stock in trade of his new business. He sells the same on 31/3/24 and gets a profit of 1 lakh. Discuss the tax implication in his hands under the head capital gains. Since car is a personal asset, conversion or treatment of the same as stock in trade of his business will not be tracked by the provisions of 45 to it's a personal asset. X converts his capital asset acquired on 10 June 2005 for 60,000 into stock in trade on March 10, 2023. The FMV on the date of the above conversion was 5,50,000. He subsequently sells the stock in trade so converted on 6 lakh. So guys, this conversion of capital asset into stock in trade, though it happened on 10th March, the taxability is postponed to June 10th. And 6 lakh minus 5,50,000 will be PGBP, and 5,50,000 minus 60,000, that is indexed cost of 60,000, will be the capital gain. That's what they say. And fair market value they have given, no? FME 5,50,000 minus 60,000. Similarly, in case of any liquidation, 46(1), in the hands of the company, that distribution is not a transfer, so no capital gains will come. In the hands of the shareholder, on the other hand, it will come in IFO deemed dividend. Distribution attributable to the accumulated profits of the company. So when the company goes for liquidation, the company transfers to shareholders. From company's point of view, they are selling off the assets, but it is not a transfer. But shareholder is selling off the shares. He is selling the shares and getting the assets. To the tune of the accumulated profit, it is treated as dividend. That is taxable in other sources. On the other hand, if anything extra received, money received, asset distributed, minus the deemed dividend portion already, that will be called as FVOC, and that will be capital gains. Illustration number 4, 3.382. M held 2,000 shares in a company ABC Limited, an Indian company. This company amalgamated with another Indian company XYZ Limited during the previous year ending 31/3/24. Under the scheme of amalgamation, M was allotted 100,000 shares in the new company. Market value of shares allotted is higher by 50,000 than the value of holding in ABC. Assessing officer proposed to read the transaction as an exchange and to tax 50,000 as capital gain. So no guys, if an Indian company is amalgamating with any other Indian company, whatever shares exchanged will be not a transfer. Very clear. If it was not an amalgamated company, then it would be whatever FMV of the shares exchange that will come. But here it will not come. Illustration number 5, page 3.384. Mr. A purchased gold in 1970 for 25,000 rupees. In the previous year, 23-24, he gifted it to his son at the time of marriage. FMV of the gold on the day of the gift was made was 1 lakh rupees. So here, purchasing the gift, giving the purchased gold as a gift is not a transfer. Gift of the capital asset is not regarded as transfer, therefore capital gains will not apply. House property is purchased by Hindu endowed family in 1945. It is given to one of the family members at the time of partition. That also is not regarded as transfer. Convertible debentures 40,000. It has been converted to equity shares 85,000 by the company. Not a transfer again. Mr. Abhishek, a senior citizen, mortgaged his residential house with a bank under a notified reverse mortgage scheme. He was getting loan in monthly installment. Abhishek did not repay the loan on maturity and hence gave the possession of the house to the bank to discharge his loan. When he gives off the possession in the end to discharge the loan, what is the treatment? Mortgaging of residential house with bank by Mr. Abhishek will not be regarded as transfer, therefore it will not be charged to capital gain. Further, 1043 provides that amount received by senior citizen as loan in transaction of reverse mortgage would be exempt from income tax. So no problem. Next, illustration 7, 3.386. Examine with reasons whether the following statements are true or false. Alienation of a residential house in a transaction of reverse mortgage under a scheme made and notified by central government is treated as transfer for the purpose of capital gain. No, alienation in a transaction of reverse mortgage is not regarded as transfer, we have seen. Zero coupon bonds held for 14 months will be long-term capital asset. Yes. Anything more than 12 months ZCB will be long-term capital asset. Zero coupon bond means a bond on which no payment and benefits are received before maturity or redemption. Yes. Zero coupon means zero interest. The only difference between issue price and redemption price will be treated as interest. So cost inflation index, and for our year it is 348. All this we saw. Goodwill of business, right shares, everything we saw. Okay, quickly read this question. Illustration number 8, guys. Illustration number 8, page number 3.405. Come on. Alright guys, so what is the answer? Converts his capital asset acquired for an amount of 50,000 in June 23 into stock in trade. Fair market value is 4 lakh 50. It is sold for 6 lakh 50. They have given CII, very simple. All the capital gains. 6 lakh 50 minus 4 lakh 50 will be PGBP. Now I have to take sale proceeds 6 lakh 50 minus cost FMB will be PGBP 2 lakh. Whereas capital gain will be what? 4 lakh 50 and index cost of acquisition 50,000. And 50,000 first I should take whenever I sold it. When did I sell it? You see that year of conversion. November 22. 22, 23 she should take 331 divided by 109. Easy question. So guys, this illustration is good. Please go through. Illustration number 10, 3.416. All of you go through guys. Please try to read it and try to note down all the points. Illustration number 10, 3.416. Please go through. All of you, 2-3 minutes. That's all. Go through, just mark it. Then we will solve. Don't worry. Everybody with me? Are you reading? Thumbs up. Yes, please. 3-4 minutes, read. Okay, my dear friends, enough of you to read. I hope you read everything. The reason I'm giving you time is here only you can finish off everything. Yes, come on. Mr. A is a proprietor of Akash Enterprises having 2 units. He transferred on 1st April 2023 his unit number 1 by way of slum sale. What is slum sale? In that 1 unit only, if you sell it off, it is slum sale for a total consideration of 25 lakhs. In slum sale, they will not sell the assets as such. The full thing only they will sell it off. The fair market value of capital assets of unit 1 on 1/4/2023 is 30 lakhs. Unit 1 was started in the year 2005-2006. The expenses incurred for this transfer were 28,000 rupees. His balance sheet as on 31/3/23 is as under. So own capital, revaluation reserve for building of unit 1, bank loan 70% of unit 1, trade creditors 25% for unit 1. So guys, this is the overall thing, but in that reserve for building of unit 1, revaluation reserve of the total 3 lakh, what is that, 70% is for unit 1. And next, bank loan 70% is for unit 1. So here, this is for building for unit 1. This entire revaluation reserve, is building for unit 1. So when I am taking the build, what do you say, for slum sale, should I take revaluation, etc.? No. Correct? Bank loan 70% is for unit 1. So 70% of 2 lakhs. 1.4 lakhs is for unit 1. Trade creditors 25% is for unit 1. Like that. Then assets unit 1, unit 2. Unit 2 I should ignore now because that will be overall I should take, but this is what I should take. Right? So what is it? The I should compute slum sale in what way? Very, very simple. First is revaluation reserve is created by revising upward value of the building of unit 1. No individual value of any asset is considered on the transfer deed. Obviously, individual assets will not be sold. The entire unit will be sold. Other assets include patents of 50,000 which is acquired on 1/7/21. In PGBP, I have told you that now any intangible asset, you should not take it as, what do you say, in the block. It should be removed from the block. If it is already there, remove from the block and give the depreciation effect. We have already discussed that, on which no depreciation has been charged. So you remove from there, charge depreciation, and that will be added to the assets. So first and foremost, what will be the consideration of 25 lakhs, slum say FMV of 30 lakhs. As discussed already, it will be obviously the higher of FMV or the consideration, and in this case it is always FMV. FMV will generally be more, 30 lakh rupees. So 30 lakh rupees is given here. So first I should take that 30 lakh rupees. Less transfer expenses, 28,000 rupees. Less transfer expenses, 28,000 rupees. Then this amount I'll get. Minus net worth. If you remember, I should do net worth. And in net worth, if you see, you have to compute the net worth. For normal assets, fixed assets, depreciable value, and for other things you should do book value. So let's see, compute net worth. Net worth, always and always when I'm computing net worth, the WDV has to be taken. So if you see, revaluation reserve is 3 lakh of the building, own capital is 15 lakh, building is 12 lakh, of which 3 lakh is revaluation. We clearly mentioned a revaluation reserve. So what they have done is they have increased the asset side by 3 lakh, then liability side also 3 lakh. So that 3 lakh I have to remove. Building, excluding 3 lakhs on account of revaluation, 9 lakhs. Machinery, again if you remember guys, machinery here they have given 3 lakh rupees. Bank loan 1 lakh, sorry, debtors 1 lakh and other assets 1 lakh 50. So machinery, I will take 3 lakh, debtors 1 lakh. Patents, other assets, if you remember, 1 lakh 50 has this 50,000 already. So I should do 1 lakh 50 minus 50 to make it 1 lakh here. This portion, patents, I'll have to take 50,000 and subtract the WDV, correct? So cost as on 1/7/21. 50,000 less depreciation at 25%. Why? 21, 22, 22, 23 I should take 2 years depreciation. Depreciation at 25% for financial year 21, 22, you have to take 12,500, and then balance as on 1/4/22, 37,500. So if you see here, that is what they have given, and it's 25% for what? For intangible assets. Next year again depreciation you give. So overall balance as on 1/4/2023, 28,125. Remember, I told you it will not be forming part of the block. You should take it out separately and charge depreciation, and then whatever the written down value is there, that has to be added. So yes guys, coming back, building 9 lakh, machinery 3 lakh, debtors 1 lakh, patents 28,125. So it will be what? 14 lakh 28,125. Less, what will you do? Creditors. And as you can see here, creditors is what? 25% for unit 1, bank loan 70% for unit 1. So that will be my liabilities. Book value of liabilities, I should take 70% of 2 lakh, 25% of 1,50,000. So coming back here, that much I have to take here. 25% of 1,50,000, 37,500, 70% of 2 lakh, 1,40,000. So overall net worth will be what? 12,50,625. So this net worth I should subtract from here, and my long term capital gain will be 17,21,375. All of you with me? Yes or no, guys? Come on. Understood? Understood the logic? Good. Very good. Deemed full value of consideration, you have seen 50CA, 50C and 50D. Advance money received also we have seen. We'll come to the exemption part. Yeah, before the tax rates as such, let's do the exemptions. All this is done. All this is done. Slum sale we just did. Exemptions. So exemptions, guys, again there have been a couple of changes, amendments. I'm not talking about the current budget, you forget about it. Finance Act 2024 I'm not worried about. I'm talking about for our attempt only, that is for September, November and January. There have been some changes which was there, which would definitely be applicable for you as well. Yeah, exemption for residential house property, section 54. Eligible SSE, individual or HF. What is asset transfer? Residential house property. Nature of capital gain on asset transfer, long term capital gain. And what you should buy? One residential house property in India. You should sell a house property and buy a house property. Correct? Long term capital. Residential house property you sell, you will buy one residential house property in India. When will you buy? One, purchase a new asset within 1 year before or 2 years after the date of transfer. Purchase a new asset within 1 year before or 2 years after the date of transfer. Or construction a new asset within 3 years after the date of transfer. Quantum of exemption, that is cost of new residential house or capital gain, whichever is lower. Very simple. So either the capital gain, for example, capital gain 30 lakh, cost of new asset 45 lakh. So it is 30 lakh or 45 lakh, whichever is less. Lock-in period, this new house should be there for 3 years. You should not sell it off. Otherwise, whatever benefit you have received will be lost. And if you cannot purchase the house immediately, you can transfer before the due date of filing the return to an account called capital gain account scheme, and it should be there, and you should ensure that you will buy the house from that particular thing. Yeah, right. So that reinvestment should be made. You can keep it in the capital gain account scheme, and within this time limit of 3 years you can make the purchase or construction. Purchase within 2 years, construction within 3 years. Now amendment that had come in the Finance Act 23 was this. capital gain in excess of 10 crore rupees would not be taken into account for the purpose of deposit in CGS. So many people were selling it and making a gain of 12 crore, 13 crore, etc. So they said capital gain maximum limit I will keep it as 10 crore. So the deemed cost of new asset is restricted to 10 crore because of that. For example, if my long-term capital gain is 14 crore, amount incurred by say on construction of new house is 7 crore. Maximum I can deposit in CGS is only 3 crore. Right? That is what it is. Maximum amount is 3 crore. Nothing more, nothing less. Because maximum I can only do 3 crore. Till now construction 7 crore done. I want to construct more. So ideally I can put the remaining 7 crore also in the bank CGS, but it's of no use. Maximum I can put 3 crore. Remaining 4 crore I have to offer to tax, no choice. 54B. Mr. Raj sells, who's an individual or HF, sells an urban agricultural land. The proceeds of that capital gain should be invested in one more urban or rural agricultural land or deposited in CGS. What should be this agricultural land? It should be used by the SSE and parents 2 years before or 2 years after. You have to 2 years before the date of transfer it should have been used for, and within 2 years after I should buy one more urban or rural agricultural land. Capital gains or cost of new asset or deposit amount taken, whichever is less will be the exemption, and exemption will be withdrawn if you don't use it on time. Exemption for compulsory acquisition of industrial land and building, 54D. So Raj Limited compulsorily acquires industrial land and building. Proceeds of the capital gain is either invested or deposited in the industrial land and building or in the capital gain account scheme within the due date, and it is locked in for 3 years. If it is transferred before that, whatever exemption you are getting will be withdrawn. It will be used for industrial purpose 2 years before, or then it is bought, new asset is bought within 3 years. Same you have to deposit in the capital gain account scheme, that will be the exemption. 54EC is transfer of what? Immovable property. Any immovable property if you transfer, proceeds of capital gain is invested in government bonds. These bonds should not be transferred for 5 years. When should you buy the bond? From the date of transfer, within 6 months you should buy those government bonds. Maximum investment will be 50 lakhs. Next, 54F. In 54F also, this is selling any other long-term capital asset other than a house and buying one house. What will you sell other than residential property, and what will you buy? Residential property. Other than residential property you will buy, and what will buy? Residential property. Other than residential home to residential home. Purchase new asset within 1 year before or 2 years after the date of transfer. Construction of new asset within a period of 3 years after. So here in this 54F, guys, sale proceeds are not invested, or rather capital gain is not the quantum of exemption, it is a net consideration. If the consideration is 1 crore but the capital gain is 40 lakhs, in other sections if you invest this 40 lakhs you will get. But here 1 crore if you are investing, then full 1 crore you will get the exemption of this 40 lakh capital gain. If you invest full 1 crore, then 40 lakh exemption you will get. If you invest only 50 lakhs, this is the capital gain. This capital gain 40 lakhs exemption you will not get, you will get proportionate. Only 20 lakhs you will get. That's what they are trying to tell. Proportionate. Capital gain was 50 lakhs and net consideration is 90 lakhs. And if 90 lakhs is fully utilized, then only you will get full 50 lakhs exemption. On the other hand, capital gains is 50 lakhs and net consideration is 90 lakhs. Only 70 lakhs you have used. You will not get this full 50 lakhs. You will get 50 lakhs into 70 by 90, 38.8 lakhs you will get the exemption. Everybody with me, guys? Yes or no? 54F is the only section which talks about what? 54F is the only section which talks about net consideration being used for exemption. Here also in the capital gain account scheme an amendment has come, that is the cost of the new house is maximum only till 10 crore. So if you see here, if net consideration is 15 crore, capital gain is 7.5 crore and the amount incurred for construction is 6 crore, SSE can deposit only 4 crore. Correct? So if the SSE deposits only 3 crore, cost will be 9 crore. That's all. So net consideration 15 crore. Capital gain 7.5 crore. He has already invested 6 crore. Maximum he can deposit 4 crore into the bank account. This 15 crore is useless. Let's say he only deposits 3 crore. So I will take it as 9 crore. So I will say very simple. What will be the exemption? Exemption of capital gain 7.5 crore. But I am only investing 9 crore out of 15 crore. So this will be my exemption, that is 4.5 crore, as simple as that. You will not get any full exemption. Net consideration full exemption you will not get, because of the amendment also it says maximum capital gain, whatever is possible, is only, or maximum investment that you can make is only 10 CR, nothing else. Right, some general notes on exemptions. Cost of land acquired will also be eligible for exemption along with the construction. Yes, land also is separately you should take. And this section 54, there is one more thing where you can buy one more asset. It's, you can buy 2 residential homes here. In a case where amount of capital gain does not exceed 2 crore, the SSE may, at his option, purchase or construct 2 residential houses in India instead of 1 in India. Further, such benefit shall be available only once in the lifetime of an SSE. You can buy 2 homes. If the 2 flats are acquired by the SSE one before the other, even if it is under 2 separate agreements, they will merge it and make into one house. So you can treat it as one house only. Many people do that. In flats, they want a bigger house. So one house will be 1000 square feet, other house will be 1000 square feet. They'll buy one after the other, demolish it and make it one single unit. So it will be construed as only single house. Yes, guys. Now coming to the tax rates. In this, there has been an amendment with respect to 50AA. New section has been added. Whatever I am saying, new section has been added. It is not in Finance Act 24. Do not worry. I am not even discussing anything that has changed in the budget. I am talking about what is relevant for your exam. So in Finance Act 23, she came out with a new concept called 50AA, which is very much important for your exam, which we'll discuss. So what are the tax rates? (112A) is applicable for what? Equity share, unit of equity oriented fund and unit of business trust. So payment of security transaction tax should have happened. Equity shares of a company, it's paid on acquisition or transfer, or units of equity oriented mutual fund, equity oriented fund, sorry, it is paid on its transfer. So what is the tax on the amount of long term capital gain up to 1 lakh rupees nil? Exceeding 1 lakh rupees, it is at the rate of 10% on capital gains exceeding 1 lakh. So there is a 10% rate given for this, and other things would remain the same. So under 112A, there was a reduced taxation of 10%. Basic exemption limit, yes. So 112A covered what? Equity shares, equity oriented units and units of business trust. Up to 1 lakh exempt, more than 1 lakh 10%. In normal other cases, it is would be your normal 112, that is 20%. Yes. So under 112A, long term capital gain 10% in excess of 1 lakh, and 111A, short term capital gain 15%. Equity shares, equity oriented units, units of business trust, it is mandatory to pay under this. Any other than 112A and 111A, that is any other asset, if it is long term or short term, short term normal tax rates, long term 112 tax at 20%. Tax at 20%. Then there is a proviso to 112 which says if anything which is LTCG on listed security, that is other than units and ZCB, like for example listed preference shares, equity shares on which STT is not paid, in these things it is 10% without indexation or 20% with indexation, whichever is less. Now they came out with one more thing called market linked debentures in the Finance Act 2023. That is the important point that I was saying. Market linked debentures means what? Let's see. 50AA, investment. Investment can be in equity, investment can be in mutual fund or others, investment can be in fixed deposit, investment can be in savings. If investments are in fixed deposits, then it's a slab rate, we know. Investment in savings bank, it's slab rate, we know. Investment in equity, equity is what? It can be listed, right? Listed equity shares, you see. If it is greater than 12 months, it is long term capital gain. Less than 12 months, short term capital gain. 112A. So under 112A, greater than 12 months, it is 10% in excess of 1 lakh, we have seen. Less than 12 months, STCG 111A, 15%. 15%. So equity of mutual funds, on the other hand, mutual funds, it can be equity, debt or hybrid. If it was equity, my dear friends, that is anything equity oriented units, that also was coming under this only. Period of holding 1 year, that also same thing, 10% or 15%. But mutual funds which is debt or hybrid, they include a certain thing called market linked debentures. If it was less than 3 years, that is 36 months, it was the slab rate. If it was more than 36 months, then we had a proviso, that was 112, which said 10% without indexation and 20% with indexation. Now this portion has been deleted for market linked debentures, and they say instead of this benefit, you will have to pay the slab rate. 50AA, everything is STCG at slab rate. everything is STCG at slab rate. It is deemed, whether you hold it for more than 36, less than 36, I don't care. It will be deemed to be short-term capital gain is what they say. So what is market-linked debenture? Any specified mutual fund where investment in equity is less than or equal to 35%. Investment equity is less than 35%, which means greater than or equal to 65% is in debt. So this will be what? Slab rate will be given. Everything is STCG and you will take a slab rate for this. So that is the amendment. Did you understand, guys? What is the logic here? This debt and hybrid instruments which are there more than 36 months, that has been deleted, and 50 AA, everything is STCG at slab rate. Yes or no, all of you? Now there is no 36 months, less than 36 months, everything is short-term capital gain. Market linked debenture, specified debenture. Yes or no, all of you? Yes, good. So we saw where all have they given FMB in Income Tax Act. 45(1)(a), destruction of capital asset. If asset is given as a replacement instead of money, then FMB is what should be taken. If you destroy and get insurance money, then insurance money. Otherwise, if you get a new asset, then FMB of the new asset should be taken into consideration. 45(2), capital asset converted to stock in trade. FMB on the date of conversion or transfer will be the full value of consideration. The stock in trade converted to capital asset, reverse case. Stock in trade converted to capital asset. FMB on the date of conversion will be the PGBP, and same value should be taken into the block of assets. 45(4), if there is any dissolution case that you will see in final. 46(2), in IFOS we will discuss that concept of dividend. 50(ca), sale of unquoted shares, FMB will be taken if it is more than the value. Then 50(d), when the selling price, when it is not determinable, FMB of the asset received or exchange will be taken into account. All shares, all bonus, all assets before 1/4/2001, I will take the FMB. Special point of section 55, shares and bonus, that you leave, that is fine. So these are all the various points that you have to keep in mind. Apart from that, let's see. This is what we have seen already. That's about it, guys. Then one more amendment with respect to the ULIPs. Come to the September 24 update which they have given. This is again important. So many things have come. Okay, actually we can still do this in income from other sources, no problem. We'll do it there. As we have seen, if the LTCG, I am reading page number 3.425 in our material. If the LTCG computed is 7 crore, cost of new house is 12 crore, amount should be 12 crore or 10 crore, whichever is lesser, 10 crore. LTCG computed is 12 crore, cost of new asset is 14 crore, I don't care, 10 crore. LTCG computed is 11 crore, cost of new asset is only 9 crore, so I'll only get up to 9 crore, I can't take 10 crore. Basically they are trying to tell whatever it's the cost of the new asset, that new house, that only you should take. You see, cost of the new residential house exceeds 10 crore, the amount exceeding 10 crore would not be taken into account for exemption. Maximum exemption can be claimed is 10 crore. LTCG computed is 15 crore, cost of new house 13 crore, still I can take only 10 crore. If the LTCG is 8 crore and the SSC has incurred 5 crore in the construction of new house up to the date under 139.2, as per 54.2, he can deposit an amount of only remaining how much? 3 crore, not appropriated by him towards the construction for claiming benefits. If he deposits only say 2 crore, then the deemed cost of new residential house will be the 5 crore plus whatever 2 crore that he deposited. That's it. He cannot claim. So he has to deposit the remaining amount in the capital gain account scheme. So if you transfer the house before 3 years, what will happen? The new house you will sell it for 5 crore, which you should have kept for 3 years, you sell it off. So cost of acquisition minus capital gains exempt earlier, that will be subtracted. What is cost of acquisition? It was bought at 3 crore. You see, for example, long term capital gain is 2.05 crore and the cost of new house is 3 crore. The long term capital gain which was exempt earlier was 2.05 crore and the cost of new house is 3 crore. Entire long term capital gain of 2.5 crore will be exempt obviously. But if the new house was sold after 18 months only for 5 CR, short term capital gain chargeable to tax will be how much? When you subtract the cost here, instead of making it 3 crore, you will make 3 crore minus 2.05 crore. You will take the cost only as 95 lakhs. Therefore, this will be the short term capital gains. Here, long-term capital gain of 75 lakh arising from transfer of building on 1/5/23 will be exempt from tax if such capital gain is invested in bonds redeemable after 5 years issued by NHAI. No, only 50 lakh, not 75 lakh. Let us see some questions if they are there. Then we can take a break, guys. After the break, we can start IFOS or something. All this is recapitulation. Okay, so third question has been asked in the exam couple of times. Interesting question. Mark this as important. Page number 3.466, guys. Question number 3, please solve. Take 5 minutes, solve it. After this, we'll take a break, don't worry. Please solve, guys. Come on. Push it and solve. Question number 3. I'll just read it for you, then you can solve. Mrs. Harshita purchased a land at a cost of 35 lakhs. So, one land, 35 lakhs. And held the same as capital asset till 20th March 2023. So, Harshita, what did she do? Bought a land in the year 2004-5. 35 lakhs. Started real estate business on 21st March 23. This was held as capital asset, converted to stock in trade on 21st March 23. 23-24 basically. And she constructed 15 flats of equal size. On this land, 15 flats. She constructed 15 flats. Cost of construction of each flat is 10 lakhs. Cost of construction 10 lakhs. She sold 10 flats at 30 lakhs per flat. So how many are there? 15 flats are there. In that 10 flats she sold, 5 was closing stock. Remaining 5 closing stock. So this 10 she sold at 30 lakhs per flat. She invested 50 lakhs in bonds issued by NHAI on 31st, another 50 lakhs in bonds of rural electrification. 50 plus 50. Will you get 1 crore or only 50? That you have to think. Compute the amount chargeable under capital gains. Very simple. So you have here capital asset converted to stock in trade, and you have the capital gain is not on the year of conversion but in the year of transfer, because she sold it when? March 24 only she sold. Difference between this and this will be PGBP. And have they given FMV? Yes, land was 210 lakhs. This land's FMV was 210 lakhs. Very interesting question. Did you understand the question, guys? Yes or no? All of you? Others, did you understand? Okay. Solve. Alright buddies, so let's discuss this problem. Right, so now when you are selling the land, converting to stock in trade in 23-24, this is a transfer, no doubt about it. But the taxability is postponed when these flats are sold, and only 10 flats are sold, right? Proportionately it is sold. On this entire land of 210 lakhs, 15 flats are sold. So what would be by PGBP? That is very simple. PGBP would be the selling price of the flat, 10 into 30 less. What would be the cost? Two costs will be there. One is cost of the apartment, 10 into 15. 30 into 15, sorry. Selling price is 30 lakhs into 15 sold. So 10 sold, no, sorry, my bad. 10 sold. And what will be the cost? Each is 10 lakhs. 10 apartments into 10 lakhs. Then, my dear friends, I should also take the proportionate cost of what? Land is also there, no, that we forget. 210 lakhs, that is for the entire 15 flats. I should take that proportionate cost also. So check it out. That's what I am trying to tell. Third question is interesting. Here, business income 10 into 30. Then cost of construction 10 into 10. Then I should take the land also, no, 210 lakhs. 210 lakhs is actually for 15. How much is for 10? That's why 2 by 3. This also I have to take. This generally we don't take, we lose marks. 60 lakh is the PGBP. And what about that? FMB on the land on the date of conversion will be deemed to be FAOC. But I should take, how much is that FMB? 2.1 crore. Full I should take. Minus index cost of acquisition. 35 lakhs is what I bought. 331 by 113. 2004, 2005 is 113. This much. But guys, will I tax the entire amount this time? No, because only 10 out of 15 flats are sold. In that land, the entire land value capital gain is this much. But in that only 2/3 I have utilized, I have not yet sold. So 2/3, 71 lakh 65, 192 will come. Very, very simple. And then after that I am investing it in 54 EC. 54 EC I will not get 150 lakhs plus 50 lakhs. I will only get once. So 50 lakhs. Understood all of you, yes or no? All of you, yes or no guys, come on, others. Okay. We'll solve one more last question, then that's it. End of capital gain. Question number 6. All of you, question number 6. Miss Yuvika. Miss Yuvika bought a vacant land for 80 lakhs in May 2005. Registration were 10% of the cost of land. She constructed a residential building on the land for 100 lakhs. Vacant land 80, building cost 100. Total cost, vacant land, registration, other expenses and all 10%. She entered into an agreement for sale for the above said residential house with Mr. Johar, not a relative, in April 2015. Sale consideration was fixed at 700 lakhs on 23/4, received 20 lakhs advance by executing an agreement. However, to failure on part of Mr. Johar, said negotiation could not materialize and hence the said amount was forfeited. 23/4/2015. Yuvika entered into an agreement again on 1/8/23 for sale of house at 810 lakhs. Received 80 lakhs as advance by RTGS. Guys, 20 lakh as advance in cash. What you'll do? Cash. Right? Nothing. Here in RTGS, stamp duty was 890 lakhs. Selling consideration 810, 890, that 110% you should do. Sale deed was executed and registered on 14/1 for agreed consideration. However, stamp duty has revised the values. Value of property was 900 lakhs. I paid 1% brokerage. So now should I go to the valuation authority or what? All that you should see. Subsequent to sale, made the following acquisition. Two residential houses, Delhi and Chandigarh, 130 and 50 lakhs. Can you buy two? You need to see. If your capital gain is less than 2 crore, you can buy, otherwise no. One more residential house in UK. Under 54, can you buy one house in UK? Think about it. Subscribe for 54 EC, 50 lakhs and 40 lakhs. Can you take 50 and 50 or only 50 overall? Only 50. Very, very interesting question. Take your time, 3-4 minutes, solve. After that, we'll take a break. Sir, last time also you told the same thing. Yes, but please solve it, guys. Once capital gains is over, then you deserve a break, no? Yes, solve. Yes. So Yuvika bought a vacant land for 80 lakhs. All done, 20 lakhs advance. Let's see the answer, guys. So very simple, but then you should see first of all that 110%, and then if they are given it to the valuation of authority, what to do, all those things should be kept in mind. So let's check that. Yeah, actual sale is 810 lakhs. Value adopted by stamp authority is 890 lakhs. So where sale consideration is less than the value adopted. So first I should see 810 lakhs stamp duty value and consideration 110%. 810 lakhs and 81 lakhs. It is 892 lakhs. Value adopted by stamp duty authority shall be taken as consideration. However, where the date of agreement is different from the date of registration, stamp duty value on the date of agreement only can be considered. So generally, guys, if I make it this one, it is 891 lakhs, but the valuation they have made it 900 lakhs, if you remember. 890 was what was there before. After that, it was made to some 900, revised. Should I take this or should I take this is the question. So there is one more, issue or one more provision which says the date of agreement, if it is different from the date of registration, stamp duty value on the date of agreement can be considered provided the whole part or part of the consideration is paid. In this case, advance of 80 lakhs is paid through RTGS on the date of the agreement. Hence, I can adopt the date of the agreement. So 810 lakhs plus 81 lakhs is 891 lakhs. This is less than 890 lakhs, no problem. So I can take 810 lakhs, no issues. 810. Brokerage, I should subtract 1% of sale consideration. So this will be my net sale consideration. Index cost of acquisition will be what, guys? 80 lakhs they have already given, plus registration other expenses 8 lakhs, being 10% of the cost, 88 lakhs. 88 lakhs, 348 this year it is sold, and 117 the year it was procured. Similarly, cost of construction they have given 100 lakhs, same, I have to make it indexation, so it comes to 270.3. 270 lakhs, that is 2.7 crore. And it was held for more than 2 years, hence it is long-term capital gain. An exemption under 54, where long-term exceeds 2 crore, capital gain arising on transfer shall not be chargeable to tax to the extent it is invested. Therefore, in the present case, he will only take it for 1 homes, not for 2 homes. Will be available only in respect of 1 residential house acquired in India, definitely not in the UK. So of the two, whether you will take Delhi or the other one is what up to you. Whichever gives you more exemption, you should take. So you should take the Delhi one, 130 lakhs. Because the 2 houses you can buy in India. So what you bought in UK, gone. If it is less than 2 crore, you can buy 2 in India. Then whether you invest 50 lakh and 40 lakh, 90 lakh, it is not considered. It's only 50 lakh is considered. So here. So this advance of 20 lakh income from other sources, it would have been charged since the same was forfeited as a result of failure of negotiation. Hence, it will not be deducted in computing index tax. So there, even though you took in cash, ideally speaking, you should offer to tax. You cannot treat it as black money. You should offer it to tax. So that completes, my dear friends, what? Capital gain. Did you understand, all of you? Yes or no? All of you with me? Yes or no? Tell me. Did you understand? We have clear, extremely in-depth we have done, and I hope it was of use. So we will meet in 20 minutes, 11 o'clock we will meet, and we will start off with income from other sources. In that, there have been some amendments with respect to 1010D and all that. ULIP, we will have to do all those things. Don't worry, IFOS we will do. Yes or no, guys? And after that, we will do salary or TDS, whatever. Okay? See you at 11 a.m. Cheers. Let us start off with income from other sources, right? popularly called as IFOS, income from other sources. So basically, like if I have a house worth cost of 3 crore and SDV of 2 crore, if I give a 2 crore check, it's fine, then it's all sorted, no problem. But if the SDV is, I mean, fair market value is higher, because SDV will be generally slightly lesser than the FMV. If the fair market value is higher, so I will only, to ensure that the stamp duty authority is happy, I will till the stamp duty value, that is 3 crore, I will write in the agreement. Remaining balance amount, let's say it's around 4.5 crore market value. 1.5 crore I will take cash. All these things were happening. 110%, all those things were happening. And I would sell my house, that's fine. I would gift my house, okay. Or I would sell my house at a lesser consideration, that also is fine. Or I would give my house for free at 1 rupee, inadequate consideration. So to curb all these things from happening, there was a concept called gift taxation. So gift taxation essentially is what? Double taxation, so to speak, because that is how it is, double taxation only. So I told you about my one example, right? So your house SDV was 5.6 crore, cost was 3 crore. So you sold it for 4 crore. Remaining 1.5 crore you took cash. So what they are trying to tell? For the seller and for the buyer. Buyer actually paid 4 crore for it, but is getting a 5.6 crore property. Seller actually got 5.6 crore, 4 crore through bank account, 1.6 crore cash. But he is showing in his FVOC 4 crore. Cheating. So what has happened, if we have seen here, if SDV is greater than 110% of consideration, then SDV is equal to FVOC. Consideration 4 crore, 110% 4.4 crore. SDV 5.6 crore is definitely more than 4.4 crore. Hence, in this example, I will have to pay tax on 5.6 crore. You received 4 crore plus 1.6 crore through cash you received. So to stop you from cheating further, I will tax you on 5.6 crore. This is with respect to seller in capital gain chapter we saw. But now come to this fellow. This fellow is selling, outflow of cash is 4 CR. Outflow of cash is 4 CR. How much is he getting in? 5.6 crore. Outflow is 4 crore. Coming in is 5.6 crore value. The difference between the two, is it 50k? More than 50k? Yes, it's crores here. Difference between the two is more than 50,000. Point number one. Point number two. Again, here is it like more than 110% of SDV? Yes. If I had received up to 4. If the SDV was up to 4.4 crore, I could have managed. Why? 110%. But it is way more. Excuse me. So, what do they say? Though you are paying 4 crore but getting value 5.6 crores, you will have to pay tax on 1.6 crore. And this will be income from other sources. Gift taxation 56 to 10. 56 to 10. right? That is called what? Gift taxation. So we'll see that further now. Come on guys, everybody with me? Everybody with me? Everybody with me? Yes or no? Okay. Here. Gift taxation chart. Money, if you give more than 50,000 rupees, gift, more than 50,000 rupees, if you give gift, it is taxed fully. Immovable property, without consideration, (56 to 10 BA). Inadequate 56 to 10 B. Movable property without consideration, inadequate consideration. How does it work? Mr. A received 45,000 rupees worth shares from Mr. B, and from Mrs. A gifts worth 40,000 rupees. Both put together is 85,000 rupees. Still 56 to 10 will not apply. Gift taxation will not apply because it says per a person. From one person it should be more than 50,000. So no problem. And property is different from cash. Property is different from cash, so it will not apply. Praveen is getting from Miss Muruku 48k gift of shares and gold. Both are same items. No, it is other than cash. Cash is separate, other than cash separate, so 50-50. But here cash and, sorry, other than cash basically. Movable property, immovable property, or movable, both movable property you are getting. Even though it is from two different persons, no issues, 56 to 10 will come, gift taxation. So it's okay if it is from multiple people because they have used the word aggregate. So here I told multiple people are no problem, but actually they have used the word aggregate. If it is two different items, cash separate, share separate, then 40-40, 50-50 separately you should see. But with the same other than cash, movable, see movable, not cash. So even if it is from multiple people, it's okay because they have used the word aggregate. So 56 to 10 gift taxation will come. Movable I took shares, gold I took. And one is without consideration, one is inadequate consideration. Right? Here I am taking both. Movable only, but one is without consideration, one is inadequate consideration. Still 56 to 10 will not apply because that 50,000 limit should be seen for without consideration separately in aggregate, for with inadequate consideration separately in the aggregate. On the other hand, immovable property. Mr. PJ received 48k and 45k immovable property from two people. Both put together it is more than 50,000. Thankfully here for immovable property alone the word aggregate is missing. So you should see per property more than 50,000. It is per property more than 50,000. Gift on the other hand, if you have an employer-employee relationship, if it is money, fully taxable. If you are giving it in kind, if FMV is more than 5,000 rupees, fully taxable. Always taxed in the hands of the recipient or donee. Always taxed in the hands of the recipient. If it is business or profession, there has to be a nexus, then it will come under PGBP. What amount? Any amount. It will be taxed in PGBP. Any other gift, then it will be taxed. We will see the chart. We will see that. Hold on. Other gifts, money. If aggregate money received is more than 50,000 rupees per annum, then fully taxable, as we have seen. Immovable property, that is land, building, or both. Immovable property, land, building, or both. If it is without consideration, if per property SDV is more than 50,000, if per property SDV is more than 50,000, then it is fully taxable. If per property SDV is more than 50,000, then it is fully taxable. Inadequate consideration per property. If it is without consideration also, it's per property, not in the aggregate. Inadequate consideration also per property. If SDV is more than 110% of consideration and SDV minus consideration is more than 50,000 rupees, then the difference will be taxable. Difference will be taxable. Very simple. So for example, selling price 10 lakh, SDV 10 lakh 60. SDV minus consideration, is it more than 50,000? Yes. But is SDV greater than 110% of consideration? No. Hence, gift taxation will not come. Others, shares, security, jewelry, drawing, archaeological collection, painting, sculpture, work of art, bullion, all these things, and virtual digital asset as per Finance Act 22. Without consideration, if aggregate FMV is more than 50,000, fully taxable. Like shares 20, art 40, jewelry 20, totally 80,000. Aggregate 80,000, fully taxable. Because here they use the word aggregate. Inadequate consideration. If aggregate consideration, that is FMV minus consideration, is more than 50,000, then the difference is taxable. For example, shares FMV 1 lakh, selling price 30 lakh. FMV minus consideration is more than 50,000. So 70,000 is fully taxable. There are exceptions though. Even though you give a gift, etc., on the occasion of marriage, no problem. Or if you receive from a relative, no problem. For HUF, any member of HUF will be a relative, right? So HUF gifting an immobile property to a member of HUF, correct? What is exempt is member of HUF gifting an immobile property to HUF. On the other hand, HUF gifting immobile property to member of HUF, that is different. So what is exempt is only member of HUF gifting immobile property to HUF. That is only exempt. So see this example here, let's see. There you go. Sum of money. Money was received from the following: Abel 15,000, Bhargav 20,000, Chandra 10,000, Danish 5,000. Total 50,000, not taxable. Money was received from the following: Abel 15,000, Bhargav 25,000, Chandra 40,000, Danish 5,000. Total 75,000, received in excess of 50,000, fully taxable. Next, movable property without consideration. If aggregate FMV of property exceeds 50,000, then it is fully taxable. The following was received without consideration: sculptures 40, shares 15, jewelry 25, total 80,000, received in the aggregate of 50 lakh. Hence it is fully taxable. Inadequate consideration. If aggregate FMV minus consideration exceeds 50,000, then difference is fully taxable. Jewelry is received for 20,000, FMV of jewelry was 80,000. Difference between the two is more than 50,000. As it exceeds 50,000, 60,000 is fully taxable. Mobile property includes shares, jewelry, drawings, sculpture, archaeological collection, painting, bullion, etc. Done. Thank you, boss. Thank you so much. Thank you. Immovable property without consideration. If aggregate SDV per property exceeds 50,000, then it is fully taxable. So plot received 40,000, building received 47,000, not taxable as SDV per property must exceed 50,000. Inadequate consideration. If aggregate SDV minus consideration per property exceeds 50k and SDV is greater than 110% of consideration, then building was purchased for 4 lakh, SDV was the building for 4,60,000, SDV minus consideration 60,000 and SDV is greater than 110% obviously, so hence 60,000 is fully taxable. So these are the various examples through which you can understand this particular 56-210. Are you understanding, yes or no, guys? Hope you had coffee also. Cheers. I'll also be having coffee now. Definition of relative, we have seen all these things, lineal ascendant, descendant and all these things, yes. Spouse of individual, brother or sister of individual, brother or sister of spouse, all these are covered, all this we have seen. Then apart from that, trust or charitable institution, registered under 12AA by way of distribution of capital asset upon partition of HF, by way of transfer of capital asset by holding company to wholly owned subsidiary, transfer of capital asset by wholly owned subsidiary to Indian subsidiary company, holding company, all these things will be taken into account. They are not chargeable to IFOS under 56-210. Yes. One second. Right? Next. Let us see the ISM quickly. Same thing we discussed, all these things. Okay, and they have given deemed dividend here. You will finish off and do that, guys. It's okay. So we have 43 CA also. If SDV is greater than 110% of consideration, then SDV is equal to selling price, that is PGBP, for computing the business income. Just like we have 50C, so we also have 43 CA. We have seen that same, no change. Valuation officer, everything is the same. Just like 50C, we have 43 CA. 43 CA is for builder, whereas 50C is for normal person. There was just a COVID amendment. If the assets are transferred between 12th November 2020 to 30/6/2021. Then only that 110% threshold was made as 120% threshold. That's all. But that is not relevant now because only during that thing, that's all. So 43CA and 50C are the same. 43CA is for business, 50C is for what do you say, normal selling of assets. There you go. Illustration number 2, please solve. Page number 3.502, illustration number 2, guys. Illustration number 2. All right, buddies, let's see. Right. So, dealer in shares received the following without consideration. Cash gift of 75,000 on his anniversary. Guys, anniversary and all is not covered, only marriage. Correct, 75,000. So, when you are going into prison, marriage, that time only you will have to, what? That is exemption. Then when you have to, fulfill your anniversary in prison, then no tension. Simply I am telling, yeah. Keep it to yourself. Yes. So that is what it is. That is what is 75,000 fully taxable. Bullion, that is gold. Fair market value of which was 60,000 rupees. On his birthday, he is getting bullion. And then on his birthday, its bullion is included in the definition of property. It is received without consideration, fully taxable. Birthday and all is not covered, guys. Only marriage. 60,000 rupees, fully taxable. Plot of land at Faridabad on 1st July, stamp value of which is 5 lakh, had purchased the same land in 2009. So that 5 lakh, definitely it will come. So next, purchase from his friend C, who is a dealer in shares. 10,000 shares of X at 400 each on 19 June, FME was 600 rupees each. Sold the shares in the course of the business. So here, difference of 2 lakh. Why? 600 minus 400, 200 into 1000, 2 lakh rupees is more than 50,000. I mean, anyway, it is either way, that more than 50,000 will not come. The difference will be taxable for sure. That difference of 50,000 is only for immovable property, right? So here, stock in trade, since is a dealer and share, subsequently sold in the market, etc., all these things, will it come or not? Ideally, it would have come. But if you see, who is purchasing from what? Who's a dealer in shares? The difference of 2 lakh in the value of shares purchased from C, dealer in shares, is not taxable as it represents the stock in trade of Mr. A. Since Mr. A is a dealer in shares, it has been mentioned that the shares are subsequently sold in the course of his business. That's the reason why not allowed. Otherwise, not part of IFOS. Otherwise, it would have been. Course of his business. Purchased from his friend who is also a dealer in shares. Here, dealer in shares. Stock in trade it is, no issues. It will not come in IFOS, it will come in what? For him it will be PGBP later. Mr. A took possession of the property booked by him 2 years back on 20 lakhs. The stamp duty of the property as on 1st November was 32 lakh and date of booking was 23 lakh. He had paid 1 lakh by account pay check that time only. So you should take 23 lakh or you should take 32 lakh. You should take 23 lakh. $20 lakh overall. So 20 lakh into 10%, 2 lakh, 22 lakh. 22 lakh, is it less or more than, what is the SDV? 23 lakh. So you should take what amount? 23 lakh. So the difference, basically difference between 23 and 23 lakh, is it more than 50k? Yes. Then SDV, 23 lakh. 110% of consideration, 22 lakh. Is 23 lakh more than 22 lakh? Yes. Hence 3 lakh. He sold the plot of land at Faridabad for 7 lakh. So plot of land, capital gains, plot of land 7 lakh minus cost. What is the cost of acquisition? Is deemed to be the stamp duty value because you have already paid tax on that 5 lakh. So 7 minus 5, 2 lakh will be my capital gain. Very, very simple. These type of questions can come in MCQs and all those things. That's why you should be careful. Akhil HUF received 75, illustration number 3. Akhil HUF received 75,000 in cash from niece of Akhil, daughter of Akhil's sister. Akhil is the karta of the HUF. What do you think? Amount taxable 75,000. Sum of money exceeding 50,000 rupees received without consideration from a non-relative is taxable for sure. Akhil's sister is not a relative of Akhil HUF, obviously. I'm talking about relative of HUF, not relative of that person. Nitisha, member of her father's HUF, transferred a house property to the HUF without consideration. So, member transferring to this thing, it is exempt. Immobile property received without consideration by HF from the relative is not taxable under HF. She is a relative of the HF. Right? Yes. One second, guys. Just 1 second. There's some technical problem. 1 second. Hold on. Right. Are you there with me? Mic testing check. 1, 2, 3. Are you there? All of you? Sorry, guys. Sorry. Right. So, that, what do you say? Immobile property received without consideration by HF or relative is not taxable under 56.210. Since Nitisha is a member of the HF, relative of the HF, or income from such asset would be included in the hands of Nitisha under 64.2. Done. Third one. Mr. Rakshat received 100 shares of A Limited from his friend as gift on occasion of his 25th marriage anniversary. Nothing he will get. No exemption. FMB on that date was 100 per share. He also received jewelry worth 45,000 from his nephew on the same day. So guys, nothing. 55,000. That is 100 per share, FMB 45,000. 100 into 100. 1 lakh. 1 lakh minus 45. 1 lakh is what he received, FMB. Jewelry also he received 45,000. So ultimately everything he received. As per the provision 56.210, in case aggregate fair market value of the property, whatever received is more than 50, everything is fully taxable. One is 45,000 and this is 1 lakh. What will come? Point number 3, Akshat. Aggregate fair market value of property other than immobile property received without consideration exceeds 50, whole of the aggregate value shall be taxable. Aggregate fair market value of shares, right? 100 into 100, sorry guys, my bad, 100 into 100. I am telling 1 lakh like a fool, sorry, 100 into 100 is 10,000. So 10,000, my bad. Mathematical error, sorry. 10,000 plus 45. That's why I was wondering. It should be 1 lakh 45. I was thinking there's a mistake there. My calculation mistake. My bad. So like that, stupid mistakes like me don't do in the exam. So 100 into 100, I'm telling 1 lakh. Awesome. Right? So 10,000 plus 45,000. Overall, how much, guys? 55,000. Is it more than 50,000? Yes. Kishan HUF gifted a car to son of Karta for achieving good marks in 12th board examination. Fair market value of the car is 5,25,000. Car and all he got, guys, for when finishing 12th standard exam. Awesome. So what do you think? Nil. Car is not at all included in the definition of property. Just read this question. Interesting illustration for page 3.504. Yes. Hari, property dealer, sold a building in the course of his business to his friend Mr. Rajesh, who is a dealer in automobile spare parts, for 90 lakh on 1/1/2024. On 1/1/2024. When the stamp duty value was 150 lakhs. Agreement was, however, entered into on 1/9/23 when the stamp duty value was 140 lakhs. Mr. Hari has received a down payment of 15 lakhs by a cross check from Rajesh on the date of the agreement. Cross check is equal to cash only, as you know. Discuss the tax implications in the hand of Hari and Rajesh, assuming that Mr. Hari has purchased the building for 75 lakh on 12th July 22. Would your answer be different? Is Hari also was a share broker instead of property dealer? Guys, if you are a property dealer, as I told you, 43 CA will come. The building represents a stock in trade is transferred for less than consideration. Under 43 CA, there is an option to adopt the stamp duty value on the date of the agreement if the part of the consideration is paid by bank, RTGS, etc., not by cross check. Down payment of 15 lakh is received by cross check and not account pay check. An option cannot be exercised. It cannot be exercised, guys. Therefore, 75 lakh being the difference between the stamp duty on the date of transfer, 150 lakh minus 75 lakh, would be business income in the hands of the seller, Mr. Hari. Because if you see, 150 lakh is SDV, agreement was entered into at 140, so I should take 150 only at the time of registration. 150. 75 lakh is the difference between what? Stamp duty and the value of transfer and the purchase price. 75 lakh would be business income. Very, very simple. In the hands of the buyer, Mr. Rajesh. Since Mr. Rajesh is a dealer in automobile spare parts, the building purchase would be a capital asset in the hands. The provisions of section 56(2)(10) would be attracted in the hands of Mr. Rajesh, who has received immobile property being capital asset for inadequate consideration. And the difference between the consideration and stamp duty value exceeds 9 lakh rupees, being the higher of 50,000 and 10% consideration. Therefore, 60 lakh rupees being the difference between what? SDV and value of property, 150 lakh minus 90 lakh, would be taxable in his hand also. Is it double taxation? Yes. Here it was 150 minus, here it was 150 minus 75. And here it is 150 minus 90. 60 lakh. That's what it is. IMPS, UPI, RTGS, NEFT and BHIM, all these things will be taken into account. On the other hand, in the hands of the seller, if he was normal share trader, then 50C will come. Under 50C is what? The building would represent a capital asset, and if it's exceeding 75, 110%, same 75 lakh being the difference between stamp duty value and the purchase price, would be chargeable as short-term capital gain. On the other hand, here 60 lakh being the difference between stamp duty value and date of registration would be taxable under then 56(2)(10) in the hand. That will not change, that will be the same. Everyone with me, yes or no? Right. I will come to that part now. 1 second. Before that, two and three. Now that we have done IFOS also, sorry, house property and capital gain also, guys. 2 and 3, please solve. Page number 3.524. Page number 3.524. Come on. Okay, buddies, come on. Where are we? Let's answer. Tax of 1,20,000 was received as gift from non-relatives by Raj on the occasion of marriage of his son. What do you think? All that non-relatives and all covered or not covered? Nothing, not covered. Then you have interest received by SSC on enhanced compensation. If you remember, it was we saw, but we saw in capital gain that 50% standard deduction will be there. So 96,000 into 50%, 48,000 will be income from other sources. Similarly, the third question. On 10/10/23, Govind, the bank employee, received 5 lakh towards interest on enhanced compensation in respect of compulsory acquisition of his land. Out of this interest, 1,50,000 relates to the financial year 16/17, 1,65,000 17/18, 1,85,000 18/19. Whatever you do doesn't matter, it will be chargeable in the year of receipt, irrespective of the financial year. So overall interest is 5 lakh, they'll get 50%, 2,50,000. Clear, guys? Yes or no? All of you? Easy. Do not get confused. It should not be like, oh, that year he received, so compute separately for 17, 18, 18, 19, 19, 20. No, all put together. Next, guys, these two. Let's finish off all the things here. Fourth one. Solve fourth one. 3.5 to 5. These are all important MCQ questions. Please solve, guys. Interesting questions. Solve, solve. Come on. 2-3 minutes. That's it. Do one thing. Fourth and fifth you solve. Fourth. Okay, one by one we'll solve. It's okay. 2 minutes. Take fourth. Question number 4. Come on. 2 minutes. Alright, buddies. So cash gift of 51,000 received from our friend on the occasion of Shastyapta Puja. Whatever that is. A wedding function celebrated on husband completing 60 years. Oh, it's Shashti. Shashtiyapta Purti. Sorry. This was her 25th wedding anniversary. Nice timing they have done. Yes. So on the above occasion, diamond necklace worth, please don't calculate when they got married, 60 minus 25, all that nonsense, don't do. On the above occasion, diamond necklace worth 2 lakhs was presented by her sister living in Dubai. When she celebrated her daughter's wedding on 21 to 24, her friend assigned Mrs. Hema Lee's favor a fixed deposit on the said date, 52,000. So, any sum received by an individual on the occasion of marriage of the individual is exempt. This provision is, however, not applicable to cash gift received during a wedding function celebrated on completion of 60 years. The gift of 51,000 received from a non-relative is therefore chargeable to tax under 56(2)(10). No mercy. Next one, it is from a relative, whether you get it for whatever it is, whether it is a celebration anniversary, it will not be exempt. Definition, it will come. But however, it is received from her sister only. Occasion can be marriage, anniversary, whatever it is. But if it is received from a sister who is your own relative, then no problem. So even though it is property, even though it is not marriage, it is not that you should receive from a relative in a marriage. Relative, if you receive for any occasion, no problem. Third one also, that daughter's marriage, they said it should be your marriage, not your daughter's or son's marriage. Any sum received, etc., will be taxable. But sum of money is not defined. Two possible views. First view is that fixed deposit does not fall within the purview of sum of money. Therefore, it is not attracted. However, another possible view is it will definitely be sum of money. Hence, accessible to IFOS. This is a correct view actually. It should be taxed. Will be attracted. Fixed deposit 1,03,000. 51,000 and 52,000 both will be taxable. Got it? Yes or no, buddies? All of you? Now before we go to ULIP, solve the last question. Question number 5. Let's see. Mr. B transferred 500 shares of R Private Limited to Messrs. B on 10/10/23 for 3 lakh when the fair market value was 5 lakh. Index cost of acquisition of shares for Mr. B was computed at 4,45,000. The transfer was not subjected to securities transaction tax. Determine the income chargeable to tax. Mr. Chezian is employed by a company with taxable salary income of 5 lakh, 1 lakh Atma Charitable Trust. Account pay check for meeting his medical expenses. Is the money received from trust chargeable? Interesting questions. So, any movable property received for inadequate consideration, yes, difference must be taxable. Share for inadequate is chargeable to the extent of full 2 lakh. Because since the consideration is less than the FMB of unquoted shares, FMB only will be the full value of consideration. So full value of consideration 5 lakh is there, less index cost of acquisition 4,45,000 would be result in a long term capital gain of 55,000 in the hands of B. Very, very simple. 210 gift taxation, it will come under this. What doesn't go anywhere will come here. So if any I give money, if any cash a gift is given up to 50,000, no problem. If it is more than 50,000, 56,210A will come. Immovable property without consideration will be under 56,210BA, and inadequate consideration is 56,210B and capital B. Others, movable property without consideration, with consideration. We will see everything one by one. 56,210. So if any gift is given individually or together, all I have to add and I have to make it what? If it is more than 50,000, what to do? Less than 50,000, what to do? Is what we have to see. So if you see here, gift taxation, employer-employee relationship. Money, if any employer gives it to the employee, money, fully taxable. But if gift is given in kind, where a watch is given worth 6,000, 7,000, whatever it is, then that would be fully taxable. Business or profession, we saw there has to be a nexus because of related to work. Nexus, they have given some money, then PGBP will come. So if I have given a gift of my watch to my lawyer or chartered accountant for doing a good job, business connection is a nexus. Other gifts, in case of other gifts, then from 1st April 2017, all gifts are definitely taxed. Gift received by any person is taxed, subject to exceptions. So always taxed in the hands of the recipient or donee. So if you are, when I say other gift, I meant not in the employer-employee relationship and not in business or profession. Like casually, if you get any gift, definitely is taxable, subject to exceptions. But anyway, other gifts will be money, immovable property or movable property. Money, it is what? If aggregate money received is more than 50,000 rupees per annum. So mind you, each friend of yours gives 10,000 each. 6 friends are there. More than 50,000 is happening. Hence what? Taxable or not? Fully taxable. Immovable property will be land, building or both. Land, building or both. There is one is without consideration, one is inadequate consideration. Without consideration, if it is per property, and the stamp duty value is more than 50,000, then it is fully taxable. If it is inadequate consideration, so we'll just see movable first, then we'll come to immovable because movable is slightly easier. Movable property can be anything like shares, securities, jewelry, drawings, archaeological collection, painting, sculpture, work of art, bullion, whatever it is. Without consideration, with consideration. If it is without consideration, if aggregate FMB is more than 50,000 rupees, then it is fully taxable. So shares 20, art 40, jewelry 20, overall 80. Aggregate is more than 50, hence it is fully taxable. Inadequate consideration. If aggregate consideration, that is FMB minus consideration here, is more than 50,000, then difference is taxable. Like shares FMB 1 lakh, selling price 30,000. FMB minus consideration is it greater than 30,000? Yes. 1 lakh minus 30,000 is 70,000 greater than 50,000. Hence, the difference only is taxable. What is difference? 1 lakh minus 30. 70 lakh is taxable. Mind you, here also they have used the word aggregate. So I should keep on adding what all gifts I have got, and all gifts, if it is more, then only it will come. So as I told you here, shares are jewelry, 80,000. Aggregate is 80. So here also they have used the word aggregate. This is for movable property. But for immovable property, mind you, here the word aggregate is not there. Here per property. So immovable property means what? It will be land, building or both. Land, building or both. Without consideration if per property SDV is more than 50,000. If per property SDV is more than 50,000, then fully taxable. Fully taxable. If per property value is more than 50,000, fully taxable. Inadequate one, however, inadequate means what? 10 crore property was sold only for 1 crore. Then, if SDV is greater than 110% of consideration, this we have already seen. If SDV is more than 110% of consideration and SDV minus consideration should be more than 50,000 rupees. Both conditions must be satisfied. SDV must be more than 110% of consideration and SDV minus consideration must be more than 50k. Then the difference will be taxable. The difference will be taxable. So selling price 10 lakh, SDV 10 lakh 60,000. So if you see SDV minus consideration 50,000, that is 60,000 is more than 50,000. And SDV is greater than 110% of consideration. So SDV is 10 lakh 60, greater than 110% of consideration. What is 110% of consideration? What is consideration? 10 lakhs. So 110% will come up to 11 lakhs. So basically SDV is less than 11 lakh because SDV here is 10 lakh, SDV is 10 lakh 60,000. That is less than the consideration 11 lakh. Since both the conditions are not, one condition is not satisfied. Here both should happen or what? Yes. If both conditions are satisfied, only then difference will be taxable. In this case, yes, SDV minus consideration is definitely more than 50k, but SDV is not more than 110% of consideration. So it's very, very less. Hence, SDV is less than 11 lakhs. So no tension. In this case, IFOS will not come. IFOS will come only both the conditions are satisfied. For example, a selling price is 50,000, SDV is 80,000. Difference only is less than 50k. Correct? 80 minus 50, how much? 30k. Difference is 30k. Will IFOS come? No. These are all the cases with respect to IFOS. Then, on the other hand, exceptions. No 56 to 10 in the following cases. On the occasion of marriage. On the occasion of marriage, because that is like life imprisonment is beginning. So the thing is, they say you take whatever you want, no tension. Nirmala aunty says you enjoy. You take however much you want money, I will not tax you. Anyway, full year, full life gone. Yes, that is on the occasion of marriage. Second is what? From a relative. So at least for that fellow being a relative, little bit use he should be. So if any money he makes, gives rather, that is not taxable. Now who is a relative? That same definition which we have seen. Same. Spouse, individual, that is their parents, lineal ascendant, lineal descendant, and all these things. Brother, sister. Their brother, sister, spouse is also covered. Individuals, brother, sister, and their spouse is also covered. Lineal ascendant, descendant, and their spouse is also covered. All these things are covered. Yeah. Then from HUF, right? HUF, for HUF, any member of the HUF is relative. Correct? So for a HUF, any member of HUF is a relative. But for member of HUF, is HUF a relative? No. So member of HUF gifting immovable property to the HUF is exempt. What is not exempt? HUF gifting immovable property to the member of HUF is not exempt. That is what it is. Then we'll see if there's anything else. Right. So instead of 110%, they made it 120% for a residential unit sold during this time only. This is COVID amendment. 12/11/2022, 36/2021. And the consideration maximum should be only 2 CR. The consideration is 2 crore. Then yes, 12/11/2022, 36/2021, whatever you did that transfer, then your threshold will be what? 110. Instead of 110, it will be 120%. First time allotment of residential unit, it should not be any reselling. Similar amendment they made to 56/210 also, same thing. 56/210, you will get a 120% benefit under 43 CA and 56/210. This is for predominantly only for a builder, mind you. It is only for a builder, not for anything else. So this amendment comes only for 43 CA cases, that is PGBP cases. It will not come for, like if you had a house, you are not taking it as stock in trade. You have a house for, as a capital asset. You are selling it during this time. It will not come. For 50C, that is a normal person selling, this benefit will not come. This will only come for 43 CA cases. And 43 CA is what? It is only for PGBP cases. Only for PGBP cases. Next concept is dividend. So this is all. That's all there is to it here. In this, nothing great. Yeah. Only thing is, let's see gift taxation how it works first before going to dividend. Gift taxation on example we'll take. So Miss Sita, this is combination of capital gain and gift. Miss Sita sells her house on 14/11/2021 to Mr. Kunal. Cost of acquisition for Geeta was 4 lakhs and she had acquired it in previous year 1-2. Mr. Kunal, now selling price is 40 lakhs, SDV is 45 lakhs. So Miss Sita has sold it to Mr. Kunal, selling price 40 lakhs and SDV is 45 lakhs. Sells it on 14/11/21. What is the cost of acquisition? 4 lakh. Acquired in which year? Previous year 1-2. Mr. Kunal now sells it to Mr. Adi. Mr. Kunal sells it to Miss Adi. Mr. Adi. Selling price is how much? 84 lakh. Selling price 84 lakh. When does the sale happen? 12/3/2022. 12/3/2022. Now, capital gains in the hands of Miss Sita. Capital gains in the hands of Miss Sita. Full value of consideration is 45 lakh. Why? 110% of selling price is 40 lakhs. How much did I sell it for? 40. So his selling price and 110% of consideration comes to 44. So selling price is definitely, what do you say, less than 110% of consideration. So what will be the FPOC? FPOC will be the SDV. What is SDV? 45 lakhs. Minus index cost of acquisition. How much? 4 lakh into obviously 317. It's sold in, let's say, 14/11/21. So for 21/22 it was 317. 317 divided by 100. So overall it's how much? 12,68,000. So what is the LTCG? 32,32,000 will be the LTCG. Period of holding was from 1-2 to 14/11/21. That's done. Next. Kunal now sells it to Mr. Adi. Now, this was sale. But you see, gift taxation. So in the hands of Mr. Kunal. How much did he purchase it for? 40 lakh. But how much was the SDV? 45 lakh. Right? So as per 56.210, what is the dialogue? Is it an immovable property sell? Yes. Is it, what do you say? Uh, the difference, is it more than 50,000? Yes. 45 minus 40. Next, is the SDV greater than 110% of selling price? You see, first one, 45 lakh minus 40, 5 lakh. 5 lakh is more than 50,000, condition 1 satisfied. Second one, is SDV greater than 110% of selling price? Yes, selling price is 40, 110% is 44 lakh. SDV 45 lakh is greater than 44 lakh. Hence, under gift taxation, difference is taxable. So, here Kunal also has to pay on 5 lakh. If you see, Sita also has paid on 45 lakh instead of 40. Kunal also is paying on 5 lakh. So can I say gift taxation leads to double taxation? Yes. Gift taxation definitely leads to double taxation, no doubt about it. So anyway, so in that year, how much should this guy Kunal pay? 45 lakh minus 40 lakh. On 5 lakh he has to pay. Now, Kunal sells it to Mr. Adi for 84 lakhs. Kunal sells it to Adi. Gift taxation in the hands of Mr. Kunal, capital gains in the hands of Mr. Kunal. So, what is the full value of consideration? 84 lakh. Minus cost of acquisition. What is the cost of acquisition? Since I've already paid tax on 45 lakh, I can take my cost as 45 lakh. Short-term capital gain, 39 lakh. Why is it short-term capital gain? Because the period of holding is only from 14/11/21 to 12/3/22. So short-term capital gain is 39 lakh. In the same example, instead of this, if Sita had gifted the property to Mr. Kunal, if Miss Sita had gifted the property to Mr. Kunal, what would happen then? Then capital gains in the hands of Miss Sita, it is not a transfer. It is not a transfer under section 47. No capital gains for Miss Sita. But this Mr. Kunal is taking the gift, right? As per 56.210, is he getting for free? Yes. Is it more than 50,000? Yes. Is he a relative? No. So full 45 lakhs is taxable. Other things remain the same. But you see, gift taxes in the hands of Mr. Kunal, capital gains in the hands of Mr. Kunal, 84 lakh minus 45 lakh, 39 lakh. However, if Miss Sita and Mr. Kunal were relatives, then 56.210 also is not applicable. Then cost of acquisition will be the previous owner will be considered. Period of holding also of the previous owner will be considered. So capital gains in the hands of Miss Sita won't come. Capital gains in the hands of Mr. Kunal will be what? Full value of consideration 84 lakh minus index cost of acquisition 4 lakh into 317 by 100. 12 lakh 68,000. So what is the long term capital gain? 71 lakh 32,000. Correct? That was that. 71 lakh 32,000. Done, guys. So next, what is there? This 120% visa only for builders, mind you, only for builders, nobody else. Online people, are you there? Yes. So all this. Now comes the dividend portion. Dividend. So let's see. Dividend is what? Return on investment. Dividend is return on investment. You have two types of dividend. One is interim dividend, one more is final dividend. Interim dividend recommended and declared by board of directors under 123(3). Final dividend recommended by board, declared by shareholders. So all that is fine. Dividend taxation. Earlier, dividend paid. There was something called corporate dividend tax to be paid by the companies under 1150. Since they already would have paid tax, that amount was fully exempt for whom? For shareholders under 1034. So for shareholders it was exempt, but for companies corporate dividend tax was paid. But then a few years ago they changed the law whereby for companies anyway it's like an appropriation, and who should pay the tax? Shareholders. So since shareholders were not interested in paying tax, the company started giving them dividend in other forms like distribution of assets. So since that was cheating, the government decided to tax that also under the concept of deemed dividend under 222. 222 will start from A, B, C, D, E and all these things. So what does the law say here? Any domestic company distributes all or any part of the assets of the company to its shareholders to the extent of accumulated profits, whether it is capitalized or not, it shall be taxable as dividend in the hands of the shareholders. If any domestic company distributes all or any of the part of the assets to its shareholders to the extent of only what? Accumulated profits. Because obviously can only give you assets worth of accumulated profits. Other things will be in the capital anyway. Whether capitalized or not, means whether you take it as bonus or not bonus, I don't care, shall be taxable as dividend in the hands of the shareholders. It may be noted that accumulated profits are distributed to the shareholder in the form of cash. Equivalent sum shall be deemed to be the dividend in the hands of the shareholder. On the other hand, if it is done in kind, then FMB of the asset shall be deemed to be the dividend in the hands of the shareholder. Accumulated profits of the company are 14 lakh. Book value of asset 8 lakh, FMB 16 lakh, deemed dividend will be to the extent of accumulated profit only 14 lakh. Why? Because only to the extent of accumulated profit. FMB, even though if it is higher, I don't care. Next, book value is 8 lakh, FMB is 11 lakh. Deemed dividend also to the extent of accumulated profit or FMB, whichever is less. So your FMB only is less. FMB will be deemed dividend. Here both are 14. So obviously I should take it at 14 lakhs only. It's 222A. 222B is what? Distribution not entailing the reserves of assets, but I will give him what? Debenture stock certificate, preference shares and all those things. To preference shareholders, I will give bonus shares, which generally is not given to them. I will give it to them like that indirectly. Or to shareholders, I will give debentures, debenture stock, deposit certificate, etc. So there also same thing, to the extent of accumulated profits, capitalized or not, deemed dividend. 222C, in case of liquidation, company going for liquidation, it shall be treated as deemed dividend in the hands of the shareholder to the extent of accumulated profits immediately before its liquidation, whether capitalized or not. That is 222C. So here it was distribution in case of liquidation. Any distribution, let's say, that is cash, assets or cash plus assets, only given to whom? Equity shareholders. As on which date I should see? On the date of commencement of liquidation is what I need to check. So if the company on liquidation is distributing assets, under 46(1), there is no tax for the company because it is not a transfer, no capital gain for the company. But for the people who is receiving, what will come? 222C. Shareholder will have to take cash. If it's assets being distributed, because if you see here, if a distribution of assets is made, If only assets is made, 222C will come. If it is cash, etc., then same section 46(2). Number will change, but the concept remains the same. That is what it is. In more in depth, you have seen in regular batch that you leave. 222D is what? Reduction of capital. Any distribution by a domestic company to its shareholders on account of reduction of share capital to the extent of accumulated profits of the company, whether capitalized or not, shall be taxable in the hands of shareholders as deemed dividend. This is reduction of share capital. When I am reducing the share capital because of internal reconstruction, any distribution of assets that I make, that also will be deemed to be dividend. That is also deemed to be dividend. 222D. So if I give anything, any distribution in case of internal reconstruction, so every single money will be taxed in the hands of the shareholder undoubtedly. So 222A was asset, 222B was debenture for others and bonus for preference shareholders. 222C was liquidation, any asset. Because if it was cash, it is under 46(1) and 46(2). 222D is again any asset in the form of what? Reduction of share capital. But 222E is slightly different. In 222E, under section 185 of Companies Act, company cannot give loan to director. Similarly, in 186, apart from director to others can it give? Yes, but we need certain permissions. So in 222E, what happens? Any payment to the extent of accumulated profits by a closely held company in the nature of any loan or advance to a shareholder. So one is loans to directors. Then what if I give loan to shareholder? Some shareholder is there who happens to be the director's relative. If I directly give loan to director not allowed, so what will I give? I will give it to the relative. If those things are happening, then it is also deemed dividend. Deemed dividend. So anything. And moreover, you should have substantial interest. So first of all, closely held company should be giving loan or advance to the shareholder, 222E will come. Or it is giving to a concern in which the shareholder has substantial interest. What is substantial interest? 20%. And what is this concern? Firm, HUF, AOP, BOI company, whatever. And the closely held company is giving what? Loan or advance to this particular concern. It is also deemed dividend. So all these things will be called as deemed dividend. So if a closely held company is in the business of lending, then no problem. If the closely held company is not in the business of lending, still it will give it as loan to its shareholder, then deemed dividend will come under 222E. Then as far as buyback of shares is concerned, in the hands of the company, in the hands of the shareholder, mind you, buyback 1034A, no tax treatment. Under 1034A, no tax treatment. But in the hands of the company, 115 QA will come. That is buyback price minus issue price. Buyback price minus issue price. Tax paid at what rate? 23.296%. 23.296% is the tax that is paid, or 20% tax plus 12% surcharge plus 4% cess. When? Within 14 days from the date of buyback. Within 14 days from the date of buyback, what you need to do? You need to pay this. So gift done, dividend done. So even mutual, any return from UTI mutual funds is also taxable. Income of member of parliament, MLA, MLC. Salary will be under IFOS. Daily allowance or constituency allowance is exempt under 1017. Any awards you receive from government like Bharat Ratna, Padma Bhushan, Khel Ratna, exempt under 1017A. Other awards taxable under IFOS. Winning from lottery, crossword puzzle, general game shows, horse race, IFOS. Tax rate 30%. Agricultural income from land in India, exempt under 10(1). From land outside India, IFOS. Rental income from house property, income from house property. Rent of asset other than house property, if I am renting you two-wheeler, etc., IFOS. Composite rent, that is agreement is not separable, composite, then it also IFOS. Subletting is also IFOS. Royalty on books, if I am getting, that is also IFOS. Director, we saw remuneration, if he is employed plus salary, if he is getting, and consultancy, etc., PGBP. Sitting fee for board meetings, it is IFOS. And if you are an ICAI invigilator, paper setter, evaluator, etc., IFOS. If you are a paper setter for school, then you will be just be employed. CMA insurance policy received by employer, PGBP. Amount received by employee, salary. Amount received by any other person, chairman emeritus, IFOS, it will be IFOS. Maturity amount of life insurance policy, which is exempt under 10(10)(d), generally except maturity amount received by key managerial personnel, that we have seen. Family pension is taxable to the extent of 1/3 of family pension or 15,000 rupees per annum, whichever is less. This is also done. Any gallantry award also again will be generally exempt, but interest received from gold bonds 1999, gold monetization scheme 2015, and PPF, etc., fully exempt. Interest on late compensation on compulsory acquisition of property, we have seen that taxable interest is 50%, will be taxable. Any other interest is taxable. Post office savings account, exempt up to 3,500 rupees per annum. Joint account, 7,000 rupees per annum. Advance forfeited on or after 1/4/2014, we have seen as per 5629, taxable. Compensation received on termination or modification of employment from non-employer organization, that is also what taxable under this. That is also taxable. Then under 57, allowability of expenditure. How much is allowed? Rent, when I am earning something, expense, is it fully allowed? Yes. For example, rent paid is 60,000, subletting is 70,000. So 60,000 rent paid allowed? Yes. So what is your income from other sources? 10,000. Exempt income. For exempt income like agricultural income, expenses will not be allowed. For winnings from lottery, etc., expenses will not be allowed. Interest from late compensation that you are getting, 50% is allowed. Dividend income from UTI, income from mutual funds, etc., only interest, and that too up to 20% of dividend income. This is if I have taken a loan to invest in share capital. If I have taken a loan to invest in shares of some company, whatever dividend I will get, can I subtract the interest on loan that I am paying? It says only interest expenditure, and that too up to 20% of the dividend income or income from mutual fund UTI will be exempt, will be taken as a deduction. That's, for example, if loan is 1 crore, interest at 15%, what is the interest per annum? 15 lakh. Dividend income is 12 lakhs. 20% of 20% of dividend, 20% of 12 lakh, 2.4 lakh. So I can claim only 2.4 lakh. IFOS will be 12 lakh minus 2.4 lakh, 9.6 lakh. Following expenses will never be allowed: personal expenditure, interest, salary paid outside India on which TDS is not deducted or deducted but not paid. Any expenditure paid to resident person, if TDS is not deducted, then 30% is disallowed. Cash expenditure of more than 10,000 a single day to a person. Again, what the expenses are not allowed, we have seen. Expenditure related to casual income, that is winnings, not allowed. 40A2, that is relative, that is also not allowed. Excessive expenditure is not allowed. That's all. That is about IFOS. Very, very simple. Let us begin the session number 4, and we'll wind up today by finishing off income from salaries, and TDS also will do. Let's see. So online people, can you hear me? All good? Cool. So let's begin, guys. Income from salary. Again, income from salary is very, very important chapter. 100% you will get questions from this area, undoubtedly. So if I just browse through the syllabus, house property we have done fully, and of course quite exhaustively. PGBP also exhaustive discussion we have done. capital gains and other sources also, whatever. Capital gains we did very much in depth. In other sources, whatever important things, almost everything we covered actually. Clubbing of income is very simple. Set off, all these are very easy topics. Chapter 6A, all that. Will not have the time to do all those things. But of course, TDS is again very important. So we need to do. Definitely around 4-5 marks will come either in MCQ or normal stuff. Then your return on income, all these are very easy, guys. Chiller stuff, you can do it on your own. Not, my help is not so much needed here. But of course, again, income from salary is quite important. Apart from that, residential status also we finished. All the main areas except the income deemed to occur in India. Apart from that, we did the full residential status as well. So after all, you take all the 5 heads and then other masala items, then you will get what? The computation of total income. That is the final thing. Good. So let's begin income from salaries. So let's go to that area. Yes, so section 15 talks about income from salaries. So there are two things. One is contract of service, one more is contract for service. So contract of service is employment and contract for service will be consultancy, that is PGBP. So whenever I use the word contract for service, it is all about PGBP. Contract of service on the other hand is contract of employment. So this is the employer-employee relationship has to be there always, undoubtedly. If anything that is earned by MLA, MLC, MP, all these things will come under income from other sources. Salary, if you forego, sacrifice the salary also, that is also taxable. It's so stupid, but it is so. But if you surrender it to the central government, then only it is not taxable. So your salary is 1 lakh per month, but you'll say, no, don't pay me. Then that also, though it is not paid to you, still you have to pay tax on that. However, if you surrender it to the entire central, to the money to the central government, then only it's not taxable because they have already got that money. So forget about the 30% tax on it. They want the entire salary for themselves. So obviously they will not tax that. Then there are something called profit in lieu of salary. That is, instead of salary, they'll give other benefits, etc. Everything will be taxable for sure. So basically, the salary, you have many things that you need to study one by one. That is your basic salary, dearness allowance, bonus, commission, advance salary, so many things. One by one, we'll see. So what do you mean by basic? Basic is the normal basic salary that you get. So basically, that is a component which they only derive. So they every company will have that this will be the basic, this will be the other allowances, this will be the other perquisites, etc. So one by one, DA, dearness allowance, will be fully taxable, undoubtedly fully taxable. Now DA, there are two things. One, they'll say DA in terms, DA not in terms. Dearness allowance, the word dearness means, dear means something which is going high. So for example, in economics, you use the word dear. So if the cost is getting cheaper, opposite of cheaper is cost is getting dearer. So honestly speaking, dearness allowance is to beat inflation. It's not any other dear that we know, right? So it is dearness allowance. So fully taxable it is. It's just a component to beat the rising prices. That's it. It is obviously fully taxable. But if it is in terms, means it will come under retirement benefit. That's why it's called in terms. So if it is in terms, it will be part of the entire retirement benefit calculation. If it is not in terms, it will not be used in any calculation. So in the exam, you need to see whether they have given in terms or not in terms. That's what it is. They would have given in the exam, so no problem. So fully taxable, that is 30,000. In that 18,000 is let's say in terms, 12,000 is not in terms. 18,000 is used for computing the retirement benefits like PF and all those things. Anyway, so those are all the various things that we'll have to see, bonus and all that. Then if you see, See the different form of salary, all this we have done, meaning of salary. These things, salary, allowances, perquisite, gross salary, deduction under section 16, and then income from salary will be the income from salary. Dearness allowance, as we have discussed already. Okay, if nothing is specified about the dearness allowance, what will you assume? That TA will not form of part of retirement benefits, you can assume in the exam. So bonus is what? It is taxable only in the year of receipt. If bonus is declared, it is to be ignored. It is only on receipt basis, not on declaration basis. Commission, it can either be given as a fixed amount or it can be given as a percentage of turnover. You need to see. That's all. If they have given only percentage, then please apply it on the turnover. Advance salary, that is taxable in the year of receipt, because you are receiving it first, you need to tax it. Arrears of salary also definitely taxable in the year of receipt, if not taxed earlier on due basis. So definitely that also will be taxable only in the year of receipt. Retirement benefits will be what? All these things. You have gratuity, we have pension, we have leave encashment, we have voluntary retirement service, we have retrenchment compensation, you have provident fund, and all these areas. Now, gratuity. Gratuity means what? As the name suggests, gratuity is from the word gratitude, means to say thanks to the employee. So that employee would have worked full time in the company for so long. So to thank that person, we have this concept of gratuity. So gratuity, there are two types. Gratuity received during the employment. Nobody will give gratuity during the employment. So if at all you get during the employment, it is obviously fully taxable. Whether you are a government employee or not a government employee, fully taxable. On the other hand, if it is received at the time of retirement, towards the end, then we have to see whether you are a government employee or other employees. Why do people always, keep telling, join a government job, It's because of this. You'll get all these retirement benefits which are exempt, fully exempt from tax. Government employee, fully exempt under 1010. Other employee, there are two things. One is if you are a POGA employee. POGA means what? Payment of Gratuity Act, which means for you payment of gratuity will apply. Act will apply. One more is payment of gratuity act will not apply. Then what part is exempt? Then this formula is there. 15 by 26 into this is as per payment of gratuity act anyway. 15 by 26. This is like roughly half a month. 26 is working days in a month, or Sunday you exclude. So 15 by 26 is like 15 working days, half a month of working month, into salary per month into number of completed years of service. It's like, actually, to be honest with you, half month salary into number of years that you worked. I'll give you gratitude. This part is exempt. Or actual amount that you have received, or 20 lakhs, whichever is lower. So if you have worked for 40 years at a salary of, let's say 40,000 rupees per month, half salary will be 20,000. 20,000 into 40 years. How much? It's actually whichever is lower is what you will get, right? And the salary per month, monthly salary you should see into number of completed years of service. Then actual amount received, or 20 lakh, whichever is lower. So sometimes you may get 25 lakhs also, but ultimately you should decide whichever is lower. That's how it is. That is the payment of gratuity employee, whichever is lower. Now, what do you mean by salary here? It says salary. Will I take all the salary? No. So here, latest basic salary I should take. Latest means about when time of retirement, whatever you are earning, that salary you should take. And dearness allowance, whether it is in terms or not in terms, everything will come under this, because I am talking about gratuity. So salary per month, this will come. Non-POGA employee, on the other hand, if you are a non-POGA employee, payment of gratuity act will not apply to you. So instead of 15 by 26, they have directly used the word half. It's almost the same only. Half into, there it was salary per month. Here it is what? Average salary per month. Average salary per month into completed years of service. Into number of completed years of service. Second, actual amount received. Third one, 20 lakh, whichever is lower. Whichever is lower. So average salary is what? Average salary of last 10 months. Average salary of last 10 months is what you need to take. Average dearness allowance in terms of the last 10 months. First is average basic salary of last 10 months. Second, average dearness allowance, which are in terms, mind you, of the last 10 months. Then average commission of the last 10 months. Average commission of the last 10 months. So as I told you, commission again will be part of the turnover. percentage of turnover of the last 10 months. So here it is 10 months. That is the average salary. In POGA employee, it is latest basic salary. At the time of retirement, what he was earning. Here it is average basic salary of the last 10 months. How will I compute average? I will take the full whatever basic salary average of the last 10 months. Then I will take the DA of the last 10 months. Then I will take commission of last 10 months. Divide by 10, everything. Only then I will get average salary per month. So, and here, interesting to know, I should exclude the month of retirement. So if I am retiring in October I should exclude. I should take 10 months prior to that. Yes, half into average salary per month into number of completed years of service, actual amount received or 20 lakh, whichever is lower. And here it is what, 15 by 26 into salary per month into number of completed years of service, actual amount received or 20 lakh, whichever is lower. Yes, and you should round off the year. How will you round off the year? In case of POGA, this is what? Number of completed years of service. No, what if I have completed 35 years, 4 months? So will I take it as 36 or will I take it as 35 is the question. So interesting to know, in case of POGA, fraction which is more than 6 months should be rounded off to the next year, and less than or equal to 6 months will be previous year. Fraction more than 6 months will be rounded off to the next year, less than or equal to 6 months will be previous year. Means 35 years 4 months will be deemed to be 35 years. 35 years 7 months will be 36 years. This is for POGA employee. Non-POGA employee, whatever fraction, fully ignore. Means even if I have worked for 35 years 11 months, unfortunately you should take it as 35 years. This is one of the benefits of being in Payment of Gratuity Act. You will get that extra benefit. The salary is more of memory chapter, but very, very important chapter. So just follow this structure. Definitely you will understand everything. So unfortunately, it's like, why is it 15 by 26? Why not 16 by 27 and all? We don't know. Right? Actually, I genuinely tried. All those books you see there, I've read everything. In that books, I've seen why they have given like that. These are all commentary by amazing authors. It's a very, very good set of books. Right? So the thing is, there I tried searching. I wanted to know the logic, because if any student asks, I cannot say I don't know. But this genuinely I don't know, because I've searched everywhere. Nowhere they have told the logic of why 15 by 26. Then I only tried to figure out. 5 days Sunday they would have taken and whatever, and 15. They wanted to take half a month, half working month. But that logic, nowhere it's given. Even in the commentary, generally every word they have given the history of every word. So all these other things that I told you is all from that book only actually. So that is my job, to condense everything and make it into a structured format. That is my job. Your job is to remember. But this logic I genuinely tried. Couldn't find anywhere, to be honest. So you need to, of course, but basically they are trying to, the basis was what, the basis is given there. The basis what they were trying to tell was at least like half month salary into whatever number of years you completed, you should take it into account. And also, since you are POGA, I will give you this benefit. If it's more than 6 months, I will round it off to the next year, is what they have told. So apart from this, these two are the same, only the first item changes. So in the exam, they will give you whether it's POGA employee, non-POGA employee, all the things they will only give. So rounding off, yes. So for example, 24 years 8 months in POGA will be 25, in non-POGA 24. 24 year 3 months in POGA and non-POGA 24. 24 year 6 months, since it's not more than 6, POGA it is 24, non-POGA anywhere it is 24. Right, so that is what it is. Very simple. That is regarding gratuity. Next, going on to pension. Pension is of two types: uncommuted pension. Second one is commuted pension. Uncommuted pension, then commuted pension. Uncommuted pension means what? Commutation means where I can take a lump sum amount. So if you are an employee, you can say 50% I want lump sum, remaining 50% I want monthly. No problem. So I'll ask you, if I want to do 100% withdrawal, how much it will be? They'll say 1 crore. I'll say, no, I don't want 1 crore. Give me 50%. 50 lakhs you give me now. Remaining 50 lakhs spread across till I die. Yes. Government employees, after the death also, the family will get the pension, reduced pension. That's why people die for government jobs. So uncommuted pension, monthly. Taxable for all employees, government and non-government. But then in government employees will not earn much in terms of salary, etc. But they'll mint money through bribes anyway. So uncommuted pension, monthly pension, that is taxable for all employees, government and non-government. Commuted pension is what? So uncommuted pension, whatever you're getting monthly, whether government employee, non-government employee, it is fully taxable. It's like normal. Commuted pension, lump sum payment. I remember for my dad, we did the calculation when he was 60 years. We commuted, I think, 60% because that fully exempt. He was a government employee. But now he's getting, I think, some 1.5 lakhs every month. That is uncommuted. Should he pay tax on that? Yes. Uncommuted pension, monthly, taxable for all employees. Commuted pension, lump sum, exempt under 1010A. Government employee, fully exempt. Non-government employee, if the gratuity is received, what to do? Gratuity is not received, what to do? If the gratuity is received, then total pension into 1/3. Total pension into 1/3 will be what? The exempt portion. If gratuity, why? Because if gratuity is not received, then it is half. Why? Because since gratuity is already received, already benefit has taken there. So here I'll give less benefit. What is the less benefit? Total pension into 1/3. If gratuity is not received, then total pension into 1/2. The total pension is full value of pension. That is amount received divided with percentage of commutation. So that's basically I have to make the full value of pension here. Whenever I say total pension, full value of pension. So they'll say the amount received was whatever it is, and this percentage was commuted. So if the amount received is 30% of commutation, what is 100%? So you should cross up. That's all. If they say 1 lakh rupees I've received, that is 20% of the entire pension. I should do for 100%. How much? So 1 lakh divided by 0.2. That is what I should do. Totally 5 lakhs it will come. 5 lakh will be my total pension. Very simple. So that is regarding pension. So pension, always note, uncommuted pension, it is always taxable for all the employees. Only commuted pension, it is taxable to only few, it is exempt under 1010A for government employees, and for non-government, I should see whether you have received gratuity or not received gratuity. Next concept is leave salary. Leave salary is encashment of unutilized leave. In every company, you will get at least around 20-25 days off in a year, apart from your other leaves. That other leaves is your holidays and all those things. That is anyway 20-25 days. Apart from that, you can also take casual leave 20 days, sick leave 10 days, like that. Depends from company to company. Saturday, Sunday anyway will not be working. So roughly will be working around maybe perhaps in that weekends only you remove, 100 days will go there only, because Saturday, Sunday generally people don't work. So 52 weeks, 100 days gone there only. So 250 days plus 30-40 days more you will get. So sometimes you just work 200 days, 220 days, etc. So yes, when you join an audit firm or when you join a Big Four which is only into audit profession, that is your assurance team, then Saturday, Sunday there will be no days. Every day is audit day, right? That's the problem. So you will tend to think that I studied so much for what? To die in the office, right? That's the feeling that you will get. But if you are into tax also, you will be working full out, but our entire life is working only, guys. Think about it. So it is all working and earning for something which we can't even spend. It's the best part. And still you are doing CA. God bless you. Yes. But it's good because you'll get that freedom to do whatever the hell you want. That is the best part of doing this CA. Definitely. So encashment of unutilized leave, not the CA. Whatever you do, it's all about working on, think about it. Yes. Encashment of unutilized leave. So received during the employment, taxable for all employees. Encashment of unutilized leave received during the employment, it is taxable for all employees. Now this is, some fellows, if they don't take that leave, workaholics will be there. Their entire life will be only working. So there was in L&T one guy, mental fellow, 35 years he worked, one leave also hasn't taken. So he had accumulated leave of some like 200 days or something. So he got something in crores of money, right? But, man, good for him, because for him he is just a workaholic. He just wanted to work and nothing else. Of course, he reached that level, no? He became like director of L&T and all that. Anyway, so received during the employment, it is taxable for all employees, but generally you will get at the end of the retirement, at the time of retirement. Government employee, you see again, fully exempt. Most of them during work also they will not work anyway. So, but leave also they will not take. Yes. So, it is fully exempt. Other employees now, least of the following is exempt. Least of the following. So, what is that? Leave credit in terms of months. What is leave credit? Leave allowed minus leave taken. So, if leave allowed is 30 days for every year, what is the leave taken? 20 days. So, what is the credit that you are getting? 10 days. If some companies actually have leave credit 40 days also, I cannot take 40 minus 20. I should take 30 only. Because it depends from company to company, leave allowed. So, Income Tax Act says maximum 30 days. If in your company only 20 days is allowed, then 20. But in your company 40 days is allowed, no, don't take 40, only 30. So, that's why maximum 30 days for every completed year minus leave taken. So, that will be your credit. If leave taken is 0, full 30 days credit you will get. So, leave credit into average salary per month. So, average salary per month means what? Same as gratuity, non-POGA. Average basic last 10 months, average DA terms last 10 months, average turnover commission last 10 months. If they have given any other commission, should not take in calculation. It should only be turnover commission. The previous one also, here also, same. It is as gratuity, non-POGA case. So, what is the average salary? 10 months into average salary per month, actual amount received, or there it was 20 lakh, no, in gratuity, here it is 3 lakh. But here it is 10 months into average salary per month. Average salary is the same calculation. So, I should do 4 items. One is leave credit, that is the 30 days into average salary per month. And then 10 months into average salary per month. And actual amount received and maximum amount 3 lakh rupees. This is the portion of leave salary. So, anything they can ask you guys, that is the problem. Anything, you have to be ready with each and everything. Next, and apart from that, you will also get some other funds. Here we will see pension done, leave salary done. Provident fund, you see. Before that, one more. Leave salary done. Retrenchment compensation. Retrenchment compensation means what? Retrenchment means where they will ask you to leave. Retrenchment means where they'll ask you to leave. Basically, retrenchment is like retirement only, forced retirement. For forced retirement, I'll give you some compensation. If it is scheme of central government, exempt. Other cases, lower of 5 lakh or actual amount received, or as per the Industrial Disputes Act 1947, whichever is lower you will get. Compensation as per Industrial Disputes Act also same guys, you see, like POGA 15/26 into average salary of last 3 months into number of completed years of service. Same it is. And VRS also we will see little later, no problem. Provident fund. Provident fund, there are 2 types. PPF, Public Provident Fund. Then EPF, Employer Provident Fund. It's a public provident fund, that is PPF. No need of employer-employee relationship. Even you and I can invest in in the public provident fund. There's no need of employer-employee relationship. But if it is employer-employee relationship is there, that is called EPF, Employer Provident Fund. So in that there are 3 things: SPF, Statutory Provident Fund; RPF, Recognized Provident Fund; and URPF, Unrecognized Provident Fund. Statutory Provident Fund is set up under the PF Act 1925. RPF, Recognized Provident Fund, is set up under EPF Act 1925 or recognized by Commissioner of Income Tax. URPF, Unrecognized Provident Fund, is neither Statutory Provident Fund nor Recognized Provident Fund. Generally, if contribution made to Unrecognized Provident Fund also in PGBP, it is what? It is not allowed, disallowed, because anything which is unrecognized cannot be taken into account. These 2 will be taken into account. Statutory Provident Fund. Now, Statutory Provident Fund is only applicable to whom? Government employees, semi-government institutions, local authority, university, etc. Employer contribution, fully exempt. So, in a Statutory Provident Fund or Recognized Provident Fund, 2 people will contribute. One, employer, one employee. Employer's contribution, fully exempt. Employee's contribution, it is taxable but eligible for deduction under 80C. And the interest also that you are getting out of this contribution will be exempt. And towards the end, whenever you retire, they will recover that money from you, from that fund, and pay you. All these years you have been deducting and paying to the government, to the fund, and that fund money, whatever investment, etc., everything will be given to you. That is fully exempt for government employee. This is one of the reasons why government employees always say, people always say join government service, because all these extra benefits you will be getting, which you will not get in normal private companies. Next is RPF, Recognized Provident Fund. So Recognized Provident Fund is recognized by whom? By the principal, commissioner or chief commissioner, principal commissioner, or in all those things. They will be under this scheme provided. Now here, what is the general rule? Employer's contribution up to 12% of salary is exempt for the employee. When I say exempt, for whom? Obviously for the employee, right? Up to 12% of his salary. If it is more than 12%, then it will be taxable for the employee. Why? Because up to 12%, the government will say, okay, no problem. But the moment you pay more than 12% from your pocket, employer pays from his pocket more than 12%, then it will now be taxed in the hands of the employee. As what? This will be more like a extra benefit. So it will be taxable. Employee contribution. So basically, if 1 lakh is the salary, 10,000 rupees assume employer is paying on his own extra. 10,000 rupees they are deducting from employee. So 1 lakh minus 10,000, 90,000 goes to employee. Minus, of course, TDS and all that you leave. 90,000 is the amount minus TDS. TDS also deduct, no? So anyway, but this 10,000 is 10%, so no problem. This 10,000 is also no problem. Now the question to the employee is, employee in his account, in his tax return will show full 1 lakh, obviously. And then on that he will compute tax, definitely yes. But in that he has already paid 10,000 to, he would have paid some tax that he will reduce, no problem. But he would have paid this 10,000 to the PF authority. So for that also, if you pay time, if you say that tax is there, then it's a problem. That is why there's a deduction available under 80C, tax deduction. Any employee contribution, it is taxable definitely, but eligible for deduction. So what will you do? 1 lakh you add to the full salary, which is taxable, then subtract 10,000, which is 80C. Employer's contribution up to 12% of salary exempt, any excess taxable. Employee's contribution taxable but eligible for deduction under section 80C. Then you will get interest on provident fund. When you get interest up to 9.5% per annum, it is exempt. Anything which is excess will be taxable. Anything excess will be taxable. Any lump sum amount that you finally receive in the end, lump sum amount, is exempt under 1011 if the 4 conditions are satisfied. Condition number 1, employee should have left the job only after 5 years of service. Less than 5 years if you leave, and if you take out the PF, what will happen? Taxable. Second, employee has left the job before completing 5 years only, either due to his ill health or the company, the business only closed down. So obviously you cannot penalize me. So first condition, second condition, third condition, fourth one. Let's say you joined somewhere else, no problem. From this PF account, you should transfer to that new company's PF account. Then it's okay. So balance in the RPF is transferred to new employer, and period with the old employer plus new employer should be more than 5 years. Then it's okay, no problem. Yes, Chinmay, under 115 BAC, you will not get ATG, ATC and all those things. Correct. Then, exemption allowed if conditions are not satisfied. If conditions are not satisfied, then exemption allowed earlier will be withdrawn. So, that interest on employees' contribution towards SPF, etc. Earlier, there used to be exemption for interest also, but now it will not be available in respect of income by way of interest accrued during the previous year to the extent it relates to the amount of contributions made by an employee exceeding 2,50,000 in any previous year on or after 1/4/2021. So this is for what? Interest portion on employees' contribution. Earlier it used to be exempt here, as I told you. Now it is not exempt. It's an amendment. So they say if the contribution, so basically here PF account, taxable contribution amount, non-taxable contribution amount. What is the non-taxable contribution? Accumulated balance as on 31/3/21. It is grandfathered. I will not touch that. So interest accrued on A and B above, that is employer's contribution, employee's contribution, everything will not be, no tax on that. But contribution made by C in the account during previous year and subsequent previous year in excess of 2,50,000. In excess of 2,50,000, interest accrued on A above will be definitely taxed. Be taxed. Now this is assuming employer also contributed. What is employer hasn't contributed? Can you see here? Contribution by such employee is in a fund when there is no employer contribution, then a higher limit of 5 lakh will be applicable. So if the employer doesn't contribute only, then how much will you get? Up to 5 lakh, no tax. This is interest on 5 lakh, mind you. Interest beyond 5 lakh will be taxing. This is the interest on the contribution amount. Which contribution? Employee contribution. This interest is what? This interest is interest on the entire PF account. This will include both employer and employee contribution. So there it is up to 5.9.5% exempt. Beyond that, taxable. Unrecognized provident fund, as I told you, is definitely employer's contribution is exempt. Employee's contribution. Why is employer's contribution exempt for the employee? Because for the, when I say exempt, it is for whom? Exempt for the employee. Why? Because unrecognized provident fund for the employer will be disallowed under section 40. There's a section called 40A7, 40A9 and all these things. If you give it to, this is not there for you actually, it's more for CA final. In those sections, only basics is given for you, but in CA final, full in-depth is there. So what I'm trying to tell is, if an employer deposits money to unrecognized provident fund, government says disallowed. Disallowed means what? Add back to the profit, which means who has to pay tax? Employer has to pay tax. When employer has already paid tax, for employee it is exempt. That's why fully exempt. Employee's contribution, fully taxable, no deduction. No deduction under ATC also, nothing. Interest, okay, I'll exempt you, no problem. But what will be taxed? Deadly. Lump sum amount received on retirement. Employer's contribution, imagine whatever the employer had contributed, fully taxable for you. Interest on employer's contribution, fully taxable. Actually, guys, there is double taxation here. First taxation, employer would have paid. Then after retirement, double taxation, employee will pay. That's why nobody will go for unrecognized. This is actually to discourage people from investing in unrecognized provident fund. Because in unrecognized provident fund, you can invest in wherever you want, equity shares, all high risk investments. But in recognized provident fund, there are rules by the PF authority. You should invest only in risk-free investments because it is the hard-earned money of the employee. On the other hand, the lump sum that you receive on employee's contribution is not taxable. Why? Because employee has already paid before. Interest on employee's contribution. That is also taxable under IFOS. So if you ever are stupid enough to invest in unrecognized provident fund, everywhere taxation. There is absolutely no point in doing so. So unrecognized fund means a fund not recognized by Commissioner of Income Tax. Then we have something called as superannuation fund. So employer's contribution is exempt. This we'll see later. Leave it. This we'll see later. So let's go on to allowances. So allowances, we have many things. One is fully exempt allowances. That is this. Then fully taxable allowances. Then partly exempt allowances. Then exemption is equal to the amount that you have spent. Some of the exemptions will be only till the amount that you have spent. You have daily allowance, traveling allowance, conveyance allowance, helper allowance, uniform allowance, academy allowance. All these allowances you will get exemption to the amount that you have spent. If they have given you 200 rupees, you have spent 200 rupees, fully exempt. Uniform allowance is for these companies which has uniforms, right? Your Hindustan Aeronautics Limited has uniform. Many companies you would have seen will have uniform. So stupid fellows, what they do is for children's uniform and all, they'll take uniform allowance. Actually, practically, that's not at all correct. Uniform allowance is for the person's uniform. Then partly exempt is house rent allowance, HRA, and other special allowances under 1014 we'll see. Fully taxable is allowances which are not covered under any other category, fully this thing taxable, and basically it's useless only that allowance to have because anyway it's taxable. Fully exempt is allowance to High Court judges is fully exempt for them. Allowance received from United Nations is fully exempt. Allowance granted to government employees working outside India, they are all fully exempt for them. So as far as allowances are concerned, some important ones here. First one, commutation allowance. Commutation means traveling, transport allowance. This is only for the blind, deaf and handicapped. 3,200 rupees per month is exempt. So unfortunately, you have to remember all these things, but only few are there, not a lot. So it's fine. You can try and manage. So that is 3,200 maximum per month exempt. Children education allowance. Children education allowance, maximum 100 rupees per month per child. You can't have cricket team, maximum 2 children, right? 100 rupees, peanuts, like this was all there in 1960s, 70s. It doesn't even make sense. 100 rupees per month per child. What is 100 rupees in this day and age? They should remove all these things. Don't tax that also. Why should we sit and remember? But it's painful for us only, right? No choice. Children hostel allowance, maximum 300 rupees per child. This is hostel allowance and maximum 2 children. So hostel more, education less. Underground allowance, that is for mining, etc. Mining, it is 800 rupees per month. Tribal area allowance, if you are now working in a tribal area, tribal zone, 200 rupees per month. Allowance for employees of transport undertaking, that is your truck drivers. For truck drivers, amount received into 70% or 10,000 rupees per month, whichever is less. So 70% or 10,000 rupees per month, whichever is less will come there. This is for transport undertakings. Hill compensatory allowance. Hill compensatory allowance means what? If you are working in hilly areas, 300 rupees per month. Notified areas, some notified hills, 800 rupees per month. And Siachen Glacier, all are army men who are working. Actually, it's very less for them, but anyway, unfortunately, just 7,000 rupees per month. It is a life and death situation there. Yes. Apart from that, all these other things, traveling on tour allowance, conveyance allowance, uniform allowance, daily allowance, helper allowance. Helper allowance means office boy, not servant at home, mind you. Servant at home will be fully taxable. Perquisite it will become. This is office boy. And research allowance, it's called academy allowance. All these things is exempt only to the extent of the amount that has been spent. Nothing else. All the bills against bills, you should give bills for all these things. And for our armed forces, Counter-insurgency allowance of armed forces operating in an area away from the permanent location. So immediately if there's some terrorist attack, the army will deploy the people, Jawans there. So for them, 3,900 rupees per month. High altitude allowance. This is not Siachen Glacier, other glaciers. 9,000 to 15,000 feet, 1060. More than 15,000 feet, 1,600 per month. Special compensatory highly active field area allowance, where a lot of terrorist activities are going on, 4,200 rupees per month. Island duties, that is in Andaman, Nicobar, Lakshadweep, etc., 3,250 rupees per month is the allowance that you will get. These are the allowances which are, exempt to this extent. Next comes house rent allowance, HRA. House rent allowance, HRA, that is under 1013A. These are partly exempt or fully exempt? Partly exempt. How much? This you have to remember because they keep asking HRA. 40% or 50% of salary is exempt up to least of the following. 40 or 50% of salary. What is salary? Basic plus DA if it comes in the terms, plus commission based on turnover. And 40%, 50% depends. 40% with other cities, 50% with metropolitan cities. Only 4 metropolitan cities are there: Mumbai, Delhi, Kolkata, Chennai. No, Bangalore is not there. Right? So that's why recently this guy, or MP, Tejasvi Surya, he made a petition to the in the parliament saying that Bangalore is a metropolitan city in all sense of the term. But unfortunately, since 1970s, Income Tax Act has not been amended. So he actually said, please make it. I mean, it's actually, you also know, it is one of the largest cities in India. So add it to the metropolitan city. Because earlier, the entire capital of the entire southern region was Chennai. So that they took there. Then Delhi is anyway there. Western part we had Mumbai and the other part we had Kolkata. That they had done in 1960s. And they have not changed only. Why he was petitioning is because people now can claim 50% in HRA rather than 40%. That is the reason why he was pushing. So basic plus DA if plus commission based on turnover. Actual amount received, rent paid minus 10% of salary. Rent paid minus 10% of salary. And what is salary? Basic salary plus DA if it comes part of the terms plus commission based on turnover. And for salary, advance salary should not be taken. Advance salary should not be taken. Basic plus DA if plus commission which is based on the turnover. Commission which is based on the turnover. 50% metropolitan, then other cities, nothing. So this you will get. Whatever rent allowance that you are getting minus these three things. 40% or 50% of salary, actual amount received, or rent paid minus 10% of salary. Again, salary means what? Basic plus DA if plus commission which is part of the turnover. Then let's see. Then you have something called perquisite. Let us see one second. So other special allowances we have seen already. Transport allowance, children education, hostel, counter-insurgency, all that we have seen. Next comes the interesting area of perquisites. If I see perquisites, some perquisites are taxable in all cases. Some perquisites are taxable only in the hands of specified employees, and some perquisites are not taxable at all. Like medical facilities will not be taxable. Leave travel concession not taxable. Other things will not be taxable. Taxable in all cases. Rent-free accommodation, butcher employee, RFA is taxed. Accommodation provided at concessional rent, it will be taxed. Obligation of employee met by employer means employee had to pay that amount, but employer paid now. Like for example, children's school fees, employer paid directly. Of course, I have to pay, so of course that will be taxed. Amount payable to affect insurance. Insurance policy paid by employer on behalf of employee. ESOP or sweat equity. So even if you're getting ESOP or sweat equity, it's taxed. Contribution to superannuation fund and other fringe benefits like free meals, interest-free concessional loan, traveling, touring, accommodation, gift, credit card, club facility, use of mobile assets, and all these things. Not taxable, medical facility, leave travel concession, others. So if you see one by one, LTC, leave travel concession. Travel benefit across India, this is what all you will get. If you are traveling by air, what is exempt? Actual expenses is exempt. Economy class fare is exempt. Either of the two. Either you will get the actual expenses or air ticket economy class. Because there are three classes: economy, business and first class. So here you will only get up to economy class. If you go for other things, you have to pay. Basically, that extra will be taxable. Other mode other than airway, it can either be railway or railway facility not available. If railway facility is available, then actual expenses or first class AC railway fare. First class AC railway fare, whichever is less, you will get first class AC. We have 3-tier AC, 2-tier AC, first class AC, like that. Travel facility not available. Then I should see whether recognized transport facility is available or recognized transport facility not available. If recognized transport facility is available, what is exempt? Actual expenses or deluxe class bus fare. Which means if bus is there or deluxe class, whatever bus fare deluxe class you will get, whichever is less. So if nothing is available, you want to go to Himalayas and then do meditation there. So there is no motorable road at all. Some hilly area you want to go. Then they'll say actual expenditure or first class railway fare of similar distance. If that distance is 80 kilometers or 800 kilometers, same, or some 600 kilometers, similar, same distance, what will be the railway fare, that you will get exemption. Beyond that, if you are getting, that will be a benefit and it will be taxable. So if I am spending, the company is giving 1 lakh rupees LTC, leave travel concession, but actually the economy fare is only 80,000, 20,000 will be taxable. Which one? Yeah, of course, all the bus facilities it will include. The government bus facilities, yes, definitely. And you will get only for 2 years, not every year. 2 years in a block of 4 years. 2 years in a block of 4 years, you'll be getting all these things. Now, this is for the entire family. Now, family means not your extended family, two spouses and all if you have, that's not covered. It is only SSC plus spouse plus children and dependent relative. Dependent relative will be your parents and your siblings. That's it. That too, dependent means what? Financially dependent, not emotionally dependent. Financially dependent parent. That's it. Then 2 children. Children also not some 11, 10, 9. It's only 2 children. And that too born after 1st October 1998. Born after 1st October 1998. Two children. Now the thing is, on 1st October 2000, one child was born. And on 10th November 2002, twins were born. So it's considered as 3 or 2? 3. This also they clarified. Considered as 3. So that one extra child not allowed. On the other hand, on 1st October 2000, twins came. And then on 10th November 2002, one child was born. What do you think? Will you take it as 1 or 2? See, LTC. We'll come to RFA. What do you think? You'll take it as 2 or 1? Yeah, the exemption shall not be available to more than 2 surviving children of an individual born on or after 1st October 1998. If the SSC after 1st October 1998 had one child and thereafter twins in 2001, exemption shall be available to all 3 children. It will be considered as 3, but it will be available to all 3. Because you had one child and then twins came. So those twins, though it is considered 2, it will be deemed to be 1 for tax purposes. So though it's considered as 3 only, for all 3 it is allowed. On the other hand, that is what I have written here. 1/10/2000, one child. Of 10/9/2002, twins. So 1 plus 2 taken as 3 only, and exemption is allowed to all the 3. On the other hand, on 1/10/2000, twins were born. It's already 2. 10th September 2002, 1 was born. Not considered only. So it's only these 2 people will be considered. Very, very simple. This is for leave travel concession. Leave travel concession. Next, medical facility. Medical facility. I should see whether treatment is in India or treatment outside India. Treatment is in India. If it's in a government hospital and that too happens to be employer's hospital or government recognized hospital, whatever it is, either government hospital or government, the employer's hospital is own hospital, like Reliance or this MS Ramaya, the employees of MS Ramaya have their own hospital anyway, and government recognized hospital, then fully exempt. But if the treatment is somewhere else in a private hospital, then fully taxable. Treatment outside India. Treatment outside India. Treatment or the stay, both exempt up to the limit prescribed by RBI. It is exempt up to the limit prescribed by RBI. And for travel, it is fully exempt. Limit prescribed by RBI is what? As per the liberalized remittance scheme of FEMA, it is $250,000 per annum. So for treatment and stay, it is exempt up to the limit prescribed by RBI, that is $250,000 per annum. For travel, on the other hand, it is fully exempt. Travel, it is fully exempt. If your gross total income is less than or equal to 2 lakh without adding this travel benefit. Else, for traveling, it will be fully taxable. No doubt about it, fully taxable. This is the medical facility. This is not medical, reimbursement of medical expenses. It is medical facility given, where they will only give you the facility, they will only pay. Employer will pay. So, for treatment and stay, if employer is paying, it's exempt. But for traveling, etc., only if your income is less than or equal to 2 lakh. Nobody will pay you if your income is just less than or equal to 2 lakh, obviously. So, generally for travel, for all employees, it will be fully taxable. Perquisite number 3, gift to employee. Gift if it is given in cash, fully taxable. Gift if it is given in kind. If fair market value is less than 5,000, fully exempt. If fair market value is greater than or equal to 5,000, fully taxable. Then you have ESOP, Employee Stock Option Plan. These are the shares issued at concessional rate. So generally there will be an employee, and I will tell you, you work for 3 more years. If you work for 3 more years, 20 lakh worth of, the shares I will give you at 10 lakh, I will give you at 5 lakh, whatever. So that 3 years that you are working, that is called as the vesting period. At the end of the vesting period, you will have an option to buy the shares. So you can either exercise the option or you can choose not to exercise the option. So what is taxable? What is taxable amount for the employee? FMV of the shares on the date you are exercising the option minus issue price. So if the FMV of the shares was 20 lakhs, issue price was only 5 lakhs. How much is taxed? 15 lakh is taxed undoubtedly. And FMV of the shares, you will take the opening rate and closing rate divided by 2, otherwise valuation will be done. This is regarding ESOP. So basically when they say ESOP, Don't jump and say, oh, everything is free. It's not free. First of all, you will pay 5 lakhs. And then 20 minus 5 on 15 lakh, 30% you have to pay anyway. 4.5 lakhs gone. So what is the effective cost of a 20 lakh share? 9.5 lakh, including tax. So it's not so beneficial, of course, but there will be some discount. There is 50% in this example. Next, loan given to employee. Now, loan can be given to employee with interest or without interest, doesn't matter, or concessional interest also. Taxable perquisite, if I am giving it at a concessional amount, then loan amount into SBI rate as on 1st April of previous year. Please note, it is not the SBI rate as on date of giving the loan. They can confuse you by giving all those things. They can give you on the date of the loan, rate of interest SBI was 14%. But on 1st April of previous year, that is 1st April 22, rate of interest was 12%. I should actually take 12%. SBI rate as on 1st April of previous year minus actual rate of interest. So I am going to tax on what? The extra amount that you have received. Loan amount into SBI rate is 14%. They have given you at 8%, 6% benefit they have given. I will tax that benefit also. So you will have to pay 30% of 6% actually. That is 1.8% you have to pay. So basically, Nirmala aunty will squeeze you from everywhere. If you are a salaried employee, the only way you can save money is if you are a businessman. We have our presumptive taxation and all those things. So that is what it is. But if the loan amount is less than or equal to 20,000, then not taxable. That also they can ask you in an MCQ. If the loan amount is less than or equal to 20,000, then benefit of interest not taxable. I repeat, don't go on the date of employee releasing the loan, go by previous year, yes. And also guys, if the loan is given for specified diseases treatment, cancer, AIDS and all those other things are there, very deadly diseases, then not taxable. So interest benefit is not taxable for loan given for specified diseases. Next, perquisite number 6, use of movable asset. One is what? Computer, laptop. Imagine the Nirmala aunty taxing you for laptop given to you by your office, deadly. With that laptop only, you will go hit everybody, right? So if you see, it's fully exempt, thankfully, right? Next, car, we'll see next part. Next, any other asset, furniture, sofa, bottle also, not kidding, right? Technically speaking, nobody does all that practically, but actually it is taxable. They will give you one bottle for use, that also is taxable. Furniture, sofa, etc. Now, next, owned by employer. If furniture is owned by employer and sent to your house where you can use that, they have given you, you rent your own house, they'll give you some 3-4 furniture. Yes, many arrangements are there like that. What is the taxable amount? 10% of the cost. If they have hired, so there's a company called Furlenco where you can hire, furniture and all, etc. So they will hire from Furlenco and give you. Then it is higher charges paid by employer will be your taxable perquisite. This is your use of mobile asset, mind you. Car we will see later. Next one is what? Sale of mobile asset. Computer, laptop, you will use for 2-3 years, then you will purchase that as an employee. Yes, it is taxable. WDV minus consideration is taxable. If WDV is 1 lakh, consideration is 1 lakh, zero tax. WDV should be computed not as per income tax 40%, normal, your WDV. Here they have given 50%. Specific rate is given already. So if you see, laptop was 1 lakh rupees, used for 2 years, employee paid 5,000. What the taxable perquisite? 1 lakh minus 5,000, 50,000. 50,000 again 50%, 25,000, 25,000, the WDV. How much did you sell it for? Buy it for 5,000. 25,000 minus 5,000, 20,000 will be my taxable value. If it is car, I am selling the car to you after usage, WDV minus consideration, depreciation at 20% WDV method. Other asset, WDV minus consideration, WDV 10% at SLM method. And mind you, life is considered as 10 years directly, no change. It is considered as 10 years. For whom? For other assets, furniture and all those things. SLM, that's why 10%, no, that's why life is considered as 10 years. Most important thing, depreciation should be calculated for completed year from the date on which employer acquired till the date of sale to the employee. If it is 10.5 months, etc., ignore. 10.5 years, sorry, ignore. 3.5 years, that half year, ignore. 2.5 years, half year, ignore. Completed year of service. Other asset, taxable, WDV minus consideration. Depreciation at 10%, SLM method. Life is considered as 10 years. So here, same thing. Depreciation per year you should take at 10% SLM. Direct SLM, mind you, not WDV. Next, lunch facility. Exempt if value of the meal is 50 rupees per meal. Chaprasi, 50 rupees. Provided an office campus, paid voucher, that is Sodexo coupon and all those things. Sodexo coupon you will get. If value is more than 50, excess is taxable. Nobody uses this practically, guys, but 10 hotel benefit. If they have given you a hotel to stay, what is the taxable benefit of that hotel that you are staying? 24% of salary. 24% of salary. With sort of salary, same bonus, taxable allowances, DA if it's in terms, same thing. Or higher or rent charges paid by employer, whichever is less. So they have given you a hotel to stay in, 24% of salary or higher charges or rent paid, whichever is less, you have to take. If employer recovers rent from employee, then that rent should be subtracted from the taxable amount because you are not providing rent-free accommodation, you are collecting some rent. If hotel facilities provided at the time of transfer of employee, it is up to 15 days, then it is not taxable. So up to 15 days, whatever hotel facilities provided, no problem, because 15 days is the time for you to shift to the new house. So there, no taxes collected, not a problem. This is just the concise version of the entire salary chapter. All the things are covered in this. Perquisite number 12, transport facility for transport employee. That is your free tickets. Airline tickets, railway tickets, no tax. For other employees, fully taxable, less amount recovered. So if you are a normal private employee, they are giving you free transport, air tickets, or not for your leave, but for your other things, then it is fully taxable, less amount recovered. Education facility. For employee, it is fully exempt. If they are giving you education facility for education of the employee, then for the employee fully exempt. Employee's children, if the value of education is less than or equal to 1000 rupees per month per child. Exempt if education is provided in employer's own institute or any other tie-up if it's there. Other schools where there is no tie-up, fully taxable. For any other relatives, fully taxable. It's anyway useless. And that too, what, 1000 rupees per month, where it is impossible now. For nursery only, it's some 1 lakh or something, right? Yes. Car facility. I told you car we will discuss later. Now, car is fully used for official purposes, exempt. If employer maintains records of each journey. Car used for fully personal purposes. Taxable value. If car is owned by the employer and then given to the employee, 10% of the cost is taxable. Car is hired by the employer, then higher charges you should do. Apart from that, you add the driver's salary, add running and maintaining expenses, that will be the taxable perquisite. If car is used partly for office, partly for person, this is how it will be generally. It cannot be, okay, it can be some official definitely, or it can be fully personal, doubtful. It can be mix of this. It is mixed. If car is owned by employee, but running and maintaining charges are paid by the employer. See, if car is owned by employee only is paying everything, then what taxable? Not taxable. If car is owned by employee, running and maintaining expense also paid by employee, there is no benefit only, hence not taxable. But if car is owned by employee, but the company says, I will pay your service cost, I will pay your petrol, I will pay everything, don't worry. Then actual amount paid by employer minus 1800 rupees per month or 2400 rupees per month depending upon the CC. That amount will be taxable. All this we have to remember, guys, no choice. But if car is owned by employer, they own the car and they'll tell employee, you need to pay petrol charges. Then employee, how much he has to pay? 600 rupees per month or 900 rupees per month, depending on the CC. But if they paid by employer only, then extra you need to pay 1800 per month or 2400 rupees per month. If driver is provided and paid by employer, extra 900 rupees per month will be added to taxable amount. Driver also if they give. If two cars are provided, first car standard amount as per calculation, second car assume that it is fully used for personal purpose. Two cars if it is there, personal purpose, and that personal purpose calculation will come. Apart from that, gas, electricity, water supply, fully taxable. Servant provided by employer for the house, fully taxable. Any other perquisite, fully taxable. Which are the ones fully exempt? Telephone bill, mobile bill, reimbursement, reimbursed by employer. Scholarship to employees' children, fully exempt. If any goods which are like stock in trade, like you are an employee of Tata Cha and Tata is giving you packets of tea at reasonable rate, no problem, fully exempt. Tax on non-monetary perquisite paid by the employer. So if your salary is 10 lakh and your perquisite extra is 2 lakh and the employee says, I will not pay on this 2 lakh, I will not pay tax on this 2 lakh. I will take my entire income as 12 lakhs, but I will not pay tax on 2 lakh. So I will have to compute the full tax on 12 lakh only. But then minus the tax paid on 2 lakh by the employer, I should subtract. That's why it says under 1010 CC, tax on non-monetary perquisite paid by employer is fully exempt. For the employer, what will happen? You should pay first of all 10 lakh. Then you should pay 2 lakh. You should pay tax on that 2 lakh. And the tax portion also will be disallowed under section 37 and all those things. 40. Tax portion 40A, it will be disallowed, small a. But that also you should pay tax on that you leave. Yes. Next, professional tax. It's a state government tax. It is paid by the employer. Add to the statement. Taxable. And then deduction under section 16. paid by the employee, directly take deduction under section 16 for the employee, because I'll pay the employee will pay on his own. It's a different thing. Concept number 17 is entertainment allowance. It is only for government employees. Fully taxable for all employees, but deduction under section 16 is allowed to government employee for this. 20% of basic salary, actual amount received, or maximum 5,000 rupees. For all employees, standard deduction 50,000 rupees or salary per annum, whichever is less. This is for standard deduction, 50,000 or salary per annum, whichever is less. Now this is also important because in Finance Act 2023, they have made the alternate tax regime, 115 BAC, alternate tax regime, different slab rates. In that standard deduction, etc., they have changed little bit, which means last time ever these things can come will be November 23 attempt. VRS compensation. VRS compensation, least of the following will be exempt. Salary per month into number of years of completion, fraction to be ignored, into 3 years of service. Salary per month into number of remaining months of service. This is if you take voluntary retirement. Actual amount received, maximum amount 5 lakh. Maximum amount 5 lakh. And what is salary? Basic plus DA if it is part of the terms, and turnover commission. And retrenchment compensation, as I already told you, we have seen 15/26 and all those things. Now, one more thing, NPS, that is the pension scheme, new pension scheme. Generally, if you make a full withdrawal of the new pension scheme, employee, non-employee, whatever it is, 40% is taxable, 60% is exempt. If you make a full withdrawal from the NPS scheme. If you make a partial withdrawal, if you are an employee, 25% is exempt, 75% is taxable. And if you are a non-employee, 100% is taxable. Now you have RPF, you have ASF, approved superannuation fund, and NPS. NPS is taxable, as we have seen. RPF up to 12% is exempt, and ASF, approved superannuation fund, up to 7,05,000 rupees is exempt. This is all employer's contribution. So what Nirmala madam did, she added all the three. And all the three, if the employer's contribution is coming up to more than 7,50,000 rupees, then excess will be taxable as perquisite. Excess will be taxable as perquisite. So RPF up to 12% is exempt. So beyond 12%, if it's anyway taxable. But even up to 12% is coming up to whatever it is within the limit. Right? So for instance here, salary is 50 lakh. RPF is 10%. ASF is 2 lakh. NPS is 60,000. You see, what is 10% of 50 lakh? 5 lakh. Is it well within the limit? Yes. Will it be taxed under RPF? No. ASF up to 2 lakh, up to 7,50,000 is exempt anyway. ASF superannuation fund, how much I am giving? 2 lakh. NPS 60,000. How much am I paying overall? 5 lakh plus 2 lakh plus 60,000. 7,60,000. Is it exempt within those laws? Yes. But here 5 lakh plus 2 lakh plus 60,000 is 7,60,000. 7,50,000, it's exceeding by how much? 10,000. So they have added 10,000 also as perquisite. 10,000 also is perquisite. So as I told you regarding that amendment in RPF, if the interest on accumulated balance 8% I was earning, accumulated balance was 60 lakh. What is 8%? 4 lakh 80, fully exempt. This is as on 31st March 21. But from 1st April 21, what has happened? I should see. Employer contribution, employee contribution. Employer contribution 4 lakh into 8%, 32,000, fully exempt. The new amendment is only for the employee contribution. Now you see, employee contribution in excess of 2,50,000 only is taxable. So if it is 4 lakh rupees, 2 lakh 50 into 8%, 20,000 rupees is exempt. The balance 4 lakh minus 2 lakh 50, 1 lakh 50,000 into 8%, 12,000 now is taxable. 12,000 is taxable. On the other hand, if there was no employer contribution and my salary was 70 lakh, 10% was my contribution. What is my contribution? 7 lakh. And as I told you, up to 5 lakh exempt. More than 5 lakh. How much is it? 2 lakh into 8%. 16,000 rupees. Taxable or not taxable? Taxable. That would be taxable. Standard deduction, all that is fine. Then connected to this, I'll just quickly go to the 115 BAC and then we'll just take a break. So 115 BAC is the alternate tax. I'll just go through the tax rates, that's all. And mind you, whatever 115 BAC concept has come, that has now from the next year onwards, this has become the, that is from Finance Act 23, this has become the default tax regime. Hence, the whatever we did the slab rate, that is the main tax regime only for November 23 attempt. And mind you, this also has changed in Finance Act 23 slabs. So this slab also last time can come only in November 23. Because these slab rates also have changed slightly. So this is an option. This is for same for normal citizen, senior citizen, super senior citizen, everything same. Up to 2,50,000 nil. From 2,50,000 to 5 lakh, 5%. 5 lakh to 7 lakh 50, 10%. 7 lakh 50 to 10 lakh, 15%. 10 lakh to 12 lakh 50, 20. 12 lakh 50 to 15 lakh, 25. Above 15 lakh, 30%. Similar to the normal provision, surcharge applicability also depends on the total income of the SSC. Surcharge of 15, 10, 15, 25, 37, all that will apply. Rebate under 87A also, which provides for 100% tax rebate, whichever is lower. Yes, this also will apply. How much? Same, 12,500. If it does not exceed 5 lakh. This also has changed, which means this is the last time they can give in November 23. I'm not going to tell you what has changed. I mean, what is the change, but I'll tell you what has changed. Third point has changed. So last attempt, November 23. This slab rate also has changed. So last attempt, November 23. So certain deductions and exemptions are not permitted. So LTC you will not get, HRA you will not get, all special allowances you will not get. Standard deduction of 50,000 you will not get. This also, guys. This point where they have told standard deduction also you will not get. Last time, November 23. Nirmala aunty has changed it little. I will not tell you what is the change. Definitely no. Let's not get you confused, but I am just trying to tell you these are all the last time. House property that, so these are what? These are all the restrictions on individuals to avail deductions are otherwise available. The list of restricted exemptions are as under. You will not get house property, that 24B interest on loan also. Additional depreciation you will not get in PGBP. Depreciation you will get, mind you. Additional depreciation you will not get. Deduction for scientific research, etc. you will not get. Capital expenditure 35 AD you will not get. Allowance of income for minor work clubbing 1,500 rupees that you will not get. Then 80C to 80U you will not get, except ATCCD2, that is deduction to employer's contribution to NPS, that you will get. ATJJAA, that is employment of new employees, you will get. ATLA, you will get. Apart from that, nothing. But you will get the normal allowances. Gratuity you will get, pension you will get, VRS you will get, retrenchment compensation you will get, leave encashment you will get, superannuation fund, all this you will get. Exemptions are available as part of employee retirement benefit. So that time somebody asked a question. Employees contribution but eligible as deduction under 115 BSc. Under ATC deduction you will not get. That's for sure. But gratuity, etc. See, your question was if employee has contributed to RPF, etc. Earlier, if in normal tax regime, ATC you will get. Will you get ATC now? No. But what about gratuity, pension, VRS, retrenchment, employee benefit, that will you get? Yes. For sure you will get all these things. So that's about it, guys. Very simple. So we'll take a break. It's 12:26, 12:40 tak we'll take a break. And after which we will do TDS, tax deducted at source. Done? Online people, are you here? TDS, again very important. Definitely they will ask in the exam. 12:45. You take 15 minutes, 15, 16 minutes. 12:45 sharp will start. TDS. Okay. So now coming to the TDS portion, tax deducted at source. So TDS, as the name itself suggests, is the tax that you will be deducting at the source itself. This is a recovery mechanism by the government because people will never pay taxes. So that's why at the beginning only, at the source itself, they will recover. So the first one is what? 192. So generally everything, if we understand who's the payer, who's the payee, etc., then it will be easy. Of course, we'll do all the important areas, all the important TDS sections we'll do. So 192, payer is an employee, payee is a resident or non-resident. Rate will be slab rate, this is salary, that's why. So what all should the employer should consider what all in this? First, he should consider the house property, profit or loss, and then the income from other sources. Income will be considered, loss will not be considered. So if, for example, any employee's salary is 80,000 assume per month, 9,60,000. The employer only has to deduct the standard deduction of 50,000 and 9,10,000 will be your income. And then his total tax for that will be, here after doing all the calculation including cess, will be 98,280. So the employer has to deduct 98,280 divided by 12 every single month. So here the person who is deducting tax will be the employer. He is deducting on behalf of the employee. And the best part is if the employer doesn't deduct, he will be liable as a assessee in default. So it's a very dangerous provision for the employer. On the other hand, if you are, saying that, as I told you in the previous example, 7 lakh is my, in the example which we saw, in the salaries. If my salary is 7 lakh, 2 lakh is my non-monetary perquisite. And I say that I don't want to pay tax on non-monetary perquisite. I should compute the tax normally only. Overall 9 lakh minus 50,000, 8.5 lakh. For 8.5 lakh, 85,800 is the tax. Now I told you I will not pay on this 2 lakhs. I will not pay on 2 lakhs is what the employee is saying. So for 8,50,000 salary, 85,800 is the tax. For 2 lakh rupees, what would be the tax? So for 2 lakh rupees, tax would be 20,000 rupees 188. This 20,188 is borne and also paid by the employer. It is borne by the employer and paid by the employer also. So this amount of 20,188 is disallowed for the employer under PGBP, and for the employee it is exempt under 1010 CC, which we just saw now. And what should the employee take? Employee, employer, how much will he deduct? 85,800 minus 20,188, because it's 20,188 fully they will only pay. Balance 65,612 divided by 12. So 5468 will be the deduction every single month. So that is all. And what if this fellow works in some cases he will work for 6 months somewhere and then goes to the other 6 months somewhere else. So when he is doing that for 6 months only, they would have taken into account the basic exemption limit, etc. So that again benefit will not be given to the next 6 months. So that is what you should calculate. What if I am deriving salary from both two sources? That is possible. Part-time, both part-time I am working. Both of them know that I am working part-time in two companies. It's not a case where I have lied to the one company. In this case, I should take the basic exemption limit, give the details only in one company, because I cannot take basic exemption limit twice. So that is all the basic deal in 192. Then let us check the important ones. So many things are there in TDS. We'll just see the most important areas. Of course, first one is definitely 192, which we have seen. All that we have checked that. Yes. Then payment of accumulated balance in EPF to employee. This is an important section because it has been amended in Finance Act 2023, which means the last part ever this can come is November 23. Which part, that also I will tell you. This is what I told you in RPF when we were discussing. I told you that you will, all the money that you are getting lump sum will be exempt if 4 conditions are satisfied. What are 4 conditions? You are continuous service of 5 years you have done, or you are exited before 5 years only because of your ill health, or because of your the closure of business. So, or other causes due to the, beyond the control of the employee. Now, premature withdrawal, has happened. That is still okay. But if any of, for these reasons it is not happening and directly you have done a taxable premature withdrawal, then what happens? Then you will have to pay tax. That is, less than 5 years you have taken a premature withdrawal, but you are not ill, you are fine only. And then you, or the business of the SSC has not closed down, it's fine only, but you only left. Or you have not joined somewhere else and you have not shifted the balance there. Then in that case it will be taxable. So that is the scene. If generally it is taxed at what time? At the time of payment only. At the time of payment. Generally TDS is deducted or rather paid at what time? It is deducted at the time of payment or credit, whichever is earlier. Either at the time of payment or credit, whichever is earlier, but some cases it is only on payment basis. One is salary. Salary is only at the time of payment, dividend, all these things, payment. TDS is always at a flat rate. There is no cess, no surcharge, etc. except salary for a non-resident. In salary for a non-resident, I will take into account, or even normal salary also, I will take into account the surcharge, etc. because I don't want the employee to pay again. Now, there is a general section. If you do not pay, if you do not furnish your PAN, then the tax rate will be 20%. But one big exception is 192A. If employee does not furnish the PAN, tax will be deducted under the maximum marginal rate, 42.74. Now, this has changed in Finance Act 23. What is the change and all? Let's not go there. But this 7th point, last time ever, it can come only in November 23. Right? They can ask an MCQ where if you don't furnish the PAN under 192A, then the tax will be, first will be double, they'll give 20%. Then they'll say double. Then they'll say 42.744%. So answer is 42.744%. For May 24 onwards, this will change. Yes, next is interest on security. Any person paying interest, and the payee here will be a resident person, rate will be 10%. This is the TDS on any interest. It says any interest on securities. So securities can be anything for that matter. That is your interest on debentures, interest on other securities, interest on government securities, etc. But TDS is not applicable for certain cases. That is, public company is giving interest on debentures to resident individual or HUF. If it is paying less than or equal to 5,000 by check, then no TDS. So they'll give you, they are paying 7,000 by check, TDS will come. They'll say 4,000 by cash, TDS will come. So it is less than or equal to 5,000 by check. Next, payment made to life insurance corporation, general insurance corporation, any insurance company. So if its payment is not made by, it is made to, mind you. And any dematerialized security, this will come. And government security, again MCQ question. Government security for state government or central government, TDS will not come except these two. 8% savings bond account, 7.75% savings taxable bond scheme account, where the interest is more than 10,000 rupees. Interest is more than 10,000, TDS will come. TDS will come. Then under 54 EC, if you remember in capital gain, we had deposited funds in some account called 54 EC. So that is only two cases there. It will be exempt, no TDS. That is for capital gain bonds issued by Power Finance Corporation Limited and Indian Railway Finance Corporation Limited. So for Power Finance and Indian Railway Finance Corporation, it will not come. So those are some important areas. 92A we saw. 194 is your dividend. TDS on dividend. Earlier, dividend used to be dividend distribution tax. Corporate dividend tax used to be paid by a company, and then for employee it used to be exempt. Sorry, for the shareholder it used to be exempt. Now shareholder has to pay under 194. When I am distributing money to the shareholder, company only will deduct TDS under 194. Mind you, only if the dividend is more than 5,000. Dividend is less than 5,000, no TDS. Less than or equal to 5,000, no TDS, and it should not be paid by cash. And as we know, under 206 AA, if PAN is not furnished, then generally it is 10%, but if PAN is not furnished, 20%. 20%. (194A), any person other than individual or HUF, payee will be a resident person. Resident person. This payer of the interest. This is what, guys? Interest other than interest on securities. This will be interest on your recurring deposits, etc. This will be interest on your recurring deposits and fixed deposit and all these things. So here, generally, what is the rate? That's all okay. That is 10%, otherwise 20%, all that okay. But when will TDS not come? If it is paid by bank, cooperative society, post office, less than or equal to 40,000 rupees per annum per bank. This is for normal people. For resident senior citizen, less than or equal to 50,000 rupees per bank, per annum per bank. Mind you, it is not per branch, it is per bank. So all branches added. And if they say non-resident senior citizen, for him it is still 40K. Whether 50K limit is only for a resident senior citizen. In other cases, it is less than or equal to 5,000 rupees per annum, no TDS. Savings bank interest, no TDS irrespective of any amount. So which means this 194A is only for recurring deposit, fixed deposit, etc. Firm is paying interest on capital or interest on advance to a partner, no TDS. Interest paid to bank, cooperative society, finance corporation, LIC, no TDS, which means I am paying interest. I have taken a loan from bank. I am paying interest to bank. Will 194A come? Should I deduct? No. Minor where parents are deceased, TDS will be in the hands of the minor. This is also an interesting point. And now interest paid by income tax department on income tax refund. So refund they delayed, so they have to pay interest. Will there be TDS? No TDS. There will be no TDS. Then 194B is for lottery and crossword. 194 BB will be for horse race. These cases, payer or payee. So TDS rate is given under this section, whereas chargeability is given under one more section called 115 BB. So what is the rate given? 194B. How much is charged? When is it immediately deducted? That is given under 115 BB. So payer or payee can be any person. Rate will be 30%. Only if the winnings is more than 10,000 rupees. If payee is a resident, then no cess. If payee is a non-resident, then cess at 4%. Plus applicable surcharge also will be there. Otherwise, generally TDS no cess. Why will I charge cess for non-resident? Because I am paying the money, will never come back later. So that's why I should deduct the cess and surcharge. However, if I have received a BMW car in a lottery and the amount is 1 crore. Now I cannot, deduct TDS. I cannot give one steering, tire and all that. So what is the government telling? You collect from that fellow only. So you will say, sir, please pay 30 lakh, take the BMW car 1 crore. As simple as that. Or if it's a cash award and other thing, then they will say, take the cash award fully, I will recover towards TDS. Extra amount you pay. That's what it is. So that is the entire thing. 194B and BB. So one more interesting thing in 194B and BB, if you see, this will also include, this is winning from lottery and crossword puzzle, okay. 194BB is for horse racing or for arranging for wager or betting in any race course. So there was confusion whether it included online games or no online games. So for online games, they made a separate section that is for Finance Act 23 onwards. So if they want to give online games, etc., this will still come under these things only, 194B and BB, because B will include lottery, crossword puzzle or other games of similar sort. So even online games will be like rummy, online rummy and all will be like online lottery in any other mode. So all that will come under 194B only for November 23 exam. For May 24 exam, they have already shifted the section with some other differences elsewhere. Right? So for November 23 exam, online games will still come under 194B. Because 194B section says lottery or crossword puzzle or other game of similar sort. So online also will be similar sort only. So insurance commission, lottery and all these things, ticket commission. 194D is insurance commission, 194G is lottery. That is, people in Kerala will sell lottery tickets. No, that commission if they are getting, that is 194G. So both similar concept only, 5%, but the commission should be more than 15,000 rupees per annum. 15,000 rupees per annum. Then on brokerage, commission on brokerage, any person other than individual or HUF, pay will be a resident person. Again, the rate will be 5%. It should be more than 15,000 per annum. Anyway, but the real deal is 194C, 194J, 194I, 194M. All those are important areas. That is what we'll cover now. 194C, TDS on contractors. Who is the payer? Any person other than individual or HUF will be considered as the payer. Payee will be any resident person. Payee will be any resident person. So, for example, if I am giving you a contract worth 1 lakh rupees, you are the contractor, I am the contractee. When the contractee is paying the money, you should deduct TDS and pay to the contractor. Rate will be for individual or HUF it is 1%, for other persons it is 2%. TDS will be deducted either if the single contract exceeds 30,000 or aggregate contracts exceed 1 lakh. If it is like 30,000, 20,000, 20,000, 40,000, 25,000, 10,000 like that, overall it's exceeding 1 lakh, and the last payment time I will deduct for the entire year. Now, will 194C apply to, what do you say, individual and HUF? Means if individual and HUF hires a contractor, should he also pay? It depends on, he should be a big individual or HUF. So, contractee, payer or deductor, individual plus HUF. If the turnover or gross receipts is less than or equal to 1 crore, So basically guys, here, very simple. If the deductor or payer or contractee is an individual or HF, we have to follow the chart now. If he is any other than individual like a company etc., then I should see the contract amount. Per contract more than 30k or aggregate more than 1 lakh. Now coming to individual HF, which is this chart we'll see. Now, if the turnover or gross assets is less than or equal to 1 crore or less than or equal to 50 lakhs in the profession, no TDS irrespective of the contract amount. In 194C it will not come. On the other hand, if the turnover or gross assets is more than 1 crore and or in case of profession it is 50 lakh more, then only 194C gets triggered. So will TDS provisions apply? Should the individual or HF deduct TDS? It depends on whether he is a big individual or a small individual. Who's a big individual whose turnover or gross assets is more than 1 CR and in case of business, or 50 lakh in case of profession. 194C gets triggered. Now it gets triggered, but I need to see if he is using it for personal purposes or if he is using for official purposes. Let's assume he is using it for official purposes. Like Virat Kohli is hiring a contractor. Is he a big individual? 100% yes. So he is hiring a contractor for official purposes. Single payment more than 30k, aggregate payment more than 1 lakh, 194C. Very simple. At what rate? 1% if that pay is an individual or 2% if the pay is other than an individual. So Virat Kohli is hiring somebody for, let's say, some training of his calf muscles. He is hiring a trainer, official purpose. He is hiring an individual. How much is deducting? 1% he should deduct. He is paying them 12 lakhs per annum. How much should he deduct? 1%. But he is hiring a company where they will keep sending every day one trainer. So how much do you deduct? 22%. On the other hand, Virat Kohli hires an interior designer for his house. Right? Interior designer for his house. And he is paying them 20 lakh rupees for his entire, one room, not even a house. One room, he wants an interior designer fully designing his interior, his one room. His, let's say, study, library he wants to design. He is given it to an interior designer. That female is charging 20 lakh rupees. Now, payment to a resident contractor per year, is it less than or equal to 50 lakhs? Yes. So 194C also will not come. There's one more section, 194M, that also will not come. But if he is paying to a resident contractor per financial year more than 50 lakh, so Virat Kohli hires a interior designer for his room and paying 60 lakh rupees to that person. So then 194C will not come because it's personal purpose. But 194M will come. Another section, 194M, TDS will be at the rate of 5%. Now what do you mean by contract? Contract can be contract of work, contract can work of labor, or it can be service. Service can be professional service, technical service, managerial service. Professional, technical, managerial service, etc. will not come under 194C, it will come under 194J. But as far as work and labor is concerned, it will include everything. Advertisement, it includes broadcasting, it includes telecasting. Cold storage facility, which we saw in specified business under 35 AD, that also will come under this. Carriage of goods or passengers other than Indian Railways. Anything carriage of goods or passengers, if you are hiring a lorry, if you are hiring goods carriage, if you are hiring FedEx plane to carry your stuff, goods, yes, definitely it will come. Catering services, it will come. Transportation of gas or petroleum stuff also will come. If you are manufacturing any product as per the client's requirement, that also will come under 194C. Advertisement, like any advertisement which is hosted everywhere will come for sure. And what about telecasting, broadcasting? For example, Netflix originals you would have seen. In Netflix originals, they are only the producers. They will hire a cast, crew, etc. They will tell them, boss, this is the script, this is how I want it, I am the producer, do it as per that, that's it. Now, is that a contract? Yes, because they are hiring everybody. Script, story writer, etc. 994C will come. On the other hand, Netflix buys the right of, let's say, RRR movie. Is RRR made for Netflix? No, but they have bought the Hindi rights of RRR movie. Is that a contract? No, it's an outright sale. So for outright sale, 194C will not come. Carriages, if I have hired a goods carriage of 35,000 rupees, can I pay cash? Yes, I can pay cash. Why? Because we had seen in 40A3 for goods carriages up to 35,000, no, what do you say? You can pay by cash also, no need of bank payment. However, now this section says up to 35,000 rupees, no problem, you can pay. If the individual is owning less than or equal to 10 trucks and is given a declaration and is furnished a PAN, then there is no TDS for that person. No TDS for that person. So for goods carriage, 3 conditions irrespective of the amount. I told the 35,000 only for cash purposes. You pay 1 lakh, 2 lakh, 3 lakh also, no problem. No TDS. No 40A3 disallowance for payer if amount paid in cash is less than or equal to 35,000. This is connecting 40A3 and 194C. Right? So if I am paying to a goods carriage guy owning less than or equal to 10 trucks, any amount paid, 1 lakh, 2 lakh, 3 lakh, no TDS. Provided he should own less than or equal to 10 trucks and he should give a declaration and he should furnish a PAN. Very, very simple. Goods carriage. Other than goods carriage, ship, airway, school bus and all those things, 194C will come. Because this is only talking about goods carriage, not about passenger. Manufacture of a product, on the other hand, if the materials are supplied by customer only, I will supply a jewel worth 10 lakhs and I will ask you to work on that. Designing. I will give you a hard jewel. You will have to work designing and give me. When you give me the bill, people used to give 14 lakh, 15 lakh bill. 5 lakh is the working charges, 10 lakh is the jewel. TDS had to be applicable on the full amount because you had not separated it. That's why the government told kindly separate. Material cost separate, work cost separate. If you separate like that and give, you will only be charging TDS on the work portion. In my example, 5 lakhs. To avoid this, this is materials supplied by customer. To avoid this, what people were doing, they were asking the related party to supply the jewel. If I want a jewel, I'll ask my father to supply the jewel. If I am a company, I'll ask my holding company to supply the jewel. Like that, I was doing cheating. Because in that case, no TDS. Why? Because materials are not supplied by customer. It is supplied by somebody else. So an amendment came. Even if it is supplied by an associate of the customer as defined under 40A2, then it is deemed to be material supplied by customer and same provisions will apply. But if it is supplied some random third party, so I will go to Tanishq and say I want this design. So they will buy from somebody else, they will get it designed from somebody else and they will sell it to me. What TDS? When I am paying Tanishq, should I deduct TDS? No, it's an outright sale. So that is regarding 194C. As far as gas or petroleum is concerned, let's say Indian Oil Corporation is producing gas and sending the gas till your factory. Now the question is, I have hired some trucks to transport the gas. If I own the trucks, then it's sale. But if I hired the trucks, even though the trucks, I have rented the trucks out every day, but those trucks are in my premises always, they'll be in my factory always. It's as if I own the trucks, but I've taken it on a contract. Hence, the law in the court case, it was there. They said it is 194C. It is 194C. Next, coming to 194I, rent. Any person other than individual or HF, but individual or HF, that is big individual also has to pay 194I. Individual turnover is more than 1 crore, gross assets in a profession more than 50 lakh, TDS is required. Pay will be a resident person. What is it? Rent for building, land or both, or furniture or fixtures, 10%. Plant and machinery and equipment, 2%. Aggregate amount should be more than 2,40,000 rupees per annum. Aggregate amount more than 2,40,000 rupees per annum. Rent. What are the adjustments in the exam? Rent can be lease, sublease, tenancy, agreement, arrangement, everything. Rent can be maintenance charges. It can be municipal taxes. Municipal taxes paid by tenant, no TDS. Municipal taxes paid by owner or included in rentals, everything 194I will come. Because municipal taxes paid by the owner here and included in the rentals. So 194I will come on that because it's part of the rent. But municipal tax paid by tenant himself, no TDS. Then if you want to take warehousing charges, cold storage units, I already told you it will come under 194C. It will not come under 194I. But normal warehouse will come under 194I. If I have partly hired a building or land, lawmaker uses the word any land or any building, hence 194I will come. If I have paid an advance rent for 3 years, let's say every year is 6 lakh, I have paid advance rent of 6 lakh into 3, 18 lakhs. 3 years. So 1.8 lakh TDS will be apportioned across 3 years, 60,000 per annum. If rent, joint owner, rent is paid 3 lakh rupees, but it is paid 1.5 lakh to one person, 1.5 lakh to the other person, Mr. A and Mr. B, no TDS. Why? I should take per person there. Deposit, refundable deposit if I have taken, interest bearing deposit, 194I will not come, 194A will come because interest is given there. Non-interest bearing deposit, no TDS. If it's a non-refundable deposit, then 194I will come because again it is non-refundable as such, it is deemed to be rent. Airport, mall, all these, food people who hire like for example, Subway has or California Burrito has hired a space in an airport or a mall to sell their stuff, food stuff, that is 194I. On the other hand, the airlines have to pay some landing charges, parking charges to Airports Authority of India. Is that rent of land? Yes, it was D, or is it like 194C or 194I? So they said, since it involves many things, traffic services, safety services, your aeronautical communication, navigational services, it will come under 194C and not 194I. Similarly, from the passenger, they will collect something called CUTE fee, common user terminal equipment fee, then passenger service fee, metal detectors, escalator, conveyor belt, all these things. In Jet Airways case, they told it is 194C and not 194I. I am not renting the space, I am giving all these services. Similarly, there will be a house, on the house there will be a telecom tower, right? So on the telecom tower, is, some company owns that tower, they will be paying rent to the owner. Is it 194I? Yes. But this telecom tower, that passive infrastructure facility, they will give it to various people. They will give it to Airtel, Jio and all these people. Now is that 194I or 194C? It went to the court. They said it is renting of machinery and it will come under 194I. What rate? 2%. It will come at 2% rate. These are all the various examples you can give. Then any long-term lease, 20 years lease, 30 years lease, where you have to refund that after 20 years, then that is not rent, no TDS. Hotel accommodation. If I fix 2 rooms for 8 months at a fixed rate, regular rate, whether I come there or not come there, it's already fixed. 2 rooms already ready for me for 8 months, 194I, because regularly hired. On the other hand, if I strike a deal with you, whenever I come, you should give me this rate. I may come, I may not come also, but I will assure you I may come for around 1 month, but it's not sure. But if I come, you should give me this rate. That is arrangement for a discounted rate. No 194I will come because it's an arrangement at the end of the day. You would have seen a lot of hoardings, billboards, etc. outside. If I had made a direct deal with the owner, then it's an advertisement contract under 194C. Otherwise, it will be like a subletting. Basically, I have taken on rent that particular billboard and I am renting it out to you. Then it will be under 194I. Zoom car, etc. Drive C, without chauffeur, without driver, without fuel, whatever self-drive vehicle if I am taking, 194I will come. On the other hand, if I am hiring Ola Cabs taxi agency, So a company enters into a contract with Ola Cabs for supplying, what do you say, some 10 cabs every day to ferry their employees. That will come under 194C. Now 194IA is there. That is what? If you are buying a house in the future and if it is happening to be more than 50 lakh rupees, then you have to deduct TDS. This will be at 1% of either the sale consideration or SDV. And it should be more than 50 lakh rupees. It should be more than 50 lakh rupees. And in immobile property, rural agricultural land is not covered. Rural agricultural land is not covered, but urban agricultural land, if it is more than 50 lakh rupees, then it will be covered. 100% it will be covered. Coming to 194J. 194J is for professional, technical and managerial services. Professional, technical and managerial services. What is the rate of tax in 194J? What percentage? Let me come to that. Yeah. 2% in case of technical services, not being professional services. If it is royalty for sale, distribution or exhibition of cinematographic films, 2%. If it is engaged in the business of call center only, 2%. In any other case, 10%. So 2% only in 3 cases. Technical services, not being professional services. Second one, royalty for sale, distribution or exhibition of cinematographic films. And third one, business of call center. Then it is 2%. In all other cases, 10%. But if you see, it is also applicable for a person. 194J is also applicable for a person, deductor whose income is more than 1 crore turnover or profession 50 lakh. So interesting to know, if he is hiring professional services, if he is providing professional services, hiring professional services, aggregate value less than or equal to 50 lakh, 194M will not come, 194J also will not come. But if it is more than 50 lakh, 194J will not come. But since he is a big individual, 194M will come. But if he is hiring technical services, if it is less than or equal to 50 lakh also, more than 50 lakh also, 194M will not apply. 194M will not apply. If the value of the service is more than 30,000, then 194J will apply. Because in professional service, technical service, etc., it is what? 30,000 is the amount. 30,000 in a year. Mind you, 194J is for the following payments: fee for professional services, fee for technical services, royalty for that movie, etc. Non-compete fee. Non-compete fee we had seen in 28(5)(a). That is, do not share the know-how, do not work elsewhere, work only here, be a full-time consultant. That is called non-compete fee. 28(5)(a). And any remuneration or fee or commission to a director of the company other than those covered under the head salary. This is your sitting fee. Sitting fee. What should be the amount, guys? More than 30,000. One interesting question they can ask you. Director got a sitting fee of 29,000 rupees. Will TDS apply? Director got a sitting fee of 29,000 rupees. Will TDS apply? TDS will apply because that 30,000 rupees limit is only for 1, 2, 3, 4. That's it. No TDS if the amount does not exceed 30,000. Above limit is only for 1 to 4. For sitting fee, entire sum will be subject to TDS without any limits. Without any limits. Entire sum shall be subject to TDS without any limits. So professional services means legal, medical, engineering, architecture, or any profession of accountancy, etc. Will also include sports persons, umpires and referees, coaches and trainers, team physicians, event managers, etc. The payment to Arsha Bogle will be under 194J. Payment to Matthew Hayden will not be under 194J because 194J is only for residents. So payment to Matthew Hayden will be under 195, foreign taxation. Sports person, payment to Virat Kohli, 194J. Payment to Josh Butler, not under 194J. Payment to an Indian umpire, 194J. Foreign umpire, 195. So all that you need to see. So any payment made to software, etc., there will be no TDS if you have just bought the software and selling it to India. When I bought the software, I would have paid anyway TDS. Then I'm selling it to other people. But if I buy the software, make some changes in it and then sell, for both the transactions, TDS will come. One, buying from abroad. Second, selling it to you, TDS will come. So that is regarding software. Then for third-party administrators like insurance companies, if HDFC Ergo is an insurance company, there will be a third-party separate service provider in the hospitals. So if you fall sick, you will have to go to the third party administrator. They will directly settle payment to the hospital. Because hospital cannot wait for longer. No, you will have to be discharged. Only if you make payment, you will be discharged. So the third party administrator will directly make payment to the hospitals. And they will take money from HDFC Ergo later. The question is, when the third party administrator is making payment to the hospitals, will 194J come? Because hospital has provided what service? Professional service. This is medical service. The issue went to court, then a lot of circulars came. They said yes. Instead of insurance company, who is giving? Third party. So third party administrator has to deduct TDS while making payment to hospitals. They have to make payment to hospitals. That is regarding 194J also. Very, very simple. Then we will see certain things here. This is my $194O. Very simple. E-commerce operator, you have Amazon, etc. And in Amazon, you will have both seller as well as buyer, as we know. Seller is called as e-commerce participant. Amazon is the e-commerce operator, can be resident or non-resident, and buyer can be anybody. Now the question is, seller is selling goods and services to the e-commerce operator and then going to the buyer. Buyer will pay money and issue is closed. When the e-commerce operator is giving money to the seller, should he deduct TDS is the question. Answer is yes under 194O. Mind you, seller must be a resident in India and he is the payee. What should be transferred here? Goods and services. And e-commerce operator can be resident or non-resident. What is the TDS rate? 1% of the gross amount of sales. 1% of the gross amount of sales. Not net amount, nothing. Full. Whatever amount is sold, that full amount will come under this. So Sony India is selling TVs to Chroma and Chroma is selling to buyer. And when Chroma is making payment to Sony India, 194O will come. Sony Japan is selling TVs through Chroma. When Chroma is selling to buyer, when Chroma is making payment to Sony Japan, 194O will not come because the payee must be a resident in India. So here 195 will come. Sony India is selling TVs to Walmart USA. Definitely 194O will come because Walmart USA can be resident or non-resident, doesn't matter. But individual, if he is selling less than 5 lakh rupees, 194O will not come. So if an individual is selling some perfume through Amazon and it's 4,95,000 rupees, payment made to individual 4,95,000, it will not come. On the other hand, if you are a partnership firm, the exemption is only for whom? Individuals, not for partnership firm. That is the gist of 194O. Next is 194Q. 194Q is for the big buyer of the goods. For the big buyer of the goods. So, P is a seller, is a resident. He is selling goods, not services, selling goods to value more than 50 lakh to a buyer. Who's a buyer? Who's a deductor? He can be a resident or non-resident who has a permanent establishment in India. And I told you 194Q is for big buyer of goods. So turnover or gross assets from business should be more than 10 crore in the immediately preceding financial year. Big buyer. So if the seller is selling more than 50 lakh to a big buyer, TDS has to be deducted under 0.1% of the sum exceeding 50 lakh. 0.1% of the sum exceeding 50 lakh. At the time of payment or credit, whichever is earlier, 0.1% of the sum exceeding 50 lakh rupees. That is one part of the story. On the other hand, if you see TCS provisions, TCS is what? Tax collected at source. Tax collected at source. In this, when the buyer is buying and paying money, the seller has to collect then and there only and remit to the government. So we have 206C1, 1C, 1F, 1G, 1H. So 206C1 only talks about TCS at specified rates. Buyer will be any buyer except state government, central government, public sector, company, etc. Seller will be any seller, CG or SG, local authority, corporation, any company, or big sellers. Individual HF whose turnover exceeds 1 crore. Same dialogue. Now these rates you have to remember. Alcoholic liquor for human consumption, 1% if pan is furnished. Pan is not furnished, 5%. Tendu leaves, 5%, 10%. Timber obtained under a forest lease, 2.5%. Scrap, 1%. Minerals, 1%. You have to remember the rates and the amounts and the nature. 206C, 1C. This is on certain contracts. What contracts? Parking lot. Nature of contract or license, parking lot. So I will give you parking lot license to you. When you are paying the money, I should collect extra TCS. How much? 2%. Toll plaza, 2%. Mining and quarrying, 2%. Motor vehicles. Every person being a seller receives any amount as consideration for sale of motor vehicles, value exceeding 10 lakh rupees. Value exceeding 10 lakh rupees. So buyer will not include state government and all that. Now, TCS applicable only at all retail level sales. So a Mercedes manufacturer is selling to luxury motor car dealer at 400 crore. TCS under section 2061F will not come. Luxury motor retailer is selling to Mr. PJ 80 lakhs vehicle. So yes, TCS at 1% will come for more than 10 lakhs. On the other hand, TCS is applicable on sale of any motor vehicle. They never say luxury motor vehicle. Any vehicle exceeding 10 lakh, ordinary or luxury. TCS is applicable on each sale of motor vehicle and not the aggregate value of sale during the year. So if I sell 7 lakh, no TCS. If I sell 6 lakh car, no TCS. It's not on the aggregate value, it's on each sale. But if I sell 60 lakh car, if I buy, but I give different payments, 5 lakh and 55 lakh, will TCS come on each payment? Yes. Even though this is less than 10 lakhs, you should not say TCS will not apply. TCS will apply. But if I buy different cars of less than 10 lakhs, TCS will not come. Then comes 206C1H. 206C1H is also selling of goods, but here you have a big seller, not big buyer. If you see the other section was big buyer. 194Q was big buyer. Here it is big seller. Seller is exporter of goods are not covered. Seller to collect TCS. Seller can be resident or non-resident. Buyer can be resident or non-resident. Value is more than 50 lakh. There also value more than 50 lakh only. Here if you compare, here buyer was resident. Seller was resident, sorry. Buyer can be resident or non-resident. Value more than 50 lakh, goods. And big buyer. Here it is big seller. And seller can be resident, non-resident. Buyer also can be resident, non-resident, no problem. Value should be more than 50 lakh, same thing, goods. Here, who is the seller? Gross receipts or turnover from business should be more than 10 crore in the immediately preceding financial year. Buyer should not be an importer of goods. Buyer should not be state government, central government, etc. Buyer should not be local authority. Buyer can be resident or non-resident. TCS value is 0.1% of sale consideration more than 50 lakh. If TDS provisions are already applicable, then TCS will not apply. Right? That's what it is. That's all regarding TDS, TCS, etc. And that interconnection and all, you leave it, guys. That is, they've given in the syllabus, stupid fellows, but no need. Right? So, on the other hand, if a luxury motor retailer is selling 80 lakhs, as I told you, to Mr. PJ, so here both will come, no? One is 206C, 1F also is coming, 206C, 1H is also coming. So the lawmaker has told TCS under 206C, 1F will come, 1H will not come. Because it's a specific section, will override the general section. Then these other cases you can just go through in the notes, otherwise not needed. That's about it, guys. That is about TDS, TCS. All the important sections you have anyway covered, just stick to that. And as I told you, there is a, 206 AA, 20% if PAN is not furnished. But exceptions are what? Lottery, etc. Rates are anyway higher. So if you don't furnish the PAN, don't furnish the PAN, tax rate will be 30% only. 194O and 194Q, it is 5%. And this is important, 192A, it is 42.744%. This is only for November 23. .74 because that also is changed to 20% later. That's fine. Normally they have made it off. Now it is 42.744%. 744%. Cool. So that completes all these areas. Other chiller areas you can go through on your own. That is what your setup, carry forward, all non chiller items. You can go through. Then your deductions. Please read deductions also. They are very easy. Just that you have to remember stuff. So we have finished all the heads of income. We have finished TDS is again important, and residential status also we have finished. Other smaller areas you can go through on your own. So all the very best. Return of income and all is very easy, guys. So all the best, guys. Do well, study well, right? So see you after the exams and see you in CA final. CA final, this whatever you studied, the father will be there. This 240 hours of classes. Okay. So fine. So online people, thank you for attending. Hope you understood. So all these videos will be uploaded because people are requesting my office calling up. So we'll upload it, no problem. Every day one. So the first video already uploaded, second will go today, third tomorrow, fourth day after tomorrow will be uploaded. It will be there only on YouTube. You can check out whenever you want. Okay. Thank you so much, guys. Take care. All the best. Do well. See you later. Okay. Take care. With a view to reduce the tax burden, persons have huge taxable income may shift a portion of their income to persons who do not have taxable income. Hence, the income derived by such other person may be clubbed with the transferor's income and be taxed so as to protect the interest of the revenue. And similarly, we have the Benami law as well to cover the same. So, as far as transfer is concerned, this transfer is covered under what? Section number 63 defines what is a transfer. We will see. And the transfer can be two types. One is what? Transfer of income without transfer of assets, or could be what? Transfer of asset. Could be transfer of asset. So transfer of asset also could be to spouse, could be due to son's wife, or it could be what? Other cases. Right? Other cases. So if it is, any assets which are transferred to spouse, and of course, guys, transfer here. Let's see section 63 just to understand. Whatever section I want, that only will not come. Everything else will come. Yes. Gives the transfer a right to shall be deemed to be revocable, and then transfer includes any settlement, trust, covenant, agreement, or arrangement. See, settlement can be a marriage settlement. Now, if the marriage settlement happens, will this clubbing come? We'll see. Trust, I will create a trust, a group of people, and I will transfer the assets there. That will look after some beneficiaries. Beneficiaries can be children, spouse. Covenant is a restriction or a benefit. For example, that's what, no? The grandfather will transfer the asset to me. Is it a benefit or a restriction? Benefit. But what is the restriction? Restriction is I need to transfer 50,000 rupees to somebody else. Covenant. Yes. Agreement or arrangement. Arrangement is something which has an oral agreement. Agreement here generally means written, but arrangement is what? It is an understanding. Need not be in writing. That is called arrangement. Just for your knowledge, these are all based on decided case laws. So obviously, rather than me going to each and every case law, I'm trying to tell you in the limited time that we have, 160, 170 hours, good enough for you to understand what all questions may come in the examination. Then, of course, revocable. We will see that revocable concept. Revocable means what? It contains any provision for retransfer of the asset back to you. Revocable. Or in any way gives the transferor right to reassume power directly or indirectly. So I can take back the power. That is called revocable transfer. That is the definition of transfer and revocable transfer. It is given here. So as far as spouse is concerned, it is 6414. Son's wife. Again, 1 second. For a spouse also, adequate consideration, inadequate consideration. Son's wife also, adequate, inadequate. So for adequate consideration, clubbing will not apply. If I give it on for the particular amount, whatever it is market value, why will it apply? It will not apply, obviously. Inadequate consideration, if I am selling a house other than house. For son's wife again, if for inadequate consideration, transferring a house other than house. Other than house. One is house, one more is what, guys? Other than the house. One is house, other than house. Sorry. Kulcha sim sim. So guys, if it is house, no, for inadequate consideration, there is a concept called deem owner under section 27. If it's other than house, we have section 6414. But for son's wife, section 27 will not come. 6416. Why? An individual who transfer otherwise than for adequate consideration means what? For inadequate consideration, any house property to his or her spouse. If you see the, what do you say? Son's wife is not covered here under section 27. We'll come to that later. So this is the overall structure. You should understand the overall structure. Right? Other cases. In other cases, I need to see whether it is revocable transfer. Again defined in, the revocable transfer is covered in section 61. Definition of revocable given in section 63. Irrevocable. Section 62. Exception to section 61. Income, transfer of income without transfer of assets. This is given under section number 60. So this, my dear buddies, is the entire scheme of things with respect to transfer. Similarly, now clubbing is also covered for minor children. Minor children is covered under 64(1)(a). We'll see that in a while. 64(1)(a) is for minor children. Are you with me? Yes, this is the entire scheme of things. The full structure should be in your mind. So when you say, okay, spouse, if it's inadequate consideration, for house, it is section 27 deemed owner concept, whereas other than house, this will come. All that logic we will see in a while. Now let's come to section one by one. Section 60. Divide and rule policy. Section 60. Come on. Chapter 5, income of other person including in assets of total assets total SSC's total income. Transfer of income where there is no transfer of assets. All income arising to any person by virtue of a transfer. We understood what is transfer. Whether revocable or irrevocable, I don't care. Whether affected before or after commencement, whether there is no transfer of assets, but where only income is transferred, will chargeable to the income tax as the income of the transferor and shall be included in his total income. So you see here, Mr. A was carrying on business, declares that the profit derived from such business shall belong to his brother. He will declare. Mr. B without transferring the entire business. So Mr. A says the whatever profits now, whatever it goes to my son. For example, I have a property. I will say the rent should go to my son. Actually, it happened. We were living in one of the rented premises when I was doing BCom, I remember. So that person, he was a ex-banker, retired guy, and he gave it to his son. Basically, it said, now the land, the owner, I am only the owner, but the rent is now to be given to son because son was not doing too well. Unfortunately, son passed away also recently. He was like, he's not old, but then of course he had some heart attack or something and he passed away. Nice guy. Sad. So if you see, yes. So the landlord has transferred his money, his source to the son. So that will be clubbed with the landlord or landlord's son only. It will be clubbed with the landlord. So will be clubbed in the income of Mr. A. What about this? MS Subbulakshmi, do you know? Correct. Singer. In lieu of amazing singer. Morning, morning in our South Indian homes. You know, your Suprabhatam will come. That is by the great MS Subbulakshmi. Suprabhatam. Yes. In view of the remuneration for acting in a movie, the producer granted the right to exploit the movie for a limited period in a defined territory. It was held that this was a transfer of asset and not income. Thus, clubbing under section 60 will not apply. So, instead of remuneration, they gave like a share of profit or exploitation. So, in this particular case, it was not clubbing at all, is what this particular court held way back. Clubbing of income in case of revocable transfer of asset. Revocable transfer. When there is a revocable transfer of any asset by a person to another person, any income arising from such asset shall be included in the total income of the transferor and taxed accordingly. Revocable transfer means an asset where the right to take back the asset is there. Example, you see, Mr. X transfers an asset to his friend. Why spouse not covered? For spouse, there is a specific section. For spouse, we have a specific section. So the specific section will override the general section, right? Right. So that is what section 60 says. 61 we are seeing. Mr. X transfers an asset to a friend, Mr. Y, with the condition that Mr. Y needs to return the asset after 10 years. In this case, transfer is called revocable. Though the income from the asset is received by Mr. Y, it is always taxed in the hands of Mr. X by virtue of section 61. But the exception is what, guys? Reverse. Exception is this. When the transfer is not revocable, means what? I will give the asset to you in an irrevocable transfer, which it cannot be cancelled. What is irrevocable transfer? Just let's check 61. All the income arising to any person by virtue of a revocable, 62. We'll see 62. Provisions of section 61 shall not apply, means what? Exception to section 61 is section 62. 61 is revocable, 62 is irrevocable. To any income arising to any person by virtue of transfer by way of trust, which is not revocable during the lifetime of the beneficiary, and in any case of any transfer, which is not revocable during the lifetime of the transferee. Before you leave that, transferor derives no direct or indirect benefit from such income in either case. So, if onion creates a trust, correct? He has an Irrevocable transfer means what? He will transfer the entire, what do you say, house property or whatever it is. So if you see one more, I'll explain both with an example. All income arising to any person by virtue of any such transfer shall be chargeable as income tax of the transferor as and when the power to revoke the transfer arises, and shall then be included in his total income. And shall then be included in his total income. He will transfer his house property to a trust, and this will be irrevocable transfer. So in this trust, the beneficiaries will be all girls whose names are Nandini. Don't ask the logic and all. It's just a stupid example just to make you understand. Everyone who's named Nandini, sir, from 20 girls will be there. He's looking after the education. Anyan has become very nice now. That is the trust. The house property, etc., has been transferred irrevocably. Correct? So obviously in this particular case, will the income be clubbed at the hands of Anyan? No. Because it very clearly says there, by way of trust, which is not revocable during the lifetime of the beneficiary. As and when those 20 girls, till they are alive, nothing will be taxed in Anyan's hand. The transferor derives no direct or indirect benefit from such an income. Benefit here should be looked at what? Financial benefit. Sir, Anyan is getting satisfaction of helping Nandini's. No. Right? Similarly, Anyan transfers his house property in the name of his friend. Irrevocable transfer. Friend's name is Ambi. Transfers to his friend Ambi. Irrevocable transfer. And transfer is what? During the lifetime of Ambi. During the lifetime of Ambi. Let's say he transferred it on 1/1/2012. Correct? Let's say Ambi dies on 10th April 2022. And Anyan takes back the house on 31st December 2022. Some 7-8 months later, he will take it back. Now, all the income that was deriving from 1st January 2012 to the date of death, 10th April 2022, will be taxed at the hands of Ambi only, obviously. That is what section 62 says. It's an exception to revocable transfer, section 61. But after he dies, the income will be taxed in Anyan's hands only because he's taking it back. Question asked in the MCQ. See, all MCQ questions I'm merging. Question asked in the MCQ is, will it be taxed from 10th April 22 or 31st December 22? 10th April 22 or 31st December 22. From which date? Income of from where will it be taxed? If you say 31st December 22, what will be, where will the income go? Whether it's tax free or taxable from April to December, what will happen? So if you see, check it out. It shall be chargeable to income tax as the income of the transferor as and when the power to revoke the transfer arises. Power to revoke, power to withdraw, power to take back the transfer, it will arise from which day? Arise from the date of death, obviously. The day Ambi dies, that is the day you have the power to revoke the transfer. The day Ambi dies, that is the day you have the power to take back the transfer. The power to take back the transfer. That is why 10th April 2022. 10th April 2022. I hope you are getting the point. Got it? That's what it is. So same here. Transfer is not revocable. Yeah, the transfer must not derive any indirect benefit from such thing. Exception is there. Income arising to spouse, son's wife, minor and HF to be clubbed under section 64. Income of spouse is covered under 64(1). So check it out. In computing the total income, so 64.1 will check. This is done. This is done. We have understood this one also. Easy chapter, but hidden points are there in MCQ. That's why I am doing it very much in depth. In computing the total income, this is 64.12 of the individual, there shall be included all income which arises directly or indirectly to the spouse of such individual by way of salary, commission, fees, or any other form of remuneration, whether in cash or kind, from a concern in which such individual has substantial interest. Provided that nothing in this clause shall apply to any income arising to the spouse where the spouse possesses technical or professional qualifications and the income is solely attributable to the application of his or her technical, professional knowledge or experience. And what do you mean by substantial interest? Substantial interest means in case where the concern is a company, shares carrying not less than 20% of the voting power, and in case of any other case, such person or one or more of his relatives are entitled in the aggregate at any time how much? 20% of the profits of the concern. 20% of the profits of the concern. And again, one or more of his relatives. And we have seen relatives means what, guys? Linear ascendant and descendant. So we'll take an example. Substantial interest. So I am reading this one now, point number A. Okay, come to F2, point number A. Where the remuneration is solely attributable to the application of technical or professional qualification, knowledge and experience of the spouse. Such remuneration cannot be clubbed. So the person is giving one, wife controls, let's say 40% of an entity, and the entity is giving money to the husband, 1 lakh rupees per month. Husband is 4th standard fail. What do you think? Depending on the technical professional qualification is 4 lakh rupees, 5 lakh rupees per month for a 4th standard fail. Is it valid or invalid? Invalid. So will it be clubbed in the wife's hands? Yes. On the other hand, if that person 4th standard fail happened to be Vijay Salagaonkar, Shyam, correct? Then deadly. Then obviously is brilliant. So yes, if you have the knowledge, qualification, etc., of course you can pay money to that person, doesn't matter. So it depends on that. Now if both husband and wife both have substantial interests in the organization and both are in receipt of remuneration, before that let's just see here. Substantial interest means this. Check example. Mr. Shah Rukh Khan and relative. Relative means what? Spouse, Gauri Khan, brother, sister, lineal ascendant, descendant. Has substantial interest in a company. Means what? What is substantial interest? Come here. In a company, more than 20% equity shares is held by whom? Shah Rukh Khan and the relatives. Then, if it's a firm or LLP, 20% of share in partnership. Employees. So, this is a case where Shah Rukh Khan employs whom? First, employs Mrs. Gauri Khan, wife of Mr. Shah Rukh Khan, an interior designer for a salary of 5 lakhs. Salary of 5 lakhs. She's anyway an interior designer and this is a company which is interior designing. Does she have adequate qualification? Yes. So if you see the arrow mark, salary income of 5 lakhs is not clubbed in the hands of Mr. Shah Rukh Khan. On the other hand, if Mrs. Gauri Khan, assume, was not qualified, then this 5 lakhs would be clubbed in the hands of Mr. Shah Rukh Khan. Now the question will arise, Shah Rukh Khan or his wife also substantial interest. So if both have substantial interest, what to do? That is point number 2. If both husband and wife have substantial interest in a concern and both are in receipt of remuneration from the concern and both do not possess any skill, both are chapper fellows, then such income will be included in the hands of that individual whose total income, excluding the income to be clubbed, is greater. So Shah Rukh Khan is earning, let's say 10 lakhs and this income is 2 lakhs and Gauri Khan is earning 5 lakhs and this income is 5 lakhs. Correct? Now in this case, both are what? Or this is, let's say 6 lakhs from the interior designing company. both do not possess any skill, and both are in receipt of remuneration, both have substantial interest, then I should, if you think about it, here it is 12, or let's make it 9 or 8. Here it is 10, here it is 11. So should I club it in the hands of Gauri Khan? No, check it out. Both husband and wife have substantial interest and both are in receipt of remuneration and both husband and wife do not possess any skill. Such income will be clubbed in the hands of that individual whose total income excluding the income to be clubbed is greater. So Shah Rukh Khan's total income is 80 lakh, Gauri Khan is 5 lakh. Ignore 2 and 6. This 6 lakh will be clubbed in whose hands? Shah Rukh Khan's hands. So Shah Rukh Khan's income will be 8 plus 2 plus 5. Sorry, plus 6 is 6 only, no? 8 plus 2 plus 6. 8 plus 2 plus 6. And once it is clubbed in Shah Rukh Khan's hands, can it be shifted to Gauri Khan is the question. So once income is clubbed in the hands of either spouse, it shall continue to be clubbed in the hands of the same individual in any succeeding year unless the assessing officer is satisfied after giving to that spouse an opportunity to be heard that it's necessary to do so. So if you see, if the AO feels that no, I should now shift the clubbing burden, etc., he can do so. But principles of natural justice have to be followed. Reasonable opportunity of being heard, PONJ, has to be followed. Husband means what? We have seen already. Second, where an asset is transferred to the spouse by the individual otherwise than for adequate consideration or in connection with an agreement to live apart, the income arising from such asset also will be 6414. 6414. So guys, this is what? Where asset is transferred to the spouse by an individual as a C. Otherwise than for adequate consideration. Otherwise than for adequate consideration. So if you see, for 6414, two things are not covered. One, agreement to live apart. And second, asset is transferred to the spouse by the individual SSC. Asset is transferred to the spouse by individual SSC, all other cases. So if you see, you see that wordings of the section subject to the provisions of 27.1. The spouse of such individual from assets transferred directly or indirectly to the spouse by such individual otherwise than for adequate consideration or in connection with an agreement to live apart. So if you see here in the chart, adequate consideration means clubbing will not come. And one more thing, spouse here. Agreement to live apart. Clubbing will not come. So husband or let's say wife gives husband a house as part of the agreement to live apart. Wife is earning really well. Husband is BCom husband, house husband. Correct? We'll tell housewife stupidly. No, he is house husband. So he will get one house because he is house husband. So what is that? That clubbing and all will not come because it's an agreement to live apart. Divorce proceedings. On the other hand, if there is adequate consideration, no problem. The husband has paid money, market value that too, properly paid through banking channels, no tension whatsoever, then what's the issue? So there is no beyond arm's length price and all that. It is within arm's length price, absolutely no problem. But it's inadequate. Now if it is a house, 6414 will not come. That's what they are trying to tell. Because it says subject to section 27. Section 27 is deemed owner. So if for example husband has property PQRS, right? So RS he will show in his books, PQ, correct? R and S he will claim as what do you say? Self-occupied. Wife will claim PQ as self-occupied. Husband is claiming RS as self-occupied. Wife is claiming PQ as self-occupied. Problem. So what happens for a husband's annual value will be nil. Wife also annual value will be nil. So even under clubbing, if I use 6414 and club the wife's income in husband's hands, husband income in wife hands, whatever it is, annual value will be nil because I'm using it as residential property, self-occupied. Hence, this was happening, guys. That is why they inserted one clause called what? Subject to section 27. Because if you go to sub 27, what does it say? For the purposes of 22-26, an individual who transfers otherwise than for adequate consideration any house property to his or her spouse, not being a transfer in connection with an agreement to live apart, as discussed. If it's an agreement to live apart, no problem. But if it is not agreement to live apart, or to a minor child not being a married daughter, shall be deemed to be the owner of the house property so transferred. So guys, in this case, husband will be the owner of all PQRS. So for RS, it is self-occupied property. For PQ, it is deemed let out property. And of the four, they have to calculate whichever is higher, he has to pay. As per law, deemed let out. Why deemed let out property? Because you are a deemed owner under section 27. Because people were clubbing nil income in each other's hand, section 27 was inserted, and in 6414, this amendment was made. So that is why this is the logic. When house is transferred, section 27 will apply, 6414 will not apply. When other items are transferred like gold, whatever, then 6414 will come into the picture. Got it? Let me change the battery. Yes. Now you know. Good. Okay. Notes to B above, which is B, this only, guys. Come down. Everything in a structured format I've given, nothing to worry. Concept of deemed owner, explained in section 27, I already did now. The marital relationship between husband and wife should exist both at the time of transfer of the asset and the time of accrual of income in order to attract clubbing provisions. So basically, if what they're trying to tell is, if I give my house to my fiance and later the rental income she's taking, will the clubbing provisions apply? No. Similarly, son's wife is also there. No. If the father-in-law or mother-in-law gives the asset to prospective daughter-in-law, will clubbing provisions apply? No. Check. Miss Alia received a gift of 10 lakh from her boyfriend, Mr. Ranbir. After they both got married, Mr. Ranbir gifted Mrs. Alia another 5 lakh. In this case, the first 10 lakh will be taxed in the hands of Miss Alia only, as there was no marital relationship. Before marriage, no marital relationship. After marriage, along with marital, change the wordings, martial relationship also. Karate. Right? Yes. Shh, don't tell anybody. Yeah. Then what? No marital relationship between Miss Alia and Mr. Ranbir. However, 5 lakh will be taxed in the hands of Mr. Ranbir, as Miss Alia and Mr. Ranbir were married, and this was transfer of asset without consideration to spouse. Sir, Alia will earn more than Ranbir. Don't connect it to the film actors. Just an example, guys. Income on the asset transferred is clubbed, but not income on the accretion to the asset. Accretion means addition. So I will gift gold to you. You will keep gold and then get some, let's say I will transfer some 10 lakhs to you. With that 10 lakhs, you will go buy debentures. Correct? Income on the asset is clubbed. Or let's take a simple example. That other part I'll come later. I'll transfer my house to you. You will get rental income. That rental income you will go and deposit in the bank. Bank will give you FD interest. Will that also be clubbed? No. Income on income is not clubbed. Mr. Mota, an individual transferred a flat to his wife, Mrs. Moti, okay, who derived rental income from the flat. Such rental income will be clubbed in Mr. Mota's hands. However, Mrs. Moti invested such rental income in fixed deposit and derived interest income from such fixed deposits. Such interest income cannot be clubbed in the hands of Mr. Mota. Hence, income on the asset is transferred is clubbed, but not the income on the accretion. So, Mrs. Moti, if she is waiting in the bank, it is called motivating. PJ. Sorry. Correct, no? Yes or no? Moti, waiting in the bank, motivating. Where an asset transferred by spouse is converted to another form, income derived from such converted asset also shall be clubbed. This I can give you an example. I gave you money. Money I didn't put in the bank. I bought some debentures from that. And from debentures I started earning interest. Yes. Allowed. I mean, it will be clubbed. Mr. Vyas gives a sum of 50 lakh to Mrs. Vyas on the occasion of wedding anniversary. Mrs. Vyas invests the sum in a fixed deposit, which derives interest income of 25,000 per month. The income so derived shall be clubbed in the hands of, despite the fact that it is the income of what? Converted asset. Converted asset allowed. Income of income not allowed. I have made a animation video, just like you saw for movie producers, etc. That movie thing. Here also I have made. I have not made for minor and all, that's easy. I have made it for these things. It will help you. I'll play it after that. Don't worry. Yeah. If any individual transfers any asset to any person without or for inadequate consideration for the benefit of deferred benefit of spouse, then income shall be taxable in the hands of the transferor. What is this? What is this? So this is 64, 1, 7 and 8 for son and son's wife both. Here any person should be read as wife, spouse, son's wife. So make that change addition here. So what used to happen was husband used to create a trust and transfer money into the trust, and trust was paying the money to whom? To the wife or the son's wife. Let's say after investing that money for 15 years. 15 years later, it would go to the, this thing, what do you say? Wife. Now, issue went to court because assessing officer clubbed this income. He said, I am not giving to the spouse or, what do you say? Somebody else. I am giving it to a trust. Issue went to court. Court said, yes, you are right. So they did not like it. The government, the lawmaker did not like it. That's why he inserted this provision. Now, any individual transfers any asset to any person, that is spouse or, sorry, not this guy, sorry, my bad. It's given here only, no, spouse. Here you write spouse or son's wife, my bad. Spouse or son's wife. This for any person, please write down trust /AOP/BOI. My bad. Here you write down spouse or son's wife. Here any person within bracket trust /AOP BOI. Son's wife, same point is covered here. Son's wife, same point is covered here. Where if an individual transfers any asset to any person, like for example trust AOP BOI, without or for inadequate consideration, either zero consideration or inadequate, for the benefit of deferred benefit of son's wife, such income from the asset, whatever the trust is investing, whatever income comes, shall be taxable in the hands of the transferor. Very much so. Shall be done so. So direct transfer, indirect transfer is also covered in all these things. So if I transfer to my wife and wife will in turn transfer it to my the daughter-in-law, covered. Or indirect transfers are also covered. Only legal separation between the spouse could avoid clubbing. In case of transfer of property in a very voluntary agreement to live apart, clubbing will apply. So voluntary agreement, they they are talking about legal separation. So separation must be legal. Voluntarily, if you say that no, I don't want to, it's a social obligation, I don't want to live with you, different. It should, like they fight, couple fight and the husband runs away, when the wife runs away, then they'll live apart for some time. That is not covered here. Clubbing will still apply. The exemption will not apply. Clubbing will apply. But if it's a legal separation, divorce, then yes. One of my friends went through a bad divorce, I remember. So they lived apart for around 1 year till the case was going on, and then the court granted the divorce. So for that 1 year, will clubbing apply? Yes. After 1 year, once the legal separation is done, clubbing will not apply. Where the wife saves money out of the money provided for household expenses, called pin money, which is called pin money. Yeah, the amount will not be treated as assets transferred by the husband, and clubbing will not apply. Like I remember, my mom is a homemaker. I will never call anybody housewife. Homemaker. Homemaker's job is the most difficult job because it is 24 hours, 7 days a week, no break, no sick leave, no remuneration, no appreciation, nothing, only depreciation. Right? So my dad used to pay some money to my mom, and my mom used to save up something. I still remember, very sweet of her to do it. On his 60th birthday, when he retired from forest service after serving almost 40 plus years. He joined the service at 18. So 42 years of service to the Indian Forest Service, Karnataka Forest Department. My mom gifted my dad, out of the pin money that he had given her, a nice, leather, couch, recliner. So in these movie theaters, PVR and all that, gold class, if you go, that recliner will come, an automatic recliner. So that we got for him. That was purely from the savings that she had made. Now tell me, if the dad keeps on paying some money, is that also clubbing? No, that's what they're trying to tell. Natural love and affection may be good consideration, but not adequate consideration for the purpose of 64(1). So in Indian Contract Act, section 25, they say agreement without consideration is void ab initio. Any agreement without consideration is void ab initio. But there's an exception in section 25 of Indian Contract Act. That is written and registered agreement arising out of natural love and affection between the parties. So one of the examples that was, Rajluki versus Bhutnath, one case law is there. CA Foundation, I'm doing a recap. So their husband could not take the torture of the wife. Husband said, hey, please shut your mouth, I'll give you some 20,000 rupees per month. So quarreling, constant quarreling. So the husband started giving money to the wife. If it was not written and registered, then agreement is void. Balfour versus Balfour, if you remember. But if it's written and registered, still is it valid or void? Still it is void. Because here written and registered agreement was there, but it was not arising out of love and affection. General rule, agreement without consideration is void. Exception, written and registered agreement arising out of natural love and affection. So when there is social obligation, Balfour versus Balfour, no contract. Even if there is a written and registered agreement, if there is no natural love and affection, then it will be what? Still it will be void. That is why, taking the features of Contract Act in this case law, they are telling that natural love and affection may be good consideration. Because there is an exception under section 25 of Indian Contract Act. It is not adequate consideration for the purposes of 64(1). Correct? Basically here what happened was, one fellow gave the free asset free of cost to the wife. Assessing officer clubbed the income. He said, no sir, consideration she has given. What consideration? Every morning she gives me food. She takes care of my family. She takes care of me. She takes care of my children. So that's adequate consideration. For that I am giving. The court said, hey, cheating. Because love and affection cannot be measured. Unconditional love and all, you'll tell, no, all that, yes. Unconditional love. See, we can be good with, we can change our accent, change our English as well. With some classy people generally who meet, we say unconditional love and affection. With normal people, our friends, love, oh, love, we are doing all that. Okay, so keep changing, guys. Come on, we should be like chameleons. Keep changing and mingling with people. Even my T-shirt is like one gift wrapper, correct? No, I'm seeing now in the screen. Looks like some gift wrapper, full shining. Obviously, it has to be the gift wrapper because I am the gift. Yes or no? Yes. I know you're clapping there because of this dialogue. I am the present. So obviously, it should be wrapped by a gift wrapper. Yes. Sir, color dress and all you come and wear. Fancy dress competition. Are you a teacher or a fancy dress fellow? Everything. Yes. So, natural love and affection will be good consideration, but not adequate consideration. Throat is full gone, guys. Excuse me. This mic captures everything. So if I'm drinking, the water going inside, everything will come. Yeah, that is what it is. Now, what used to happen? Can I do this? Husband gives a loan. Smart boy. Loan to wife. Wife buys some debentures. Debenture will fetch interest. Interest, can it be clubbed? Please see here. Asset is transferred. Loan is not an asset. Loan is not an asset. Important point here, already given. All these they'll ask in the exam, MCQ. Husband gave a loan to wife at 0% interest. Oh, suddenly inadequate consideration. Gave a loan, irrevocable transfer. Oh, irrevocable 62. Guys, do not go to 61, 62. That is why it says other cases. Other cases, revocable, irrevocable, yes. Here you see, for spouse, I don't care. For spouse and son's wife, I don't care. Specific section will override the general section. So for spouse or son's wife, whether it's revocable, irrevocable, all this should not matter. Specific section will override the general section. What if an NRI gives some shares to the wife? So guys, wife of an NRI, but the company is Infosys. Infosys shares if I give, again, if you go to section 9 of Income Tax Act, any income arising or deemed to accrue or arise in India will be clubbed. So, if a non-resident gifts shares of Infosys to wife, since shares of Infosys is from, it's a resident because the office is in India. Correct? So it is deemed to accrue or arise in India and hence clubbed. Hence clubbed. So similarly, you see, I think there was a question also. See this. Mahesh and Madhunika are non-resident living in Amsterdam. They have interest in rental income in India as well as abroad. Minor child Kai is living with grandparents. Okay, this is the children, so we'll see that later. This is for the wife, 64 one. We'll come to 1A and see that later, don't worry. So this is Govindram T. Jarani, case law, New Delhi. Govindram T. Jarani. See all that I've written it down. Analysis. Correct? Govindram T. Jarani. An individual asset transfer an asset without or for inadequate consideration of the son's wife, any income derived from such will be taxable in the hands of the individual. If any individual transfer any asset, this we have told. For the future thing, yes. On the other hand, (64), 1, 4, and 6. Any asset if I'm using it as a capital contribution in a partnership firm, what to do? Asset which is transferred. Like for example, money. Husband gives money to wife, or wife gives money to husband. Husband uses it as a capital contribution in a partnership firm, or he can invest in business. Money, for example. If it is invested in business, the proportionate income is clubbed. For example, I gave money 2 lakh. You invested 6 lakh, out of which this 2 lakh is also included. Correct? And you derive for the entire income, you will derive some 60,000 rupees income. So what is it? 60,000 rupees income is for full 6 lakhs. So for 2 lakhs, how much is it? 20,000 rupees will be clubbed. Proportionate like that. No, it should be clubbed. But if you put in the capital contribution in a partnership firm, income derived from the partnership firm, income derived from the partnership firm, income derived as salary, no clubbing, because guys, salary has got nothing to do with the money that you have pumped in. Income derived as what do you say, share of profit. Guys, if you know, share of profit is an exempt transfer under 10(2)(a), anyway exempt, so it will not come. What is clubbed then? Any interest on capital. We have seen, no, in partnership firm, interest on capital. This only will be clubbed. This only will be clubbed. Hope you got it. That is the part that would be clubbed, nothing else. Same thing given here. Transfer asset by individual to spouse, son's wife without or for inadequate consideration. Yes. Income from the business, my example 60,000 into value of transfer 2 lakh by capital of the business 6 lakh. Mr. Bun, Mr. Hun. See, same thing. Profit is 3 lakh. Profit taxable in Mr. Hun, 3 lakh into 2 lakh by 7 lakh. 85,115. Other one is remaining amount. Clubbing provision shall not apply when the gifted amount is not part of the opening balance of capital, because guys, see here, it says capital of business on the first day of the previous year. Here on 1/4/2021. If she had gifted on 15th April 2021, right? Then this both was on 1st April. That's why I took, overall 7 lakh. If this was gifted on 15th April 2021, and for the year 21-22, this gift of 2 lakh will not be considered. It will be considered for the next year, 22-23 onwards, it will be considered. Hope you understood that. Right? So basically here, very clearly, capital of the business on the first day of the previous year is what you should consider. In my example, Bun and, got the amount on 1st April. Assume she got it on 10th April. When I do the denominator here, generally I take 7 lakhs, right? So here 7 lakhs will not come that year. 7 lakhs will come next year. So keep that in mind. Right? So all these things. HUF also similar thing, cross transfers. And one important, this whatever I've given, no, extremely important. Pointers for MCQs. General law applicable to the clubbing, for clubbing of income. So let us now do for minor child. Okay, minor child will do. Before minor child, I will show you the video for what? I will show you the video, as I told you, to revise till now whatever we have done. Correct? This video is for us to revise. Till now whatever we have done, we will revise.
Hello, my dear friends. As you know, a person is taxed in respect of his own income. But what happens when the taxpayers make an attempt to reduce their tax liability by transferring their assets to their family members like father, mother, brother, sister, wife, etc., such that they can continue to enjoy the benefits? In order to curb these practices, the Income Tax Department introduced the sections 60 to 64, and these provisions are called clubbing of income provisions, which is very important for CA Inter and CA Final. Hello my dear friends, my name is Punarvas Jayakumar and welcome to my YouTube channel Punarvas Jayakumar Classes. Today we will be discussing some interesting aspects in clubbing of income. Before we begin, I request you to please subscribe and hit the bell icon so that you can always be updated about such videos. Let us see some interesting illustrations to understand the concept of clubbing. Let's do it. If a husband transfers his house worth 1 crore to his wife without adequate consideration, let's say for 10,000 rupees, then the income generated from that house, that is the rental income, would be clubbed, that is added to the husband's income. Clubbing would still apply if the asset is given to the daughter-in-law instead of wife. Rental income would be clubbed with the father-in-law's income. If the husband transfers his house to his wife and the wife in turn transfers this house to their daughter-in-law, would clubbing provisions apply? Yes, because section 64 subsection 1 clause 6 covers direct or indirect transfers, and here there was an indirect transfer. However, if the wife buys the home for 1 crore rupees from the husband, there would be no clubbing because this would be adequate consideration. Also, if the husband has given his house as part of divorce proceedings, that is alimony, then there would be no clubbing as well. In order to circumvent these provisions, an individuals used to form a trust in which the beneficiary is the individual's wife or his daughter-in-law. The individual then used to transfer a house valued, say 2 crore, to the trust for just 10,000 rupees. Let's say the house earned an income of 10 lakh rupees every year, which has, as per the trust deed, accumulated for around 15 years, and then the amount of 1.5 crores would be paid to the beneficiary, that is the wife or the daughter-in-law. Would this income be clubbed with the individual? The Supreme Court said that the income was accruing to a trust and not to the wife or the daughter-in-law. In order to nullify this Supreme Court judgment, lawmakers brought in 6417 and 6418 to include association of persons as well. For example, trusts. So, now the income of the trust, that is 10 lakh rupees per annum, will be clubbed in the individual's hands from year number 1 itself. Very nice examples, don't you think? Let us see some more interesting examples, my dear friends. A husband gifts his wife some gold. Wife sells this gold and buys shares of a company. Will the dividend income received on the shares be clubbed with the husband's income? Interesting to note that the clubbing shall continue to apply even if the transferee has converted the transferred assets to some other form. So in this case, the dividend income would be clubbed at the hands of the husband. The husband transfers 2 crore worth of debentures to his wife, which fetches a rate of interest of, let's say, 10%. The wife will earn an interest of 20 lakh rupees. She deposits this 20 lakh rupees and creates a fixed deposit on which she gets an interest of, let's say, 1 lakh rupees. Would this 1 lakh be clubbed in the hands of the husband? It is interesting to understand that the income arising out of income earned on transferred assets will not be clubbed. Therefore, this fixed deposit interest of 1 lakh rupees will not be clubbed. Yes, my dear friends, Income on income will not be clubbed. Next example. Husband gives his wife 10,000 shares of X Limited. X Limited issues bonus shares of, let's say, 1,000 to the wife. Now the wife sells these 1,000 bonus shares in the open market. Would the capital gain arising out of sale of bonus shares be clubbed at the hands of the husband? The law says income arising from accretions, that is, additions to the assets transferred, will not be clubbed. Next example. The husband gives an interest-free loan of 1 crore to his wife. The wife deposits this amount as a fixed deposit and earns an interest of 10 lakh rupees per annum. Would this 10 lakh rupees be clubbed in the hands of the husband? It is very interesting to know that loan is not considered as a transfer. Clubbing will apply where assets transferred by the individual to spouse. Assets must be transferred. Giving a loan is not considered to be transfer of assets. But instead of a loan, if the husband had gifted the same amount, then the income of 10 lakh rupees would obviously be clubbed at the hands of the husband. These were just a very few examples, my dear friends. There is still a lot more to learn in the chapter of clubbing. Please support this initiative by liking, subscribing, but more importantly, commenting below if you want part 2 of clubbing chapter. And also let me know what other concepts you want me to handle. Thank you so much, my dear friends, for all your love. Love you all. Punarvas Jayakumar signing off.
Yes, guys, so hope you enjoyed the video. Yes, it took a lot of efforts to do that video. Hope you enjoyed my animated avatar, right? Okay. So, done. Let's see minor child. (64) 1A. In computing the total income of any individual, there shall be included all such income as arises or accrues to his minor child, not being a minor suffering from any disability under ATU. So if you see, this was inserted in 1994 by Mr. Manmohan Singh. Provided that nothing in this subsection shall apply in respect of such income as arising or accrues to the minor on account of any manual work done by him or activity involving application of his skill, talent, or specialized knowledge and experience. So guys, as far as minors are concerned, minors assets or minors income is clubbed in the hands of the parent. Which parent we will see, but under 64 1A. But there are 3 exceptions. Exception number 1, where he does manual work, no clubbing. Child labor, though there is obviously child labor, Prevention of Child Labor Act was there, but now anybody above 14 can definitely work in India. Unfortunately, that's the truth. They work, so you will get that. What do you say? That money that you make will not be clubbed. Then anything activity involving skill, talent, knowledge. Prithvi Shaw at the age of 16 years earned some 1 crore deal when he was picked up by, I think, one of those teams, Mumbai, if I'm not wrong. No, not Mumbai. Mumbai only, right? Yeah. Then he was across various places he went. Then Yashasvi Jaiswal, he's also 16, 17-year-old kid. Like that. Child actors, many child actors you would have seen in many wonderful movies. All these people, if they get money, that will not be clubbed. Third one, Manmohan Singh added that disability clause. If you are disabled, where you are claiming deduction for your child under ATU, as in if your child is disabled, handicapped, So of course, whatever planning you do like this, that is okay. So apart from these three, in all cases, it will be clubbed. One doubt may arise if you are a minor married child. Again, in India, all this happens, guys. Clubbing will happen under 64.14, which is the spouse, husband's thing, or it will be under 64.1a. Again, the specific section should override the general section. Here it's very generic in nature, but this is clearly saying specific. And if you see 64.14, it doesn't say spouse who is major and all that. That you have to clearly see here. Spouse of such individual who is a major, nothing they say. So everything will come into the picture. For the purpose of this subsection, where the marriage of the parent subsists in the income of that parent whose total income is greater. So if the parents are married, then where will it be clubbed? In the hands of the mom or dad, whosoever total income is, excluding this income, whosoever total income is higher. Or where the marriage is not happening, does not subsist, if the income of that parent who maintains the minor child in the previous year. Maintains the minor child in the previous year. Basically here it means that who has custody, who has primary custody. There will be joint custody also, but primary custody also. Who has primary custody? So custody, that will come here. Whoever has custody, that parent, it will be clubbed in their hands. Where any such one included, of course, once included in one parent, will not be included in any other parent as such. If both the parents are dead, then it's a different thing. We'll have to see what to do. So will it be included in the legal guardian? Correct. So income of the minor child, what do you think? Will there be clubbing when both parents are dead? No, because it's here clearly sees here where the marriage of his parents subsists or marriage does not subsist. Talking about marriage, what if their life only is no longer there? If they're dead, then obviously it will not be clubbed. So minor will have to file income tax through the guardian. Once clubbing of minus income is done, same thing. Child includes obviously stepchild and adopted child of that individual, but does not include illegitimate child. Stepchild is there definitely. So basically if a person gets married to one more lady who's already married with children, who was married before, divorced with children, then of course yes, stepchild or adopted child. Legally if you have adopted some child, that child also will come. Illegitimate child, so anything born out of wedlock will not be covered under that, you need to remember. So when any income of the minor is clubbed with that of the parent, exemption of 1,500 rupees per annum, Chapadasi exemption, or income clubbed per minor child, whichever is less, shall be taxable. Useless shall be available to the parent, not taxable, shall be available to the parent. 1032. Income of to a minor by way of winning from lottery. So exemption at section 1032 cannot be availed by the parent if the minor wins some lottery. Income of minor married daughter would be clubbed in the hands of either parent, one part, or you can write husband. Many courts have held husband also. Correct, because it is specific section overriding the general section. Minor unmarried, that's okay. Minor married, it is specific section override under section. There are many areas where this is also covered, many areas is also covered. In the exam, you can write either. In the MCQ, generally stick to the husband thing only. Clubbing shall not apply when disability, all these three things you have already done. Any investment made out of the income of the minor which cannot be clubbed with that of the parent. So if that income, whatever the minor earns, if it is, invested somewhere and that interest is earned, yes. Interest income earned on such investment will be clubbed with that of the parents. That is one part of the story. Other part, let's see. What is the other part? Investment will not be clubbed, but the income on investment will be clubbed. So in this particular case, in these three cases, especially let's say your Prithvi Shaw's dad. Prithvi Shaw earned 1 crore rupees. Prithvi Shaw invested that 1 crore in an FD. Will that be clubbed in the father's hands? No. But the income from that, see, interest income earned on such investment will be clubbed with that of the parents. So, yes, investment will not be clubbed. The fact that you invested, that will not be clubbed, but the interest will be clubbed. That you need to keep that in mind. 11th one is a normal point. 12th one also I've told you already. Disabled, no clubbing. Interest, dividend, rent from investments, clubbed in the hands of the parent. Manual work, taxable in the hands of the minor child alone, no clubbing. Income derived by minor from the activity involving application of skill, etc. Taxable in the hands of the minor child alone, no clubbing. But interest on FD derived by minor child when money received by such minor child is from manual work or application of skill, interest on FD. That is clubbed in the hands of the parent. Prithvi Shaw receiving 1 crore, that is not clubbed. But when Prithvi Shaw puts it in a FD and gets interest, that will be clubbed. Similarly, where a trust is created for the benefit of the minor child without any rights attached to enjoy such benefits but deferred to a date after he attains majority, income could not be clubbed till he attains majority. So, income will not be clubbed if there is any trust. So, from the 19th year onwards, obviously, or 18th year onwards, it will become his property only anyway. Income of minor child of a non-resident cannot be clubbed if such income accrues or arises outside India. Such income is taxable in the hand of the minor child if he is a resident only. Section 5 cannot override 64. Based on that only one question had come. See. Mahesh and Madhunika are non-resident living in Amsterdam. They have interest and rental income in India as well as abroad. Minor child Kai is living is with grandparents in Delhi and is resident of India. Kai earned interest income from fixed deposits held in banks and companies both in Amsterdam and India. Mahesh and Madhulika filed returns disclosing their Indian income and interest income of minor child earned in India clubbed. Separate return was also done as guardian. EO wants to club everything. Section 5 restricts scope of income only to income received, accrued or deemed to accrue or arise in India. 64(1)(a) envisages to club the income of minor child in the hands of the parents. Any income of resident minor child earned in India alone shall be clubbed. Any income of resident accruing outside India cannot be clubbed. Hence, bank interest from Amsterdam, etc. cannot be clubbed in the hands of his father as he is a non-resident. So, where a member of the HUF has transferred an asset with or for inadequate consideration to HUF, income arising from such asset is taxable as the transferor member. So, this was a tax evasion tool for tax evasion, whereby a member used to create a HUF and HUF used to invest. So, earn income. So, that also is clubbed in the hands of this. All that I have given here, very interesting. We will see that in a while. General notes and other things. Especially this one. General law applicable to clubbing of income. Study that and go. For clubbing, it is not essential that the assessee's own income, excluding income to be clubbed, must exceed the taxable limit. There is nothing like that. No, nothing. It says that excluding the clubbed income, it should exceed the taxable limit. Nothing like that. Everything will be clubbed. Husband or wife have equal income or no income apart from what needs to be clubbed, and it cannot be established whose income is greater. Clubbing fails, and income shall be assessed in the hand of the minor. Deadly. Basically, parents have no income. This fellow has income. Clubbed. Then under whose name? Nobody's name. So it will be clubbed in the minor's name. Minor child's income from agriculture will be included in the hands of the parent with a higher income for the purpose of aggregation, even though such agricultural income is exempt under 1011. Where a member of the HF has transferred with or without, yes, the transfer asset is subsequently partitioned. So if partitioning happens, where I will transfer an asset to a Hindu undivided family, then no, then normally if it is income arising from the asset is clubbed there. So when it's transferred till the date of the actual participant. So let us say Mr. A puts this property in the HUF on 1/1/2022 till 30th/6/2022. On 30th/6/2022, it is partitioned and it is divided 20% each. 20% to wife, 20% to minor son, minor daughter, major son, major daughter. Now tell me, guys. Till from the date he transferred till the date of partition, it is clubbed in A's name only. Correct? That's a 10% to the wife and 10% to A also it will go, no? Now, after the partition happens, the income, etc. will go where? Partition happens, but it continues. The investment continues, interest will keep getting. So 10% will be taxed in A's hand only. Whatever has gone to the wife will be taxed in A's hand only. Minor son, minor daughter, tax in A's hand. Only these two things, major son, major daughter, that will not be taxed. In A's name, it will be taxed in their individual names. That is what this says. Clubbing provision shall be applied only when there is a transaction of gift. In case money is lent to another person, loan already, which creates lender-borrower relationship, it is not a transfer, already discussed. If the asset is sold by the transferee, then the capital gain also shall be clubbed. No mercy. We have seen that in the whatever we had shown. Income for clubbing purpose also includes loss. Yes, you can club the loss also, and you can also, when you club the loss, it will be benefit for the person, right? It's good. Benefit is also allowed. Income is a subject matter of clubbing shall be first computed in the hands of the transferee under the appropriate head with all permissible exemption, deduction, etc. Net income only will be clubbed. So when I transfer house property, etc., that fellow will transfer, not to the spouse, let's say to the son's wife. Then the son's wife will, subtract all those municipal tax, etc., everything, and whatever remains, only that will be clubbed. Who in turn sells it for capital gain. Capital gain would be first be computed in her hands with all relevant exemptions and deductions like 54, 54 EC, and then net taxable capital gains only shall be clubbed. Cross transfer. Two transactions are interconnected. Mr. A sells it to Mrs. B. Mrs. B and Mr. B gives it to Mrs. A. Full cross connection. Then Mrs. A transfers to like this, cross transfers. That also will be clubbed. Device for evasion of tax, clubbing provision shall be invoked. Shahrukh gives a sum of 10 lakhs to Mrs. Karina, who is the wife of Mr. Saif Ali Khan. Here you see. Shahrukh, Saif Ali Khan. Shahrukh gives a gift of 10 lakhs to Karina. Saif Ali Khan gives a gift of 5 lakhs to Gauri. So this gift will be in the hands of Shahrukh Khan. This gift in the hands of Saif Ali Khan. Nothing can be done. Keshav Morarji, case law, Supreme Court. Income from gift received from Mrs. Karina will be clubbed in the hands of Saif Ali Khan. Cross transfers. In case of clubbing, person in whose name the asset stands shall be liable on the service of notice of demand by the AO. So yes, AO will send a notice of demand at 156. It will be clubbed. Who will be given to? Whose name the asset stands. Name matters. So general law. For the chapter of clubbing, the clubbing shall continue to apply even if the transferee has converted the transfer to some other form. House property is transferred to son's wife and she sells the house property and buys debentures. Income from debentures also will be clubbed, we have seen. Chapter of clubbing, income shall include loss also. Loss is also to be clubbed. If the transferee sells the transferred asset, capital gains also shall be clubbed, we have seen. Income arising out of income will not be clubbed. We have seen that already. Clubbed income shall be retained under the same head. Therefore, business income of a minor child shall be clubbed in the hands of parent under the head PGBP. Deductions available under 5 heads of income shall be allowed, and income after such deduction only shall be clubbed. Interest-free loan, as discussed, loan is not transfer. But if gift is given, then clubbing shall apply. Cross transfer, just a revision tool, revision. HUF is a partner in a firm ABC through its Karta, Mr. X, and has 25% share in the profits of the firm. Wife of Mr. X wife of Mr. X is employed by firm ABC. It's there corrected in your thing, don't worry. In this case, clubbing shall not apply because Mr. X is a partner in the representing and not in the individual capacity. So here, HUF is the partner of the firm ABC. How will HUF be? Only through the Karta, right? Mr. X. And it has HUF has 25% share in the profit of the firm. Wife of Mr. X is employed by the firm ABC. And wife is being paid salary. Will clubbing apply? No. Because X is a partner not in his individual capacity but in the representative capacity. So kindly see this very interesting word here in 64(1). In computing the total income, any individual. Doesn't say HUF. Page F1. It says individual, right? So only individuals thing should come there. Hope you got the point. If a trust is created for the benefit of a minor child, then the income of the trust shall be clubbed with the income of the parent under 64(1)(a). This shall apply even if the trust deed provided the income shall be accumulated by a trust and shall be given to a minor child when he attains majority. Clubbing provision under 64(1)(a) shall apply since the income accrues for the benefit of the minor child, although it may be given on attaining majority. So this 10th point is what is followed in ICAI. This is an exception to this particular law. After that, many cases came. This first one. Correct? So this you can ignore if you want, because it was nullified by this. This is what you need to follow. ICAI. Okay. So if a trust you create also, it will be clubbed. Then deemed owner, we saw deemed owner will just quickly, it's house property, deemed owner. One is this one, deemed owner. Holder of an impartible estate shall be deemed to be the individual owner of all the properties. So earlier, no, for all the, what do you say, people who were going and telling the secrets to the British were giving property as rewards. So that reward is called as an impartible estate. And that will be deemed to be the holder of the impartible estate. That is passed on to various generations. Whoever is holding that estate, though it doesn't belong to him, but it belongs to his parents, father, whatever it is, that person is also deemed to be the owner, just to make it absolutely clear. Similarly, in these homes, etc., if you are registered as a cooperative society, the cooperative society holds the all the houses there in the apartment, and shares will be given to the owners in the cooperative society. The building, etc., the land and building will be owned by the cooperative society, and the owner of that particular flat will be given shares. So is he the owner of the shares or owner of the flat? Obviously, deemed to be owner of the flat is what this point number 3 says. Then other thing you leave, it's fine. These 3 things are enough for us to understand. One more thing, guys, just we can, for your knowledge, we'll just do that also. Section 65, once that asked in MCQ, I'll just cover that. You can make a note somewhere. Where by reason of provisions of 27(1), income of any asset or from membership in the firm is included in total income of the SSC, person in whose name such asset stands or member of the firm will be what? Will be attributable. where it is held jointly and severally payable. It's there in the notes here. In whose name the asset stands shall be liable on the service of a notice. Means what? Person in whose name the asset stands shall be liable, which means if my property is there and I have given it to my wife, whose name is the property in now? It's in the name of my wife. And let us say there is a tax demand on me and I am unable to pay. Then this section says assessing officer can ask the wife also to pay. Assessing officer can ask the wife to pay. So for example, if my total income is 30 lakhs after clubbing, of which I have to pay let's say 3 lakh amount, and in that 30 lakh, 10 lakh is the one that is clubbed. So proportionately 3 lakh into 10 by 30, that is 1 lakh can be recovered from my wife. That is what this actually means. Section 65. So that, my dear buddies, completes clubbing of income. Easy provisions. Please go through all the questions and solve. Okay. Very much in depth we have done. Beyond this, not needed. Everything we have covered. Okay. Ciao. All right, guys, come on. Let's begin. Which is this camera? We'll change the camera. Okay, so moving on, guys, we had done that section 234. Shift. It's fine. No. Shift it, no. Why did you change it? This side, this other side. Yeah, enough. Thanks. Thank you. All right, guys. So question number 5. So before that, come to this page number 15.6. Two extra points are there in 234C. 15.5 come. Page 15.5. Come back. See that. Note number 1. Mark it as important. (15.5) Note number 1. So guys, what are the 4 installments? First is 15%, 45%, 75%, 100%. So they went to the ministry and said, please give some concession. 15%, 45%, it was too huge initially, so please give some concession, because estimated income is for the entire year, but my income I will start getting after 6-7 months. They went and proved it with the ministry, saying that I may estimate today, but the cash flow will only come later. It's like KSA will tell these many students will come, but the students will come only after 6 months, after the results, etc. Like that. Many people went and told, first 6 months you cannot charge this percentage, please, I'll pay, no problem, but at least give some relaxation towards interest. So they have told, guys, instead of 15%, if you pay 12%, then no interest is charged. 3% concession. Similarly here, 36%. So 9%, 9 concession. 9% concession, no interest will be levied. If you have not paid 36% overall, you have paid only 35%, then interest will be charged on the full 45%, no mercy. So a small relaxation, that's all, only for the first 2 installments. They went to the finance ministry, requested them, and they have given the approval. They have told, instead of 15%, just make it 12%. It's okay. So even if you pay 12%, yes, there is a shortfall of 3%, but there will be no interest charge on this 3%. Similarly, 45% you are supposed to pay. Even if you pay 36%, more than sufficient. No, I will not charge anything for the remaining 9%. Got it? So there is a concessional, what do you say, advance tax, only for the first 2 installments. Correct? So this also you should remember, 12% and 36%. If you pay 12 and 36%, I will not charge any interest. So if you see, if SSC does not even pay 12 or 36%, interest under 234C shall be levied on the entire sum. On the entire sum. Okay. Now tell me, for presumptive taxation fellow, will 234C come? My question was very simple. For 234C fellow, will, presumptive taxation guy, will 234C come? It will not come only. It will not apply then, 234C. 1% will apply, right? So you cannot say it will not apply. It will apply. How much? 1%. So within 15th March 2023, if he does not pay 100% of his, what do you say, advance tax, how much is he liable to pay? 1%. So definitely, even for the presumptive taxation guy, 1% will come. Yes, 1% will come. Yes, some exceptions. As I told you, you should do it for the entire year. But what if capital gain comes, winnings from lottery come, crossword puzzle I will get, income under the head PGBP I will suddenly get for the first time. I just started a business this year. I never thought I would start. I just started and I made money also. Then dividend, we don't know which company will pay how much dividend, how will we know? Suddenly one company issued dividend of 50 rupees. I have some 10,000 shares. So much money came directly. So ideally speaking, I should have assumed that all this will come at the beginning of the year only. Can I assume like that? No. So what does the lawmaker say? As and when you receive it, recompute the advance tax and the next installment you pay properly. That's what it says. See, for example, capital gain arises on 1st November of the relevant previous year. Would you have paid it in that 15%? No. Would you have paid it in the second one of 45%? No. So what are they saying here? To be paid in the remaining installments falling due on 15 December and 15 March. You have to recompute your estimated taxable income and you need to do the needful. Capital gains arise on 23rd March of relevant assessment year. That is where there are no more installments of advance tax. Then to be paid on or before 31st March of the relevant previous year. So suddenly I got a capital gain on 23rd March. What to do? Ideally speaking, 15th March also over. So they are saying no problem, at least before the relevant previous year end. That is before 31st March you need to make the payment. This is for special income coming in without any knowledge. I did not know that this would come. And of course there is a default in furnishing the return. Separate fee is there, guys. This is a separate fee. Where a person fails to furnish a return of income apart from interest under 234A, a fixed fee of 5,000 has to be paid. 5,000 rupees. If the total income of such person does not exceed 5 lakh rupees, then it will be reduced to 1,000. And mind you, the fee payable under 234F is in addition to the interest chargeable under 234A. In addition to interest chargeable under 234A. That's what it says. Let's solve question number 9. Other things are all fine. Question number 9. The estimated total income of Aparna, age 32 years, is in previous year 22-23 6,50,000 rupees, which includes long-term capital gain of 80,000 rupees. Compute the amount of advance tax payable. And see, the sale of land happened when, guys? 1/8/22. 1st August 22. Obviously, that time she had not known that this would come. So when, which one? It will come on the next 3 installments. It will come in the next 3 installments. First installment will not come. Right? How do we do it? Let's see. Yeah, we'll check it. Come. Not full 18. We'll have to split that 18 also. Computation of question number 9. Computation of tax payable of Aparna. Total income 6,50,000 rupees. Tax payable on LTCG at 20%. On what amount? 80,000. How much? 16,000 rupees. On other income of 5,70,000 rupees at slab rate. How is it 5,70,000, guys? 6,50,000 minus 80,000. Because LTCG is taxed separately. So 6,50,000 minus 80,000 will be 5,70,000 rupees. How much? Slab rate. Up to 5 lakh rupees it is 12,500. For that 70,000 on what percentage? 20%. So I can say 70,000 into 20% plus 12,500. How much? 26,500. So total it will come up to 42,500. Add what? Says health and edu cess. At what rate? 4%. So 42,500 into 4% will give me how much? 1,700. So what is the total tax on estimated income? 44,200. Now should I make this 44,200 into 15%, 45%? No. Why? Because capital gain came into force only from 1st August, which means it will come from the remaining 3 installments. It will come in the remaining 3 installments. It will not come in the first installment. Everybody with me on this? Understood? So you cannot make it 44,500, 200 into 15%. No. So first installment First installment would be 15% of tax on estimated income. So in that, tax on LTCG will be nil. Second one, tax on other income. How much is it, guys? Here 26,500 plus excuse me plus 4% as I should put 26,500 plus 4% cess. How much? 27,560. So what is the first installment? 15% of 27,560. How much? 4,134. 4,134. Second, first installment done. Second installment, second installment should be before 15th September 2022. How much? 45%. So now first one, tax on LTCG. How much, guys? Here, this 16,000. 16,000 plus cess. 16,000 plus 4%. How much? 4% on 16,000. How much will it come up to? 16,640 into 45%. 7,488. Next. So I am computing the advance tax payable, right? So first is 4134 I need to pay. Second installment, how much I should pay? How much I should pay? Amount next on other income. How much, guys? 27,560 should I do? 27,560 into 45%. Should I subtract 4134? But here if you see, what are they asking? 44,200, and what are they asking here? Compute the amount of advance tax payable. So when they are asking like that, I should also say before this time how much I should pay. Now assuming he has paid full amount 4134, then should I subtract? Okay, now I can write full bulk only, no problem, but I am saying assuming he has paid 4134 already. So should I, how much is a shortfall? That I have to compute that also, because here it is not, it's two different things that are coming. So either way you're right. So tax on other income, what I should do ideally? Bulk payment, cumulative. So let me, write cumulative amounts paid cumulative amounts to be paid. I'll write it like that. Cumulative amounts to be paid. And in the question, if they have added some more, what have they added? If they have said they have paid this much, then I should compute the shortfall also if need be. So now tell me, cumulatively, 4134 is the first installment, no problem. So second installment, how much guys? 27,560 into 45%. How much? 12,402. So what is the cumulative second installment? How much? 19,890. So ideally how much he should pay? Assuming 4134 he had already paid, assuming 4134 had already paid, this time how much he should pay? 19,890 minus 4134. 15,756. That's just for your knowledge. Assuming he had paid properly everything. Additionally he has to pay 15,000. So you can just write down here only, just for it. If 4134, that is first installment, was already paid, then additional payment in the second installment would be 19,890 minus 4134. How much guys? 15,756. Now next guys, third one. Before 15th, before 15 December 22, how much? 75% has to be paid. How much will it be? Tax on LTCG. $16,640 into 75%. How much? 12,480. Second, tax on other 27,560 into 75%. Answer 20,670. Total 30,150. And the same story, if I have already paid 15,756 previously, or cumulatively I have paid everything, then what is the amount remaining? 13,260. I will not write that, I am just saying. So if I have already paid full 19,000 etc., so So what is the amount remaining? 13,000. Lastly, full amount, guys. Before 15,323, 100% to be paid, which is how much? 44,200. 44,200. Done. That's all. Advanced tax over. Very simple. Nothing great in that. Very easy. Yes. All right. So next, let's do exempt income, guys. Very simple it is. Very chiller. Extremely chiller it is. Incomes which do not form part of total income. Section 10. Excuse me. So these are the incomes which do not form part of the total income. Excuse me. So unfortunately for you, this will not come because the legend is waste for you. Legend means the color, black, red, blue, not other Saravana stores legend. Right? In this chapter, the color legend has been changed to the, for ease, black is section number, red is nature of income which is exempt, and blue is recipient of income. For you, everything will be black only. Yes. So, guys, in this chapter, only two things you need to understand. One is this, 10 subsection 1, 10 clause 1 actually, agricultural income derived in India is exempt, we know. Second one, 10 AA, exemption in relation to units located in special economic zone. Just two parts. Agricultural income derived in India is one. Second one is exemption in relation to units in SEZ. Remaining, all that we would have, some are in CA final, some you already know. We'll discuss that. We'll quickly go through. Third one, receipts of income of Hindu undivided family by a member is exempt. Means, from a Hindu undivided family, if a member is receiving something, that is fully exempt. These are just things you should just go through, but these two things are what actually come in the exam. And in your ISM and in your syllabus, only these two are there. Share of profit of a firm, we know, you know already. Any share of profit received by a partner is already taxed at the firm's hand. So for the partner, it will be exempt. Exempt. Yeah, and all these things again is in CA final. These things are not relevant for us. You can just go through. I am repeating. important things are only these two. What comes in the exam is only these two. Other things you can just go through. It's just a list of all the exemptions. So for non-residents, etc., basically all these things, I'll just explain quickly. Non-resident and foreign company. For non-resident and foreign company, if you have money in an account called NRE account, non-resident external account it is called, NRE, then that will be exempt. What about remuneration received by Indian government officials? That is a foreign ambassador who is working in USA. All money received from him by him is exempt. See, remuneration received by Indian government official resident in foreign countries should be exempt. So for them there is no tax because he is a foreign diplomat. He is a foreign diplomat. Sorry? Yes. See this, royalty from technical services rendered in or outside India for NTRO, National Technical Research Organization, received by a non-resident or a foreign company is exempt. Little bit of history in this. Modi was best friends with Benjamin Netanyahu. Who was Benjamin Netanyahu? Israel Prime Minister. Not now. When he is no longer there, somebody else has come now. Previous Prime Minister was Benjamin Netanyahu. So if you see Modi and Benjamin Netanyahu, full bromance. I'm not kidding. So if you see, bromance only. Romance between brothers. Modi and, see here, full on. See in the, this is like lovers only, you know. Yes. They were best friends. Trade relation. See this. See this. Love. Lovers. Correct? See this in the beach. Here. Best friends. Bromance. And when Benjamin Netanyahu was standing for election again, he put a full banner of him and Modi's friendship. He had put it on this buildings in Israel. Unfortunately, he lost. Right? It's okay. But what I am trying to tell is, guys, Israel and India share a very, very cordial relationship. And the thing is, the best part of the story is, when this, Pathankot attack happened, after that, there was an airstrike by India, if you remember, in many places. So, and they said that was through mobile signals. They traced these sleeper cells existing in the Pakistan occupied Kashmir, and they went and bombed all these things. The technology, believe it or not, was provided by Israel. So that technology, know-how, there are many Israelis who are working for India. Where? In this organization, National Technical Research Organization. So they will receive royalty for one of the, countries which has high level of military equipment is Israel, believe it or not. Surveillance equipment. Correct? So they have this. So if you see NTRO, National Technical Research Organization. So Israeli officials living in NTRO, working in NTRO, amount received by them is exempt. Amount received by them is exempt. That's what it is. So in the beach, that was what they're discussing. Bro, NTRO exempt, bro. Okay, done, bro. And then this. See here also same thing. So see, that's what. NTRO exempt, guys. No tension. Then 1011A, amount received in the nature of interest or withdrawal from, there's a scheme called Sukanya Samriddhi account. Correct? Sukanya means what? Girl, child. Samriddhi means the financial development. So, Sukanya Samriddhi account, any person for the beneficiary, that girl, if she receives that amount in that, as per that scheme, exempt. Then, Sikkim again was not part of the country. Later it became part of the country, and there was separate rules in Sikkim. So India had to tell that Sikkimis, you will get some additional benefits, etc. The money that you are receiving in Sikkim itself, once you are married or without marriage also, whatever money that you receive, that will be exempt. So they inserted a separate section, 1026, hey, 3 A's, correct? 1026 AAA. So income which accrues or arises to whom? Sikkimese individual from the following sources shall be exempt. Just read this and go, because Nirmala aunty has changed little bit of this in the budget 23. In budget 23, Nirmala aunty has changed something. What she has changed, I will not tell. Last time ever, questions that can be asked based on old provisions is this attempt. That's why I am saying this one thing you study and go. May or may not ask, right? So income which accrues or arises to a Sikkimese individual from the following sources shall be exempt from tax. There is special provisions for Sikkimese. 1. Income from any source in the state of Sikkim. So that Sikkimese individual is living in Chennai, is living in Coimbatore, but he or she is deriving some rental income from Sikkim. Income exempt or taxable? Exempt. Income by way of dividend or interest or securities, whether generated in Sikkim or any other place. Super guys. All interest income, dividend income is fully exempt. For whom? Sikkimese. Special privileges for them. Correct? However, this exemption will not be applicable to a Sikkimese woman who marries a non-Sikkimese on or after 1st April 2008. This is what has changed now. What has changed I will not tell, but just remember this and go. Right? So if a Sikkimese marries a non-Sikkimese after 1st April 2008, then this benefit will not be given. Otherwise, it will be given. As I told you, it took a lot of effort to convince the rulers of Sikkim to add their map to Indian map. For them to be a part of India, northeast of our country, took some time. So I need to give some special privileges. What did I tell? If you go work anywhere else, leave your land and go, no problem. All income derived from your land, exempt. Second, you buy any share certificate, any interest, any dividend that you receive, exempt. Special exemptions for Sikkimese individual. But if a Sikkimese person marries a non-Sikkimese, then all these benefits will be not applicable. Huh? What? Sikkimese woman marries a non-Sikkimese. Sikkimese man marries a non-Sikkimese. Guys, in northeast of India, it is patriarchal society or matriarchal society? Means the husband will stay in the wife's house or wife will stay in husband's house. I told it in BCR. Husband will stay in the wife's house. So the dominant person is wife. That's why Sikkimese woman marries a non-Sikkimese. The dominant party is Sikkimese woman there. It's a matriarchal society. Right? That's what it is. Then scholarship granted to me, any education scholarship if you are getting, exempt. Any award that you are getting, instituted in public interest, done. Guys, this also, those useless fellows are getting some daily allowance received by MPs and MLAs. What do you think? Exempt. And if you are getting any family pension, guys, who is getting posthumously, that person unfortunately has passed away. Posthumous means passed away. After death, if I am getting for the family members, if I am getting what? Pension. For any member? Yes. Otherwise, any awardee, Paramveer Chakra, Mahavir Chakra, Veer Chakra or any gallantry award, in that case, if he has been receiving any pension for the service for the country, that pension is not taxable. Rightly so. Correct? All these things. Just remember that basically and go. No need to remember any section. You can simply say exempt under section 10. That's okay. Exempt under section 10. That's enough. No need to remember anything. But what they can ask, problems, these are all MCQs. Problems will be 10, that is agricultural income, which we have already studied little bit, and then your other one, that is SEZ. Guys, what is agricultural income? Income derived from anything that you do, agricultural activities, will be agricultural income. 2.1a defines agricultural income. Again, definition and all they will not give, they will only directly tell that he has agricultural income, but then everything. Nippo is some stupid company. Rohit Sharma is there in that. Alright. A poor guy, man. He's a good player. Very? Yeah. Family pack he has, little. No six pack. Alright? Yes. So, I have to ask him only. Yeah. He's not replying. He becomes CA, then he'll reply. Yes. 2.1a defines what agricultural income to mean what? Any rent or revenue derived from what? Land, which is situated in India and it's used for agricultural purpose. So guys, even if I get income from land, if I lease the land, is it agricultural income? Yes. Sale of agricultural produce. What is agricultural produce? Crops. What about dairy farming? Is it agricultural produce? Yes, everything yes. Then yes, fishing also. Any income derived from farm building, which is in immediate vicinity. Vicinity means next to. Occupied by the cultivator, dwelling house, storehouse, everything. It is all in this. Rural agricultural land, we already know this, guys. Rural land. What is rural land? That 3 circles. Up to 10,000 kilometers. Less than 10,000 kilometers, rural. 10,000 or more up to 1 lakh. And that population, if it is there, not kilometers, sorry, 10,000 people, less than 10,000 people, rural. Greater 10,000 or more up to 1 lakh people, up to 2 kilometers, rural. Urban, beyond 2 kilometers, rural. More than 1 lakh up to 10 lakh, up to 6 kilometers radius, urban. Beyond 6 kilometers, rural. More than 10 lakh population, then see the radius 8 kilometers, urban. Beyond 8 kilometers, rural. Yes, that is what it is. And income from agricultural land is not used for agricultural purposes, then such income is taxable. For example, income in the nature of rent received for use of garden land, for shooting films, teleserials, etc. is not agricultural income. You have a huge garden, that garden you are letting out for marriage, shooting, then that will not be called as agricultural income. If I am a trader of saplings, what do you think, guys? I am buying saplings from the farmer and selling it in the market. I am a trader of saplings, not a grower of saplings. Nursery that I have, taxable under PGBP, not under agricultural income. Basic agricultural operations like tilling, sowing, planting, etc. and subsequent like weeding, spraying pesticides, pruning. Pruning means to cut the trees, harvesting. All these are what? It should be linked to the primary objective. So guys, if the tilling, sowing and planting is done by one farmer, but is outsourcing the weeding and pesticide to another company, they will just weed. Weed out means what? All the other weeds which they have grown, I am going to cut. Then I am going to spray pesticide. Do you think that is agricultural activity? Farmer is doing tilling, sowing, planting. But the weeding and pesticide is being given to somebody else. I am doing sowing, tilling, planting. You are doing only spraying pesticides and weeding. Are you doing agricultural activity? No. You see, mere rendering of subsequent operations alone cannot be considered as agricultural activity. But there is one exception to that, nursery. Where an SSE is carrying on nursery activities which do not involve basic operations, it shall be considered as agricultural income. If I have a separate nursery for only trading, I buy from the nursery and I am selling saplings to you, that is trading. But if I am owning a nursery where I have a deal with the farmer and saplings I will buy and I will nurture everything and then I will sell, then it's okay. Then it is agricultural activity. These are all based on decided case laws. That's why they have inserted various explanations here. Agricultural land outside India, it is not an agricultural income. So when I had gone to UK, I saw many nice land and I just inquired. There anybody from outside UK also can purchase the land. But from an Indian point of view, if you want to buy the land there, it will be fully taxable. So it will only make it worthwhile if you are earning much more than you would earn in some other land in India. So if some land in India here, not agricultural land, some land, I am renting out that house, I am getting 40,000 rupees. But from the UK, if I am getting 2 lakh rupees and let's say tax is 50%, if I am getting for the same land, same cost 1 lakh rupees, but if I invest the same in India, I am getting 40,000 rupees, which is better. Owning a land in the UK would be better. Owning a land in the UK would be better. Got it? So, because there is no difference between agricultural land in UK versus any normal land in India for an Indian, because it is taxable, fully taxable. Yes. But there are certain things, guys. Now you write down. Sale of agricultural produce also. So write down pointers, we will only study that, it's fine. Write down, guys. Exempt income. Exempt income. Just stick to these notes, more than sufficient. Exempt income. First one, agricultural income. Exempt income, in that word, agricultural income. Exempt under section 10(1). Exempt under section 10(1). First one, sale of agricultural produce. Sale of agricultural produce. Second, rent of agricultural land. Used for agricultural produce, used for agricultural activity. Farmhouse rent. For agricultural activity. Guys, if you rent the farmhouse for normal stay, weekend getaway, then that is business. That is business. Many people do that. Nursery income. Nursery income is also agricultural income. Next, as far as sale of agricultural produce, sale of agricultural produce. First is sale in raw form. Tomorrow what time is your class? 7. Sale in raw form. Today I'll leave early. Sale in raw form is one. Second, sale after the process is done. One raw form, I'll just, what do you say, harvest it, like tomatoes, I will harvest and sell directly. This is called agriculture income. Agricultural income. Sale in the raw form. Sale after the process. Sale after the process. One, process compulsory for sale. Process is compulsory for sale. The process is compulsory for sale. Example, coffee. Yes, coffee you just can't, take out the beans and start selling. You need to make a process. You need to first whisk it, then ground it, correct? First roast it, all that peeling activity, many things are done. So, process is compulsory for sale, agricultural income. In Thailand, in Indonesia, sorry, in Bali, they make coffee using what? Cat shit. Cat shit, I told it correctly only. So, there is a cat called civet cat. Correct? There is a cat called civet cat. Sorry? It is called Kopi Luwak. Luwak is that, Kopi Luwak. See this one. See, this is shit. So, this one, poor thing. So, they will make this Luwak eat the coffee beans. This Luwak cannot, digest the coffee bean. So the luwak will eat the coffee bean, goes through the digestive tract, next day morning, this will come. And they will use this to make coffee. I am not even kidding. When I had gone to Bali, I tried. What is there? You have to try everything in life. Yes. So, 2017 or 18 I had gone. Yeah, 1 week. Same it was, no change. It was the same, definitely not like filter coffee, but it's the normal. It's fine. You should try everything. So this is so famous, Luwak coffee, 1 kg, some 3,000 rupees, 2,000 rupees. I tried 1 cup, right? Yeah. So now tell me, is this agriculture? No, huh? Why? It's not agriculture. If poultry is agriculture, why not this? They are making coffee. Is a process. Yes, definitely. Is a process needed? Yes. After the coffee bean, there is a process compulsory. There was an entire tour that we had gone. That is the process of making Kopi Luwak. So there was an entire process. Last but one process is they'll feed it to this poor thing. I mean, first is initially all those harvesting and all. Immediately after harvesting the bean, they will feed it. So once this comes out, the next day they'll collect it, and then because through the digestive tract, the taste will be enhanced. The cat shit you will be eating, right? Yes, so that is what it is. It's the true, it's how it is. Is this agriculture? 100% yes. Is the process compulsory for sale? Yes, it is. So it is what? Agricultural income. Agricultural income. Process can be optional also in many cases. Sugarcane, yes. Sugarcane, you will extract the sugarcane juice, and from the molasses, you can make other things as well. Correct? So that's fine. That's optional. From potato, you can make chips if you want. Right? Yes. From grapes, you can either sell the grapes or you can ferment it and make wine. Yes, anything. So process is optional. Process is optional, definitely. And from this, what do you say? So I had gone to a, this time I just wanted to understand whiskey making process, right? I had gone to Johnny Walker distillery. Superb it was. So there they'll superb. They'll give a test, for taste also and for testing. So basically you can taste it by smelling it. It's the more of the sensory thing. You should understand how it works. But anyway, the entire process there. Then I asked them, will there be a waste? So first they'll do all the fermentation, etc. And finally when they're fermenting, after that there'll be some, part of the wheat, barley, which is actually starch, what will they do with that? They will still use it in farmland. So nothing goes waste. Everything will be utilized back, right? It's a byproduct. So is that those processes are all optional? But the main thing is what? Agricultural income. So optional processes are different. So here coming back, if it is agricultural income, what to do? How much? What will you charge? If it is business income, what will you charge? So here also, if it is agricultural income, both. Whenever there's agricultural income, what to do? When there is business, what to do? If it's agricultural income, guys, it is what? FMV. Write down everything. Agricultural income, what to do? Business, if it is there, what to do? So some will be used for business, some will be used as agricultural income, whatever it is. So they will take the FMB of the agricultural process. Which one? That, like if you sell it outside, like for example, if you use the potato chips, etc., there's processes optional there. That ideally you can only use the potato. But the moment you are selling potato for the, to make these vegetable cutlet or to make other things, then process only becomes different. Next time when you go to Maharashtra, go to this farm called Maypro Garden. It is very, very nice. In your Mahabaleshwar, it is there. That is your Maypro Garden. They make many things. So you will understand this process. So they actually grow strawberries. And from strawberries, they will make strawberry cream, strawberry ice cream, lot of jams, etc. They grow many, many things. But there's a business aspect to it also. One is this agricultural income. Other part is the byproducts, etc. They will sell it off in the open market. So that will be business related. So FMB of agricultural produce, which has gone through the further processes, that we have to consider FMB, because I don't know what will be the other things. Less cost of agricultural produce. Cost of agricultural produce. How did I derive? What is the cost? So the balance will be what? My agricultural income. I should take the FMB, market rate. Same thing is given here, you see. Sorry? Yes. So if you check that here, you see rule number 7 tells that agricultural produce ordinarily sold in the market, agricultural income. Agricultural produce is further processed, divided into agricultural income and income from business. Income from business. So if you see, if sugarcane is cultivated and used as a raw material in the manufacture of sugar or jaggery by the SSE, then rule number 7 will apply. That is this rule number 7. Because I can directly sell it off in the market. But now I am making it separate. What? Some I am selling in the market. Some I am converting it to jaggery. So when I am converting it into jaggery, guys, that is not agricultural income. What am I doing? I am making it as into a business. If I grow strawberries and just sell strawberry, that is okay, agricultural income. But I am converting it into jam, ice cream, cream, then obviously that will be a business component to it. Raw material. So if I am just extracting honey and selling honey. Sorry? Yes. Yeah. So honey, if I am just extracting and I am selling it off, okay, agricultural income. Honey I am extracting and making cough syrup. I am making it into, I am adding it into biscuit and selling honey cake, honey biscuit, honey cake, all these things. Yes. So all these things obviously will be business thing. It will be business. So if you see, that's what I am trying to tell. Check. FMB of agricultural produce is further processed, less cost of agricultural produce. Yes, agricultural income of agricultural produce which is further processed, it will become like this. But income from business, which I am selling this strawberry cream, strawberry ice cream, sale of final product. Sale of final product, that selling price I should take minus further process cost. That is conversion of strawberry into strawberry pulp and into strawberry cream. It's in near Pune only, go there. That strawberry cream they'll give you, that is something that you never would have tasted. In South India, we don't make that properly. There it's really nice. And Maypro has never come to South India because they are self-sufficient exporting it. Even in India, it's not there so much. They export the stuff abroad. Extremely high quality product. There is a Maypro cafe also. It's a huge garden. It's a huge factory. You can do a tour of the factory. They will explain the process, how the entire thing is done. So what all they do so many things. You will go crazy seeing that. And directly if they sell off everything, you can buy strawberries also from there. That is what? Agricultural income. But other processed goods, 100% business. Right? Further process cost minus what? Agricultural produce FMV. Agricultural produce FMV. That also I should subtract, because that I already would have taken here, no? FMV of agricultural produce I would have already used it here. Am I not using the strawberry? Strawberry, when I get, guys, 1000 kgs, 500 kgs directly I'll sell it off. So how will I use the agricultural income? FMV of the 500 kgs minus cost of growing the 500 kgs, agricultural income. Now when I make the strawberry, remaining 500 kgs, if I make it into jam, cream, ice cream, whatever it is, then sale product of final product minus the cost of conversion of strawberry into cream, ice cream and all those things, minus what? Cost of strawberry. And cost I will not take. What will I take? FMB. Because it's like I have sold, though it is in-house only, I have sold this 500 to myself. To be taken as I have sold this 500 to myself. If this 500 was not there, I would have purchased from outside. That's a very good logic. Rather than taking the cost, it's like what? FMB. It's like as if this 500 was not there here. I am buying it from outside. Very good provision. So that is about it. That is regarding normal. That is regarding normal stuff. So same thing. So processing cost, all that, then when I sell it, final thing. So again I repeat, sale of final product is sale of 500 kgs worth of strawberry in converted form. It can be cream, it can be jam, it can be ice cream, biscuit, so many things, syrup, so many things. So they have nice syrups also. It's that you can add water and make strawberry milkshake, strawberry juice. So many things are there. I went mad. I never knew it was like that. Because in South India, it's not there only. It's not available anywhere. Then I asked them, why is it not available? He said, sir, in India only we don't supply. Everything is exported. It is amazing. And then minus further processing cost. The cost of conversion of those things into those products. Minus, it is as if I have bought that 500 kgs from outside. So I have to do the agricultural produce FMB. Very good provision. So that is regarding this. But guys, this is one part of the story. But there are 3 items for which income tax law only says something else. Rubber, which is centrifuged latex. So rubber is from rubber trees. Correct? Have you seen the rubber trees? Yes, in the rubber trees they will cut the bark. Have you seen it? And from there they will put one cover here. So that latex, they'll put a cover or a bowl. So the latex will come, keep dropping, and from that they will make rubber. Sticky stuff. Now the thing is, when I sell that, guys, or when I use it when I make it something else, I can use that for so many things. Question is, how much is agriculture, how much is business? Don't know. Confusion. Next is coffee. Coffee which is grown and cured. Grown in coffee plantations, cured means where they'll pluck it and do the first process called curing. Then they will sell it off to other people who will do the other processes. But coffee plantation, who really grow coffee, like my grandmother, before she came to live with us long time back, she had a coffee plantation. So I have grown up in those coffee plantations during childhood. She used to do all these things: grow coffee, cure, roast and ground. So I used to participate as a small kid in all these things. I used to stand on the coffee and ground as if something, I was doing. I still remember those wonderful memories. So every, summer holidays used to be spending in the, coffee estate which my grandmother had. So she also had a small business of honey collection because many trees were there, lot of honey was there. So honey trading also she was doing. I remember very clearly. So once I had gone to actually extract honey as if, I would go and know everything. Correct? That honey bees attacked everybody, we had to run away. It was good fun. So rubber is this, second is coffee, grown and cured is one. But this process, what the coffee growers do is growing, curing, roasting, grounding. Grounding means making it into fine powder. In that, how much is agriculture, how much is business? We don't know. Tea also, grown and manufactured, how much we don't know. That is why, guys, income tax department only has given the percentage, which we need to remember. Yes, 65% of rubber when you sell, 65% is deemed to be agricultural income. 35 is deemed to be business income. You may be actually selling 50% as business, I don't care. As per income tax, that's like presumptive taxation. As per income tax law, 65% is agriculture, 35% is business. For business is taxed as business income, obviously. Agriculture, obviously, no tax, no. And business income, 35%, in that you can claim expenses and all those things. Coffee, only grown and cured, 75-25. Other two, 60-40. So coffee, full process 60-40. Because in roasting and grounding, they will add one more material called chicory. Correct? It is called chicory. You will call it chicory. In Kannada, it is chicory. That same thing, chicory. So that will add the flavor and that will add the taste. Correct? Color, everything. Flavor, color, taste. Chicory is nothing but the waste material of those, seeds. They will use that only. It's a waste product they'll use, but it will add flavor, color, taste also it will add. So 100% pure coffee is available, but the color will be weird. Yeah, if you want like this darker flavorsome color, you will have to add, ideal thing is 75-25. Correct? 75-25, 70-30, 60-40. 60-40 will get too strong. But if you want to enjoy the real pure coffee, apart from coffee luwak, then it is 100%. Without chicory you should use. That is the real coffee, right? So if you see 60-40, 60-40, 75-25, 65-35 is all they say. This you have to remember, guys. So in the exam, what they'll give? If they give you anything about rubber, coffee, tea, use this. If they give you sugar cane, then this. Rule 7. Rule 7 is for example, sugar cane. We'll solve a sum, you'll understand. Are you trying to get it? If they say the entire sugar cane was sold, then this one. 60% of the sugar cane was sold, 40% was made into jaggery, then this. You have to calculate and do that. On the other hand, if they ask you anything related to rubber, coffee, tea, then this. Then this will come. Right? So, one more point is there in this, that is the concept of aggregation. Mark this as important. That we'll do in a bit. One sum we'll solve, then we'll take a short break. So just take one sum we will solve. Open the material, guys, agricultural income. Aggregation we'll see later, don't worry. Agricultural chiller, no? Easy. What is there in this, guys? All chiller. But if they ask, important. They will ask also. Yes, good. You got the answer already. All PJs in the house. Right. One second. Long time? Yeah. Yesterday only I told, Noda. Yesterday only I told one nice PJ about Windows, Apple and all. See, incidental PJ. One second, which question? Okay, this only, no? Question number 2, guys, come on. Question number 2, sorry. Just. Question 2. Scholarship received for meeting the cost of education is exempt in the hands of recipient. True or false? Okay, first one only we forgot, sorry. Mr. X, a member of HUF, received 10,000 as his share from the income of the HUF. The same is to be included in the chargeable income. False. Why it is exempt? Scholarship received for meeting the cost of education is exempt in the hands of recipient. True. Why? I told you, any scholarship you are receiving is exempt. Actor Amir Khan received 5 lakh rupees from Filmfare as an award for best performance and claimed it as exempt. One slap. Correct? It is not anything given by government and all those things. Mr. Prakash is a working partner in Milk and Cheese, a partnership firm with a share of profit of 15%. He received a sum of 15 lakh towards share of profit from the firm. Examine the taxability. What do you think? Not taxable. Whether it is a firm or LLP, share of profit is not taxable. In question 4, would your answer differ if Prakash is a sleeping partner? No change. Any partner, you are sleeping partner, awake partner, and all these things. What is this? It is what? No change. Mr. Akshay, a Mahavir Chakra awardee, was formerly in the service of central government, received a pension of 3 lakh in the financial year. Answer? Exempt. Yes. Like this chiller questions will come, guys. Then Mrs. Y, wife of Mr. Y, who was a former employee of central government and recipient of gallantry award, received family pension. Yes, it is also exempt. Interest of 30,000 received from an account opened in accordance with Sukanya Samriddhi. Exempt. Just right as per section 10. Mr. P, who is an MLA, received constituency allowance of 1,50,000 and salary of 5 lakh. Answer? Daily allowance and constitutional allowance will be, constituency allowance will be exempt. Salary? IFOS. Salary is taxable. Only that constituency allowance will not be taxable. That's all. Very simple. Now, question number 3. The total non-agricultural income of Mr. Kailash, aged 40, is 15 lakh rupees. Agricultural income earned is 75,000. Determine the tax payable of Mr. Kailash. Okay, this we have to aggregate. Leave it, guys. Question 4 you do. Question 4. I will come to aggregation later. Question 4. Mr. Sanjeev has estate in rubber, tea, coffee, everything this fellow has. He derives income from them. He also has a nursery wherein he grows plants and sells. He is not a trader. He grows the plants in the nursery. For the previous year ending 31/3/23, he furnishes the following particulars of his sources of income from estate and sale of plants. You are requested to compute the taxable income. Rule 7A. So here what is the percentage, guys? 60? 65, 35. Coffee? 75, 25. It is just coffee grown and cured. This one? 60, 40. This one fully agriculture. So you need to make a column: agricultural income, business income, total. In nursery, 2 lakh will be full agriculture. This will be nil. Total 2 lakh. Here you do. What is 65%? Tell me. 65% of 3,90,000. Business 2,10,000. Overall 6 lakh. In 3,50,000, 75%. 2,62,500. Here 87,500. Here overall 3,50,000. Here 4.8 lakh, 3.2 lakh. So this amount is fully what? Exempt. That is fully exempt. So since it's nursery, he is doing all that, and remaining this will be business income. Business income of which he will do other things. That's what they say. So Shrikant, an individual, did you get it? Very easy guys, direct questions. Only aggregation I have to do still. Mr. Shrikant, an individual, is in the business of growing and manufacturing of tea in India. Tea, 60-40. The total income derived from the activities is 50 crore. Answer. 60%, 30 crore is agriculture, 40%, 20 crore is business. Will your answer be different if he is carrying on only the manufacture of tea in India? He is not growing, he is just manufacturing. Full 50 crore will be business. So you should be careful, it is growing and manufacturing. If somebody else will buy the entire tea leaves in a 5 manufacture, it's just business. So growing and manufacturing tea will be 60-40, otherwise 100% business. So like that questions will come, which is quite simple. So aggregation we will do after a short break. Take 5 minutes. I'll give you again no proper break. 5 minutes you take now, then 4th question. I'll finish, I'll take off 10 minutes, 15, anyway it's almost 3:50. Till 4:15 we can take, and then 4:15, 4:20, 4:30, and we can finish. No, I'll give 4:10, before 4:10 I'll give you. 15 minutes to go, that's all, plus GST. Yes. So next, done. Aggregation is what we have to do. We'll finish it off. Aggregation. Growing and manufacturing tea, rubber, all that done guys, very simple. There's nothing there. Questions also we've solved, couple of things. Yes. So next, write down, it is here in this only. Write down guys. Next heading, partial integration. Differentiation and all will not come. Partial integration, yes. The only integration that you will use now is this only. I don't know why that stupid chapter was there in foundation. Useless it is. Life also integration. Yes, okay. How? See, it's gone to some other level only. Yes. And yesterday he wants some soul. Yes. He is a lost soul. Yes. Right. Rakesh needs a soul. Yes. Partial integration. Partial integration. So, sorry. So guys, write down and first normally calculate your, I will explain. So just an example, if income from salary for this fellow, income from salary is let's say 3,30,000. Income from house property is let's say 2 lakh. And income from other sources, in which agricultural income is 3,10,000. Gross total income 8,40,000. But will you take this? Fully exempt. Agricultural income. Full agricultural income. So overall how much? 5 lakh 30. Guys, what is the tax on this normally? Just calculate normal tax. Up to 5 lakh it is how much? Up to 5 lakh? 12,500. 30%, sorry, 20% on 30K. How much? 6,000. How much is it? 18,000 plus cess. 740. How much? This was how everyone was earning money. They had agricultural income of 3 lakh, 5 lakh, 10 lakh, 20 lakh, 40 lakh. But what was the tax paid? 19,240. Correct? Agricultural income is exempt. Agricultural income is exempt. Now, if you ignore agricultural income, or what is the agricultural income more than 5,000 rupees? Yes. Is the other income, is it more than the basic exemption limit? Yes. It is more than the basic exemption limit. So, if you use 3 lakh, 5 lakh, 6 lakh, whatever it is, how will it be if I do like this? I will add all these things, just assume. How much will it be? 5 lakh 30 plus 3 lakh 10. 8 lakh 40. Right? The finance minister, not sure who introduced this. The finance minister, I think it was Chidambaram if I'm not wrong. Not sure about this though. Yeah, so here what he did was, he said, why don't you compute tax on 8 lakh 40? Correct? And after you compute tax, basically what they are doing, you have a basic exemption limit, then you have taxable income. You are always calculating tax on that. The other exempt income can be this much, this much, this much, no tax. Correct? So what Chidambaram or whichever finance minister decided, you have basic exemption limit, okay, no problem. You may have other exemption, agriculture this much, you may have this much, everything is exempt. And then you have a taxable component, separate taxable component you have, that I always add here. I always add here. He said it is unfair, yes or no? Isn't it unfair? Because if you have 1 lakh, 10 lakh, 2 crore agricultural income also, only these two are getting added, and how much am I paying? 19,240. He said this should change. He said let us aggregate. Take the basic exemption limit, add this also, and then add this. Calculate the tax on this. Because the moment you add the agricultural income big base, the other income will move towards the 30% bracket, yes or no? 30% bracket. So calculate the tax on this, then you remove this. When you remove this, what will happen? You are still giving exemption, yes or no? What is exempt? Agricultural income is exempt. And what is exempt? Basic exemption limit is exempt. Excellent. Then again one more. Basic exemption limit is there. Then this big 10 lakh you add. And then on top of it you add other income. Calculate the tax normally. Then you remove this. Tax on that you remove. First tax on this minus tax on this. The moment you add a chunk of exempt income, the non-exempt income will move into the 30% slab. And that creates a correct way of calculating tax. Brilliant. I think it was Chidambaram. That fellow only, all these cunning ideas. Chidu. Right? Chidu Mama. Brilliant. Actually, it makes a lot of sense. I will create a equal base. Rather than you earning whatever the hell you want there, basic exemption limit you take, a chunk of exempt you put, on top of that put the other income. Automatically other income will go towards 30%. I will not allow you to take that slab rate benefit between 2 lakh 50 to 10 lakh. That cushioning I will not allow because I am adding this slab in between. I am adding this slab in between. Then if you have like 2 crore and all, imagine. So if you have here, then is 2 crore and then on top of it, this is full 30% only, no? It will become 30% only. Then you remove this later, no problem. So this is the concept of aggregation, or rather partial integration of agricultural income. Correct? Brilliant concept. I am giving you exemption also. You remove. Tax on overall minus tax on this will be this only, no? Tax on overall minus tax on this. It will be tax only on this is taxable. So I am giving you benefit. Tax on overall minus tax on basic exemption limit plus exempt income. Which means I am just pushing that other income to the 30% bracket. And still giving you exemption. Wonderful concept of aggregation. This is one more type of question that they can ask. So write down, guys. Write down partial integration. Conditions. Conditions. First condition. SSE must be individual / HUF / AOP / BOI / artificial juridical person. This will not apply to company or firm because individuals are doing all these things. Company or firm, anyway, all the agricultural income is exempt because I have to support agriculture. Second is your anyway that 65, 35, 70 is clearly given anyway. So there is no point. Will you get slab rate for company? No. So why am I doing this? For slab rate, and all these fellows get slab rate, yes or no? Yes, that's why. Second, net agricultural income. The net agri income should be more than 5,000 rupees. Should be more than 5,000. Third, other income should be greater than basic exemption limit. Other income should be greater than basic exemption limit. Fourth one, what will it be? Tax on net taxable income plus agri income. Net taxable income plus agricultural income, whatever I will get, I will subtract what? Tax on agri income plus basic exemption limit. Obviously, no, I am removing that chunk. So whatever I get, that will be the actual tax. That will be the actual tax. So guys, in this particular question, I just told you this 5,30,000 you wrote down. Now you do this method and tell me. So in this particular question, which is question here we have written down, salary plus HP plus 3,10,000. So first time putting basic exemption 2,50,000. On that I am adding this chunk 3,10,000 and then adding that. So that's the meaning of net taxable income. I am going to remove the basic exemption limit, obviously, right? When I say net taxable income, what is it? After removing the basic exemption limit. So let's do it. So first one, tax on net taxable income plus agricultural income. How much, guys? How much? 5,30,000 plus 3,10,000. That is 8,40,000. How much is the tax on 8,40,000? 3,40,000 into 20%, no? Up to 5 lakh, how much is 12,500? So 68,000 plus 12,500. Are you getting it, everyone? 8 lakh 40 tax will be what? 12,500 plus 20% of 3 lakh 40,000. 68,000, 12,500 plus 68,000 will come up to 80,500. That is point number 1. No need of cess, we can add it later together. So 80,500. It comes the same anyway. 80,000. Second one. Tax on, I am removing the tax on what? Agri plus Bell. How much is it? Agricultural income is 3 lakh 10. Basic exemption is 2 lakh 50. So 5 lakh. How much? 5 lakh 60. What is the tax on 5 lakh 60? Up to 5 lakh 12,500. Beyond 5 lakh is 60,000. 60,000 into 20%. 12,000. 12,000 plus 12,500. How much? 24,500. Everybody got it? It is 12,500 plus 60,000 into 20%. Will be 24,500. So taxable income. How much, guys? 80,500 minus 24,500. How much? 56,000. Compare this. 56,000 plus 4%. 2240. 58,240. See this, guys? 58,240. Where is 58,240? Where is 19,240? 19,240 I had taken because of the benefit of slab rate. Because the benefit of slab rate. Here in the old, before this aggregation, 19,240. After aggregation, 58,240. After aggregation, 58,240. Brilliant. Lungi man. 39,000 government is making more money. Actually, they are taxing agriculture indirectly, but still giving exemption. Yes, so they are telling you add there, and the other income you pay at a higher rate. That's the idea. Other income pay at higher rate. You are getting an exemption, no? What exemption you are getting? In agricultural income exemption you are getting. Pay higher rate for other income. So there is no actually slab rate for other income. There is no slab rate for other income because of this. One more question and we can leave. 58,240. On aggregation, one problem you solve, and that's it. Go home. Sure. Yeah. Home definition I'll give. Home is where the heart is. Where the soul is, correct. Home is where the soul is. His soul is somewhere else. Question number 3 you solve, guys, now. 3. 1 second. Question number 8 and we are done. Question number 8. Mr. Agam. Heart. 60-year-old individual, Tata fellow, but young at heart. Engaged in the business of roasting roasting and grounding of coffee. Roasting and grounding of coffee. Derives income of 10 lakhs during the financial year 22-23. Okay, enough. Compute the tax payable by him, assuming he has not earned any other income during the financial year. What would your answer be if Mr. Agam is engaged in the business of growing and curing coffee? 60/40. Now first one answer. 10 lakh actual tax. So how much is it? First one is easy guys, 10 lakh. Roasting and grounding of coffee. How much? Only roasting and grounding. Will it be PGBP? Guys, only roasting and grounding. Please see the chart carefully. That is why it's important. Nice question. He is roasting and grounding. Is it agricultural income anyway? No. Full business. Full business it is. Are you understanding? So the full how much? 10 lakh will be 11 lakh. No, how much is it? 10 lakh. 1 lakh 14,400. The full 10 lakh in part A, part B. If you do in part A, full 10 lakh is what guys? Business. How much is the income? What is this thing? Slab rate. Up to 5 lakh, Tata fellow is. So, up to 3 lakh, nil. 3 lakh to 5 lakh. How much? 10,000. 5%. Then 5 lakh to 10 lakh. 20%. 1 lakh. So, 1 lakh plus 10,000. 1 lakh 10,000 plus education cess. 4%. You want me to do it? So, how much is it? 1 lakh 14,400. So up to 3 lakh nil, 3 lakh to 5 lakh 10,000, 5 lakh to 10 lakh 1 lakh. You watched the new Spider-Man movie? That Across the Spider-Verse? Shubman Gill. Hey, that is Hindi version. Oh, he has given his voice, no? Okay. Yes. Who's the other person? Sarah is there in that? No. Okay. 4,400. Yes. So what is 1 lakh 14,400? 1 lakh SAR. Yeah. Sarah sir will come. Yes. 1 lakh 14,400. 1 lakh 14,400. Now part B. Now he is doing what? Growing and curing coffee. 75/25 or 60/40 guys? Also engaged in growing and curing. All four. Growing, curing, roasting, grounding. 60/40. So in question number 8, the part B of the question, in 10 lakh, 60/40. 60% is what? Agricultural income, 6 lakh. 40% is what? Business. So now PGBP, 4 lakh. Agri income, 6 lakh. What is exempt guys? Agri income is exempt. So it will be 6 lakh. So what is the net taxable income? 4 lakh. Now you have to do integration. Obviously now you have to do 2 minutes. Yeah. Now we have to do partial integration. Come on guys. What is the partial integration thing? First one. Tax on how much? Net taxable income plus agri income. How much? Full 10 lakhs. 4 lakh plus 6 lakh. 10 lakh. We already computed the tax. How much? 1 lakh 10,000. Less tax on agricultural income, 6 lakh plus basic exemption. 2.5 and all don't take. 3 lakh. Basic exemption limit is 3 lakh. Are you getting this? 6 lakh is what? Agricultural income. 3 lakh is basic exemption limit, 9 lakh. What's the tax on 9 lakh for this Tata fellow? How much? 90,000. How much is it? 20,000 is the tax that you need to pay, plus one question, will rebate come? Huh? Income is more than 5 lakhs. Where? Business income you have to see, no? Exempt income you should subtract, no? Rebate. Rebate. One concept few years ago we studied. Rebate under 87A, will it come or not? Total income? Total income is what? What is the chapter heading of this chapter, whatever we are doing? Income which do not form part of total income. So what is total income? 4 lakh or 6 lakh? 4 lakh or 10 lakh? 4 lakh. So guys, this is a income which doesn't even form part of total income. What is the total income actually? 4 lakh. So will rebate come or not? Yes. So rebate is how much? Total tax payable or 12,500, whichever is less. So 100% rebate will come. 1 mark will be there for this. We'll miss out on this for sure. So 20,000 minus 12,500 is 7,500. Section 10, exemption income is an income which does not form part of total income. And rebate is provided if the total income is less than 5 lakh. Isn't this less than 5 lakh? Yes. 7,500 plus cess 4%. 300 rupees. Totally 7,800. Got it? Done. Take a break. 15 minutes enough, guys. Then I'll take for 1 hour. Over. 5:30 close. Fair enough. 5:30 close. 4:30 come back. 5:30 close. That's it. Law will do. Or I will finish this or will do law? I will finish this. Leave it. The other export turnover also will finish. Yes. So next part is units in special economic zone. Next is units in special economic zone 10AA. So 10AA is one more section which speaks about exemption for all the units in special economic zone. So deduction under 10AA is available to all categories of SSEs, being entrepreneurs, namely individual, HUF, AOP, firm, LLP, company, etc., who derives profits from an undertaking, engaged in the export of articles or things, or providing any services where in any special economic zone. So to encourage people to come to India to sort of start their practices, their business, the government has given these benefits for what? To the special economic zone. So just write down, guys, here. Next is section 10AA. Section 10AA. Applicable to two things. One is manufacturing business. Manufacturing business. Second one is software development. This was added later after the intervention of Narayan Murthy. He said, boss, even the software development we should add, that is also like manufacture. That's the reason. So one is the manufacturing business, second one is software development, both to be taken into account. So guys, for the first, generally for the first 5 years, this is the benefit given for the first, basically though it is an exemption section, it is actually like a deduction. Though it's like an exemption section, it is to be treated as a deduction. For the first 5 years, that is the beginning year till the 5th year, how much? Based on the export profit. So to compute something called export profit, 100% deduction. 100% deduction. So guys, this 10AA is a benefit given if you manufacture in India and you export. Why is government giving this deduction? Because we will get foreign exchange. Foreign exchange. Plus, I will get employment for the persons in India. Yes, so I am telling you, please come to India, manufacture, then export. If you see Microsoft at their first, base here in India, Google also want to establish a base. They are calling Elon Musk also to start Tesla factory in India so that they can export. He is contemplating now. Initially he said no, but now again they are offering him, lot of tax benefits. So for him, he will probably think of coming to India and setting up Tesla. He's already opened a company, Tesla Bangalore, but right, yes, it is already there. But the thing is, he couldn't reach Bangalore because of the traffic, so that is closed still. So he will probably definitely not come to Bangalore. He'll go somewhere else. He'll go to Pune maybe. Yes, Pune or other place he will go where he can set up his factory. So 0 to 5% export profit, 100% deduction. 100% deduction. Next 5 years. The next 5 years. That is from, that is the 5 to 10 basically. So 5 to 10 years. Again guys, for the every year export profit, whatever is making, 50% will be the deduction. Export profit into 50% deduction. After that, the next 5 years, 10 to 15. So you will get the export profit into 50% deduction or special economic zone reinvestment reserve. So you can put your money in a reinvestment reserve where that profit that you are getting, government is again telling, please put it in a reserve and use it for reinvestment. Don't repatriate your money. Repatriate means what? Pulling out your money back to your country. Don't do that. Reinvest in India only. If you reinvest in India, I'll give you this. Whatever this 50% deduction or this reinvestment, whatever you give, whichever is less. Whichever is less, I will give you. That makes sense. Otherwise, I know you will get 50%, so you will simply take that and go. Instead of that, if you invest more in the reinvestment reserve or at least equal to that, you will be at least trying to get more. So basically, they're trying to push you to invest in the reinvestment reserve because again, you can use it in some other business in India only. Is what more employment again? Yes, that's what it is. So everywhere we have seen export profit, export profit. What do you mean by export profit? So this is the entire thing, guys. So this is how much you will get exemption. Export profit, deduction basically, export profit. So export profit will be what? PGBP of the entire SEZ unit into, in that export percentage divided by total percent. export, instead of percentage, okay, let me write turnover, it will be easier. Percentage again, it will create confusion. Let's say export turnover divided by total turnover, which means very simple, guys. For a 100 crore turnover, you got a PGBP of 30 crore. But in that 100 crore turnover, you got 100 crore because you have 65 crore you have exported, and 45 crore you have, 35 crore you have, sold it in India only. So for this, how much? So 65 into 30 by 100. How much? 19.5 crore will be your export profit. Correct? So if you have if you have made a turnover of 100 crore, you have earned a PGBP income profit of 30 crore. PGBP. Profit and gains of business. Final gain will be how much? 30 CR. So that's okay. Basically in this 100 crore, 65 crore you have exported outside. So the corresponding thing, 19.5 crore is the profit you have earned purely by exporting. Since you have helped my country earn 19.5 crore profit for foreign exchange, 100% of that you can take a deduction every single year for 5 years. Every year you have to compute. And from 5 to 10 again 50% deduction I will give. Then later I will request you to put an investment where? In the reinvestment reserve. So there whatever you do, don't repatriate. So then I will give this or this, whichever is less. Very, very logical. Which one? In some other business if you do, yes, again 0 to 5. New business you open, again 0 to 5. Some other business. That's what I am asking you to open multiple companies. So it's just a incentive. Just an incentive. So then, in my turnover, we need to remember, in my turnover, following are not included. Following are not included. First, freight and insurance. Generally, if you pay insurance for everything, then you will include in the turnover. No, that is separate. Any telecommunication charges, internet, phone, mobile phone charges or thing, not to be taken into account. Then expenses. Then expenses incurred to provide technical service outside India. Yeah, services outside India. Expenses incurred to provide technical services outside India. These are not included in the turnover. This will not be part of total turnover also or export turnover also. So basically, if the goods are there to the tune of, let's say, 11 crore, I have paid freight towards that. Expenses I have paid. Freight 2 crore. So overall, my turnover, whatever I have sold, is 13 crore. This I have recovered from the consumer. I have recovered from the consumer. This telecommunication charges also. This is an actual expense, but I have recovered from whom? The customer. So if I have to go and install the machinery outside India, I have asked him to pay for the technical charges. All that is actually my expense, but what have I done? I have recovered from the customer. So they are telling, since you have recovered from the customer, do not take it into account. So here my export turnover will not be what? 13 crore, it will be 11 crore. So the turnover will be 11 crore. Apart from that, when I make more and more sales, government will give me incentive. When I make more and more sales, government will give me incentive. What are those incentives? There are 3 incentives. One is duty drawback. It's not on, isn't it hot? Or you made it some 30, 35? Duty drawback. Duty drawback is one. Second, those fellows have switched off everything. Cash compensatory support. Cash compensatory support. And third one, import entitlement license. Import entitlement license. So, duty drawback, cash compensatory support, import entitlement license. These are the three names given for benefits or refund given by whom? Government and other agencies. Cash compensatory support, government will give you cash back, correct? And for you to push the sales for happening, they will first give you a compensation support and later you can recover from that. Import entitlement license. So it will, because you are exporting, relating to those raw materials, you can import other items also. The right to import is given through that license. Rather than a normal import license, it's a fast track license where goods you will get first because you are using them for exporting. Yes, so all these things also, this will reduce your turnover because it will reduce your, what do you say, it's actually like if you make 100 crore and in which you get 10 crore duty drawback, actual turnover is how much? 90. So this also should not come in turnover. Not come in turnover. It will not come in turnover. So what is that SEZ reinvestment reserve? What is the SEZ reinvestment reserve? This is for purchasing. Did you write till here? Only this much you study and go, guys, more than sufficient. So SEZ reinvestment reserve is what? It is for purchasing new plant and machinery. For purchasing new plant and machinery within 3 years and also put to use in 3 years. Yes, put to use in 3 years. So basically, if I have put some money in the year 22-23 in the SEZ reinvestment reserve, then you should purchase within 25-26 we need to purchase. Not just purchase, also put to use. If not used, entire amount will be taxed. Entire amount will be taxed. Got it? So next, some other points you see here. Computation 100%, 50%, all that we have seen. Export turnover. What happened? You have written down? Okay, write down. This one you have written down, duty drawback. Okay, write down this. 2-3 extra points are there. Let me check. Huh? What? Mouse. Done. Next, guys, write down. Then, if here, 1 second. Total turnover, all that. These three things, guys, here. The Special Economic Zone Reinvestment Reserve Account should not be utilized for distribution of dividend, remittance outside India, creation of any asset outside India. This also write down. It should not be utilized for these three things. My intention is only if you study the notes, more than sufficient. The reinvestment reserve account should not be used for the following. Dividend distribution of profits, remittance outside India, creation of any asset outside India. Done. Then what are the written? These three. So basically, dividend distribution of profits outside India. Second, remittance outside India of as profits. That is, you cannot repatriate. That is called repatriation. Cannot do repatriation. And creation of any asset outside India. Cannot use it to create an asset which is outside India. So if you use it for this, what they are trying to tell is whatever you have utilized will be subject to tax. So it will be taxed. There will be no deduction given. It will be fully taxed, whatever you did. Sorry? Yeah, whatever. But that part of the amount. So how much amount that you are repatriated. So that reserve is created is, let's say, 20 crore, in which you have repatriated 5 crore. 5 crore is taxable. 5 crore will be taxable. So next part, export turnover will not include foreign currency which is not brought into India. So when I sell something now, I have to bring it back to India. If I just sell it outside and not bring it to India, will it be taken in export turnover? No, it will not be taken in the export turnover. Yes, so obviously they are trying to tell that it should be brought into India. Then for the purpose of computation of deduction, total income after set off of all losses will be considered. So you please brought forward loss, everything you set off, and finally only that will be used as a deduction. Why? I'll not give you a double deduction. I'll not allow you to, what do you say, take this brought forward loss also of 2 crore. And then what? Set off, not allow you to set off this. First of all, there is an overall deduction of 10 crore available, brought forward loss of 2 crore. I cannot allow this 2 crore separately, then give you full 10 crore reduction. No. First use a set off, then only 8 crore I can give you the reduction. That will be the export profit, is what they say. Next. So I told you that it cannot be said that it's brought into India. Now, one thing is, because of Narayan Murthy, even this on-site development of computer software, all these things also will be deemed to be export profits. That is what? In India only, I am developing the computer software. Accenture has asked Infosys to develop a software in India, but it is utilized where? Outside India. So, isn't it export? Yes. Sitting in India, I am creating something which is used outside India is export. So, all this will be sorry? It will be in SEZ or it will be anywhere, but doesn't matter. Here, this 10AA, for 10AA purposes, it should be in a special economic zone, obviously. That's what they say. So, if so now here you see profits earned as a result of deployment of technical manpower at client place abroad for software development shall also be eligible for 10AA. So we will just write down 4 things. The following are also allowed. Last part. The following are allowed as export turnover. The following are allowed as export turnover, or rather export profit. First, on-site software development. On-site software development is allowed. Means what? I'll go to the client place and develop software. So it is basically like exporting. Second one is supply of manpower. Supply of manpower. So, let's say Capgemini from Germany, they want you to come, they want Infosys to send 40 employees for a project there. Are you exporting services? Yes, through sending people there, you are exporting services. Will it be money that you have earned by sending people there for your project? So these 40 people are looking after a project there. What do you think? That will be considered as export turnover? Yes. Yes. What about transfer of SEZ? The entire SEZ is relocated elsewhere. This is one SEZ. Here only if you are there, I will give you for 10 years. I stayed here for 6 years, then relocated to one more SEZ. Yes, so remaining period allowed. Remaining period allowed. Then SEZ is owned by one guy, now somebody else owns. Change in ownership. Allowed. Change in ownership allowed. Done. So guys, so let's solve one question. Okay, question number 9. Mr. Atharva, proprietor of Anime Associates, owns an undertaking, Unit X, in Special Economic Zone. Did you know it is in Japan, if you go and tell anime, they'll slap you. It is anime. That is how you need to pronounce. Anime, not anime. If you go to anime, tell, they'll slap you. They are the creators of anime and manga. Right. Yes. Anime Associates. In India, we can do whatever we want. Yeah. Owns an undertaking, Unit X, in Special Economic Zone for manufacturing of computer software. He furnishes the following particulars of its second year of operations ended on 31st March 2023. Total sales 180 lakhs, export sale 90, profit 60. Compute the deduction. Answer. Total turnover, let's write down. That is solution number 9. Total turnover. $180. Export turnover. $90 in lakhs. Profit derived from eligible undertaking. Next, eligible. What is eligible profit, guys? This is A, B and C. What will be the eligible profit? This is D. D is equal to C into B by A. Yes. How much? How much? 30. Eligible profit under 10 AA will be 30. Yeah, eligible deduction under 10 AA will be, so eligible deduction 30 lakhs. Let us see. Yes, question number 10. Come on, guys. Mr. Phantom is running 2 industrial undertakings. One in SEZ, unit Zoya. Other one in normal area, unit Zara. The brief summarized details of the year ended 31/3/2023 are as under. Domestic turnover, unit Zoya 10, unit Zara 100. Export turnover, unit Zoya 120, unit Zara nil. Gross profit 20 and 10. So in Zara there is no export turnover. Expenses and depreciation 7 and 6. Profit derived from the unit 13 and 4. Brought forward losses for unit Zara is 6 lakhs. Briefly compute the net total income of the SSE. What is the total profit, guys? So here, should I take unit wise or should I calculate for the entire company? Sorry? Profit? Okay. No, but the entire, one more question. The deduction available to SEZ, will it also exceed the overall profit of both the units or only SEZ unit? What do you think? Both the units or SEZ unit? So let's do the deduction under section 10AA first. So what is the question number 10? What is the deduction allowable under 10AA? First one, domestic turnover, how much? Domestic turnover. What is the domestic turnover here of Zoya? 10 lakhs. What is the export turnover? Export turnover 1.2 crores. Then profit derived from the unit. For that total turnover 1.3 crore. Profit derived from the unit. How much? $13 lakhs. So, what is the deduction available under 10AA? No, that we'll see. First we'll just do the deduction available under section 10AA. We'll do all that. How much? How much? 13 lakhs into 10 by, no sorry, into 120 by 130. Correct? So 13 lakhs into 120 lakhs by 130 lakhs. How much? 12 lakhs. 12 lakhs. Question is, will full 12 lakhs be available or should I also consider the brought forward loss? Should I consider the this is the available. I am not saying I am going to use this. This is the deduction which is available. Deduction which is available. So in that obviously I have to subtract what? Brought forward loss. So first computation of business income. Computation of business income. Computation of business income. Guys, business income obviously I have to take both the units, right? Total profit of the company I should take. Business income, total profit. That will be how much? 13 lakh. From one company it is 13 lakh. Second company it is 4 lakh. Second company it is 4 lakh. What is the total business? 17 lakh. Less, obviously brought forward loss I will consider it as a full business only. For the entire business, what was the brought forward loss? 6 lakh. 6 lakh. So what is the total income that I have? Total income before giving effect to, section 10AA. What is it? Total income before giving effect to 10AA will be 11 lakhs. So after subtracting the business loss, brought forward business loss also from the entire business, my total income will be 11 lakh. But guys, if I give the deduction, I'll be giving deduction of 12 lakh. Is it allowed or not? No. So the deduction cannot be more. I cannot claim one loss and all from there. So what is the final deduction? Yes, the less deduction under section 10AA only to the extent of profit. How much? 11 lakh. So what is the taxable business income? Taxable business income will be nil. Done. So that is about this export turnover. Other things you can solve, 2-3 other questions are there. Done guys. So in this they can either ask you that rubber, tea and all those things, or they'll ask you the aggregation of income, or they can ask you the export turnover problem. So generally it may not come, but if it comes, it will come for around 4 marks one question. Or MCQ they can ask you like 1 to 2 marks like that. So since everything is part of the syllabus, we cannot leave anything guys. So till the next 15 minutes, I don't want to start law now. Just do the basics of something else and then we will stop for the day. No problem. First of all, 6:30 class I made 5:30. There also Sar, Sambar, nothing doing. Come back. What is there? SAP. So no time for revision. Right. Come back, come back. I was supposed to take till 6:30. I'll take. No. Come back guys. Come on. Who is a CA who will work 4 years of his life like nobody else will, so that he can live the rest of his life like nobody else can? Simple. If you want to enjoy in the future, you need to slog now. No Sar, Sambar, etc. And I have the right to tell because I have also studied like you only. Honestly. I cannot say, no, you should study. You will tell, hey, who are you? I have also studied just like you. And that time, to add, I am not boasting, but we had articleship also. Because after CPT, we had to do articleship. So it was, to be very honest with you, much more than what you are doing. I am not trying to degrade you. Please don't think otherwise. Really, we had much more than you because we had college and articleship. And articleship used to be crazy traveling. So we have all done it guys. I know how it is. I am not even saying it is not difficult. But run with your mind, not with your legs. I told you in the day 1 that we didn't understand that time. Now we know. Run with your mind, not just with your legs. Physically you will be very tired. Mentally you will be drained out. So you will be a social outcast. You will be friendless. You will be, completely, dejected, depressed. Congratulations, you are a chartered accountant student. That's how we should all be, yes. Right, no choice. We will be like that. We will be hopeless, homeless, chaprasi, number 1. If you open wallet will laugh at you. April Fool, right? Nothing will be there inside. But it is how it is, no choice. And worse will be once you start articleship. After slogging for so many hours, you will get 3,000, 1,000, like that. So now at this stage, after you become a CA, 3,000, 5,000 will be peanuts for you. But now, Mic testing, it's not gone, it's working. Little bit here and there, still there, going on. So yes, that's how it is, guys. So come back, we will check something and we will just stop for the day. So we were doing the, what do you say, how, direct tax, correct, thank you. Yeah, we will do alternate minimum tax, just the basics, AMT, alternate, just the basics. Hardly anything is there, it's just 2 pages, but nevertheless, we'll just go through quickly. And then the alternate tax regime and then computation of total income. So first, today no. Maybe I'll finish early, and in case they have other plans for company law, then I don't want to waste your time. Maybe they can allot something else. So I'll speak to them today. I don't want to simply drag for the heck of dragging, right? If something else can be allotted, because now time is of the essence. I'll also go and spend time with my family if they are leaving early. That's not the problem. But if the syllabus was there, I would have done. But simply for the heck of dragging, simply taking slow, giving 2 hours break, that is not me. You also know. But I want to sort of, let me ask them today. Because if they have anybody else or any other classes, they can allot it. You shouldn't waste time, guys. If the syllabus is over, what will I do here? Simply wasting your time. I will get paid, for me no tension, but that's not my intention. So alternate minimum tax, AMT. Alternate minimum tax, AMT. So AMT credit. So I explained the concept of AMT. As I told you, AMT was similar to MAT. So Chidambaram said, bro, you are earning from all these ATIB, ATIA, all these deductions you are earning. 10 AA, for example, 10 AA you are earning deductions. At least some mana maryada you have. Some tax you pay. And don't worry, it's like advance tax. Later I will give you credit, but something you pay. So for companies, he created MAT. And for individuals, it was AMT. And AMT, I think, was introduced by Jaitley. MAT was 100% Chidu. So MAT was there, it was success for a few years. Then Arun Jaitley introduced alternate minimum tax. You're like, bro, we should do something different. MAT is already there. What to do? Minimum alternate tax. Reverse. Alternate minimum tax. That is for individuals. Correct? Yes. So AMT. This was 115 JB was MAT. 115 JC is AMT. Provisions of 115 JC with alternate minimum tax shall apply in respect of all SECs other than company. Why? Yes, MAT is there. Thus, AMT shall apply to individuals, HUF, firm, LLP, AOP, BOI, and artificial juridical persons. It will apply to everybody except companies. So, alternate minimum tax means the amount of tax computed on something called as adjusted total income at the rate of either 18.5% or 9% as the case may be. 9% we'll see later, but predominantly it's only 18.5%. So, very simple, guys. If I write down here AMT. First one, applicable to all SSEs except companies. If they are allotting somebody some other class, then we can stretch a little tomorrow, day after, and finish it off. Actually, there is nothing to stretch also. We are doing already only 2 more chapters are there over. AMT. Huh? We'll do. 2 sums we'll do. How much more you want? Enough, da? Revision? Not enough. Why? 2 full-fledged sums, like proper full-fledged. Each one will take minimum 1 hour. All put together. So you can do it. Applicable to all SSEs except companies. Second is what? So basically 115 JC. Tax on normal provisions. Tax on normal provisions of income tax. I should compute normally or obviously adjusted total income into 18.5%. That will be AMT. Adjusted total income into 18.5% AMT. So this will be whichever is higher. Whichever is higher. Whichever is higher, this I will what? Pay to the government. Whichever is higher will be paid to the government. Adjusted total income into 18.5% or this, whichever is higher. Will I get the credit? Yes. Will I get MAT credit? AMT credit, sorry. Yes. If this year it is 0, but what I am supposed to pay is 0, but what I have to pay as per adjusted total income is, let's say, 2 lakhs. Will I get 2 lakhs credit? Yes. Tomorrow when I actually have to pay tax, I will get a credit. So it's predominantly more like advance tax only. For you, for taking all the deductions, please pay advance tax. So the adjusted total income, what do you mean by the adjusted total income? Adjusted total income. So first is what, guys? NTI, net total income. Whatever income I get, net total income. Add. So you should add back all the deductions you have taken under section 35 AD. What is 35 AD? Specified with cold chain, all those things. Second, if you have taken any deduction under section 10, two A's. So 10 AA. Add back. Net income is what? Whatever after all deductions. I am adding back the deductions. So that is the actual profit. Third one, if I have taken anything under 80JJA, QQB, RRB. Tell me, guys, revision. What is JJA? You can see and tell, no problem. 80JJA is what? J. Jayalalitha. Yes, additional employees. Remember an additional employees problem we had done? Yes. QQB? Yeah, Quran, Bible. Royalty on books. Oh, yes. Quran, Quidditch and Bible. Yes. Next. RRB. Royalty on patents. Right? So, RRB. So, all these things, I am getting lot of deduction there, no? How many years I am getting? Like new employee and all, I am getting every year. So, all that I have to add back. I have to add back. So, once I am adding back, guys, now tell me one thing. I am adding the deduction under 35 AD. What is 35 AD? Specified business assets I am adding back. Don't you think so I should give them depreciation benefit now? Guys, 35 AD is capital expenditure or revenue expenditure? Capital expenditure. In normal scene, 35 AD I will take full 100%. If I buy a capital asset of 2 crore, full 2 crore I will subtract in my P&L. Now if I am adding back, don't you think so at least depreciation I should allow? Logical. So less depreciation. Depreciation allowable under section 32, assuming 35 AD is not claimed. 35 AD is not claimed. So I will subtract. So what I will get will be my adjusted total income. Got it? Adjusted total income. So tomorrow we will solve questions on alternate minimum tax, AMT. Then we will move on to the main thing. What is that? The other tax regime. we'll solve that, and we will do our law, ignoring negotiable instruments, we'll do, try to finish it, and then day after tomorrow, computation out. Depends, I will just ask them what is the plan. If they don't have any other plan for us, if they have any other plan for company law, whatever, let me ask them. They may have some plan because they would have planned for you guys what it is. So I don't want to, you know, sort of affect those plans. Let me ask them. If they say no, you have to stay for 2 days, I don't have any problem. So I will do full revision of DT, and then we will do the computation of total income problems. I will occupy you, that's not the problem, but my only worry is seeing your syllabus still not being completed in other chapters. If they can allot somebody, at least your portions will get over. But I can still do the revision and it will really help you, undoubtedly. But what I am trying to tell is, if given a choice where you can do other subject, at least completion, this revision you can see my YouTube video also, and I will record it separately. Which one? I will make everything available. I have not recorded anything. So I will make it available on YouTube, only the marathon revision of all the concepts. So let's see. I have not recorded anything. I'll record. I would rather record separately and upload if it saves your time. Because if I see my interest, I can drag till 8th also. I'll mint money. But that's not my point. Because I saw your syllabus, it's still decent level, has to be still completed. So I'm seeing your time only and figuring it out. And since you guys came early in the morning today, I thought I'll leave you, because if I take 1 more hour, I know tomorrow morning you'll be dead. So I understand all those things. That's why I'm leaving you early. Okay? See you. Hey, where is this Brookfield Mall? I used to do some time pass. Here only. Not Brookfield Mall. Sorry. Very minute changes, but of course important changes, and you can expect these questions in the exam. Salaries, profit and gains of business or profession, income from other sources. Respect to your life insurance policy 1010D exemption, there is a change. And little bit of advanced tax, TCS, TDS, etc. Especially TCS, very important change has come with respect to the TCS on the liberalized remittance scheme, and some provisions relating to return of income, etc. That is all okay. The first change is rent-free accommodation, my dear friends. So if you come to our notes in page number 5.14, we had seen the perquisite 5.13. That is your rent-free accommodation in terms of, for government employees and for others. So basically for government employees, what was the deal? It was taxable as per the license fee decided by the government. And for other employees, if the entire accommodation is owned by the employer, then I had to see the population. If it is hired by the employer, then I should see the, taxable amount would be 15% of salary or higher charges, whichever is less. And if it is owned by the employer, then population I should have checked. If it is less than 10 lakh to 25 lakh and more than 25 lakh, then it was 7.5%, 10% and 15%. And hotel benefits, some other provisions were there. Now, interesting thing is rent-free accommodation may include furniture also, right? So in case value of furniture, which was there as part of the deal, so here I had to add the value of furniture. If it is owned by the employer, 10% of the original cost of furniture, or hired by the employer, actual higher charges is what was there. So ultimately, taxable rent-free accommodation used to be value of unfurnished rent-free accommodation plus value of furniture. That will be a total rent-free accommodation. So to this, some changes have come. That is what is given here in the statutory update. This can be downloaded from the institute website. If you go to our Board of Studies knowledge portal, you will get all the details here. Okay, so here from 1st September 23, the CBDT has provided these notifications, substituted Rule 3.1 to specify the manner of determining the residential accommodation. So this is what is the new deal, where the accommodation is provided by the central government or any state government to the employees either holding office or post in connection with the affairs of the union or such state. So basically central government or state government employee. So earlier what was the deal? It was just the license fee as decided by the government. Nowadays they are also collecting some rent from them. Employee is also paying some rent. So to make it very easy and to make it fair to everybody, this is the change. License fee continues as reduced by rent actually paid by the employee. So this part was not there. Now they have added this as reduced by the rent actually paid by the employee. Apart from that, this will be added. This is what my furniture shall be increased by. If furniture is owned by the employee, same thing. See, 10% per annum of the cost of furniture. So here also, you see, it was the same 10% of original cost of furniture. The wordings have changed to what? Per annum of the cost of furniture. Every year, 10%, 10% you should do. That includes television, radio, refrigerator, air conditioner, everything you should do. If it is owned by the central government or state government. If it is not owned, if it is hired by them, then actual hire charges as reduced by, as I told you, any charges paid or payable by the employee during the previous year. So here what they have made a changes, which is very fair, I would say. Apart from just the license fee, you also reduce the actual rent paid, which this is same thing we're doing in the sums also, but anyway they have just given it in the final notification like that. Apart from that, 10% per annum you should take of the value of furniture if it is owned by employer. If it is hired by employer, then hiring charges and minus the thing already recovered is what they are trying to tell. So let's say the license fee turns out to be 2 lakh and you have recovered from the employee 1 lakh. So 1 lakh will be my perquisite. To this, I have to add the furniture. Furniture is owned by the employer, that is by the government. Let's say the furniture valued of 10 lakhs is given. So 10 lakhs into 10%, 1 lakh is added. Totally 2 lakh will be my perquisite. On the other hand, if this furniture is hired by the employer, central government hires it out from somebody else. It pays around 2 lakh rupees to somebody, higher charges, and they recover 1 lakh 50,000 from the employee. But this 50,000 is the extra benefit. So then the perquisite will be 1 lakh plus 50,000, 1 lakh 50,000. That is what this entire thing is about. On the other hand, here, where the accommodation is provided by any other employer, where the accommodation is owned by the employer, 10% of the salary in cities having population greater than 40 lakhs, 15 lakhs to 40 lakhs, and in other areas. So this has changed, guys. So come to this particular page number 5.14 and make the change here. Greater than 40 lakhs. Greater than 40 lakhs. Then here the amount of taxable salary will be 10% of salary. Next, more than 15 lakhs, less than 40 lakhs. More than 15 lakhs, less than 40 lakhs. This 15 to 40 lakhs. This will become 7.5% of salary. And if the population is obviously less than 15 lakhs or any other case basically, then this will become 5% of salary. That's the change. So now population less than 15 lakhs, 5%. 15 lakh to 40 lakh, 7.5%. More than 40 lakh, 10%. That is the change here, guys, nothing else. As reduced by rent, if any, that is normal, whatever is there usually. And if it's owned by the same thing, 10%. Otherwise, higher charges as reduced by these things. Very fine. That's the same. Where the accommodation is taken on lease or rent by the employer, means if it is hired by employer, then if you see, actual amount of lease rental paid or payable by the employer or 10% of salary, whichever is lower. So this will be 10%. Please make these changes in the notes. Page number 5.14. Okay. 10% of salary or higher charges, whichever is less. So those are the changes, guys. Population less than 15 lakh, 5% of salary, 15 lakh to 40 lakh, 7.5% of salary, population more than 40 lakh, 10% of salary, taxable amount, 10% of salary or higher charges, whichever is less. Where the accommodation is provided in a hotel by the employer being central or state government or any other employer, this part, up to 15 days, no problem. Otherwise, you see here, 24% of salary paid or payable for the previous year are actual charges. That remains the same, whichever is less, as reduced by rent actually. So 15 days, up to 15 days, nothing. So this will remain the same, no problem. This will not change. Okay. So now let's say you are transferred from Bangalore to Chennai, and but you are living somewhere else. Your family, etc., is in, let's say, Raipur, but you are presently in Bangalore but shifted to Chennai. Since you're shifting, they are asked you to vacate your house in Bangalore and they're giving you a hotel there. And even in Chennai, they have given you a hotel until you find a accommodation. Now you are being given property both the places. What to do? So if an employee is provided with accommodation account of his transfer from one place to another at the new place of posting while retaining the accommodation at the other place. If not given a hotel in Bangalore, whatever quarters you had in Bangalore that you are retaining, and in Chennai also they are giving you a hotel or one more accommodation for a brief period, whatever it is. Like maybe 30 days, 40 days or 20 days, they are giving you accommodation at both the places. Value of the perquisite shall be determined with reference to only one such accommodation which has a lower perquisite value as calculated above for a period of not exceeding 90 days and thereafter both. So guys, for 90 days, you compute the perquisite in Bangalore, you compute the perquisite in Chennai, whichever is lower you take for 90 days only. After 90 days, nothing doing, both you should take as a perquisite. That is what they have told. And in case the accommodation is taken on lease or rent by the employer, that is this case, hired by the employer, what we should do take generally 10% of the salary or higher charges, whichever is less, right? Yes, that's true. But next year, what will I take? For example, higher charges, they have hiring, your salary is, let's say, 40 lakhs. What is the higher charges? 10%, 4 lakhs. It will be a perquisite. But that property, they are hiring at 6 lakh rupees. So it is 4 lakh or 6 lakh, whichever is less. Which is less? This one. Correct? Next year, this is first year, no problem. Next year, they will increase your salary to, there's a huge hike, 70 lakhs. You've done some good job, good work, 70 lakhs. Now what will become 10% of salary? 7 lakh. 7 lakh or 6 lakh, whichever is less, will you take 6 lakh? That's the question. So that's why this provision is given. See, where the accommodation is owned or taken on lease or rent by the employer and the same accommodation is continued also to be provided to the same employee for more than one previous year, the value of the perquisite as calculated in 2 shall not exceed the amount so calculated for the first previous year. Mind you guys, first previous year means 1st April 23 to 31st March 24. That they have given here very clearly. Previous year 23-24. Or the previous year in which accommodation was provided to the employee, whichever is later. So the base year is this much only. Going forward is what they are saying. So this is all amendment which has come for previous year 23-24. As multiplied by the amount which is a ratio of the CII for the previous year for which the value is calculated and the CII for the previous year in which accommodation was initially provided to the employee. So they are saying going forward, let's say the accommodation was provided to you when? 23-24. Accommodation was provided to you in 23-24. Right? Next year I'm saying in 24-25 what to do. So here accommodation was provided, I told you 40 lakhs was your salary, 60 lakhs was what they were, 6 lakhs were what they are paying for that accommodation. So 10%, 4 lakhs or 6 lakhs, whichever is less, 4 lakhs. No problem. Value of perquisite is 4 lakhs. Next year, your salary is increased to 70 lakhs. So 7 lakh or 6 lakh, whichever is less. Should you take 6 lakh is the question. The answer is no. You should take this only, 4 lakh into either this, they are saying 6 lakh, or this 4 lakh into cost inflation index of 24-25 divided by cost inflation index of 23-24. Very simple. For 23-24, with the cost inflation index, it was 4 lakh. So for 24-25, what will it be? So 4 lakh into CII of 24-25 divided by 23-24. Like that. This question you may not ask, they may not ask because we are in 23-24 only for our examination. But still you should remember. So either it will be 6 lakhs or whatever value comes with this, whatever value comes, that we have to take into account, whichever is less we should take, obviously, because it says it shall not exceed. It shall not exceed is what they say. So the CII for 23-24 is 348, and this, let's say they make it as 360 or something, let's say. So next year, what will be the value of this perquisite? This is the base year or first previous year. So when the CII was 348, it was 4 lakh. So when the CII is 360, what will be the value? So do the math. How much will it be? Let me just do. I'm just saying. So now they will not give, but later they may give like that. Let me make it like 470 or something. 370, sorry. So 4 lakh into 370 divided by 348. 4 lakh 25,000 something, it will come. So it will come up to 4 lakh 25,000. So that's what, 4 lakh 25,000 or 6 lakh, which will you take? 4 lakh 25 only you will take. That's what they are trying to tell, that whatever value you fix it in the base year will be 23-24. Then you should use the CII method. You see, if the same accommodation, if where the accommodation is owned or taken on lease or rent by the employer, the same accommodation is continued to be provided to the same employee for more than one previous year. The value of perquisite as calculated in 2 above. What is the value of perquisite calculated? 4. Shall not exceed the amount so calculated for the first previous year, 4 lakh, as multiplied by the amount which is the ratio of CI of the previous year in which the value is calculated. And what is the year for which value is calculated? The next year, in my example, 24-25, divided by the CI of the previous year in which the accommodation was initially provided, 23-24. That's all. For the first previous year means 23-24 onwards. So this will come for the next year, so you leave it. But anyway, you should know. Now, my dad was in the Indian Forest Service, and many times in his tenure, he was deputed also. On deputation, they send it. So the Karnataka government owned a stake in something called as Mysore Paper Mills Limited. It was a state government owned undertaking. And my dad was director forest of Mysore Paper Mills. For 2-3 years he worked there. So though he was Karnataka Forest Department, Indian Forest Service, he was deputed to Mysore Paper Mills to look after the inflow of trees, etc. Because for paper you need trees. So now I remember we also had gotten accommodation that time, right? So then in that case, what will be the perquisite? Is the employer Karnataka Forest Department, Karnataka government? or is the employer Mysore Paper Mills Limited, which is a separate company? What to do? So if you see, where the accommodations provided by the central government or state government to an employee serving on deputation with any body corporate. So my dad, state government, though is a central government employee, is serving as director of Mysore Paper Mills. So who's the employer here is the question. Central government or Mysore Paper Mills? That's what they are trying to tell. Employer of such employee shall be deemed to be that body corporate where the employee is serving on deputation. So who's the deemed employer? Mysore Paper Mills. Value of the perquisite of such accommodation shall be the amount calculated in accordance with as if the accommodation is owned by the employer. That's all. It all goes down to the employer now. That's what they're trying to tell. Done. So next, under 35D, amortization of preliminary expenses. So let's see the notes. Page 7.24. Amortization of preliminary expenditure. Expenses before commencement of new business and after commencement of new business for setting up of a new unit or existing undertaking, whatever the case may be. This is the limit that you will get. 5% of the cost of project or 5% of capital employed, whichever is higher, or preliminary expenses, both whichever is less, company or SSE. Company SSE basically. Others, preliminary expenses or 5% of project, whichever is less, you will get. Deduction is allowed in 5 equal installments. This is what we normally know. So here, SSE has to furnish a statement containing the particulars of expenditure in connection with these things. So you should furnish a statement as to what all expenditure you have spent on preparation of feasibility report, project report, any market survey, engineering service, etc. A statement has to be given with all the particulars. Only then you will be eligible to get that 1/5 deduction. That's what they are trying to tell. This statement is mandatory. So this is a very theoretical thing. You can just go through. So you need to prepare a statement. Now, guidelines with respect to 1010D. Life insurance policy. Other than ULIP. So if you see in our material, just a sec, 9.18 guys, page number 9.18 in our material, all the details are given. Here under ULIP it is given 8.41 is about ULIP, but other than ULIP it is given in 9.18. All these provisions. So all these now especially will change to this, come to this page, is most important. Yeah. Section 1010D provides for exemption of the sum received under a life insurance policy, including the sum allocated by way of bonus on such policy, subject to the condition that annual premium does not exceed 10% of the actual sum assured. So if your premium is less than or equal to 10% of sum assured, then you will get an exemption under 1010D. Whatever amount you receive from a life insurance policy, whatever you receive in the end as a maturity amount, fully it will be exempt in the hands of the taxpayer, provided your premium is less than or equal to 10% of the sum assured. However, with effect from 24-25, 1010D has been amended to provide that in case where an SSC has a single life insurance policy other than ULIP, because ULIP definitely is taxable. Unit linked insurance plan is unit linked insurance policy is taxable. This is a different thing. Single life insurance policy issued on or after 1/4/2023. Exemption under 1010D would not be available with respect to any life insurance policy issued on or after 1/4/23 if the amount of premium payable exceeds 5 lakh rupees of any previous year. So this is for all the policies issued after 1/4/2023. If the premium amount is more than 5 lakh rupees, then this section, the exemption will not apply. Mind you, for the policies issued before 1/4/2023, this 5 lakh rule will not apply. But what will apply? This 10% rule will apply. But if it is after 1/4/2023, even if it is less than 10% also, but if the premium happens to be more than 50 lakh rupees, then, 5 lakh rupees, then there is no exemption as such. We will see examples. Institute also has given examples via notification. It will easily be understandable. In case where an SC has multiple life insurance policies, guys, issued on or after 1/4/2023, and it has multiple policies and the aggregate is exceeding 5 lakh rupees. Aggregate is exceeding 5 lakh rupees. But the premium is definitely less than 10% of the actual sum assured. So this rule you have to follow. Premium should be less than or equal to 10% of the sum assured. That will remain the same. However, individually those policies are like 1 lakh, 1.5 lakh, 2 lakh, 2.5 lakh, everything. But if you add everything, it is crossing 5 lakh. Then the lawmaker says that they are at the option of the SSE. Whosoever aggregate premium does not exceed 5 lakh, then you can claim exemption for them. For this also, I'll show you examples, don't worry. Death of a person, obviously, exemption will be available. Now, guidelines says, check the examples. They have only given examples because it becomes very, very simple. Situation number 1. No sum of any nature, including bonus, is received by the SSE for any of the life insurance policies issued on or after 1/4/23. During any previous year preceding the current previous year, or consideration has been received on such eligible life insurance policies in an earlier previous year but has not been claimed exempt. In such a situation, it will be determined as under. What is this? Never have I received any amount from the life insurance policy. There is no maturity amount received. I have never claimed any exemption before. And all the, life insurance policies have been issued after 1/4/2023. So how will I compute my exemption? Let's see the examples, guys. Very, very simple. If the amount of premium payable on such eligible life insurance policy does not exceed 5 lakh rupees for any of the previous year during which the eligible LIP and annual premium does not exceed 10%, then full exemption you will get. But the moment your premium is more than 5 lakh rupees for any of the previous years, then that consideration would not be eligible for 1010D. So guys, you should fulfill the first condition of premium should be less than or equal to 10% of sum assured. If this condition is satisfied, next you see whether your premium exceeds 5 lakh. If it is less than or equal to 5 lakh, no problem. The moment it exceeds 5 lakh rupees, gone. You will not be eligible for any exemption. Nothing to worry. See the example, you will understand. Date of issue 1/4/2013. Annual premium 6 lakh. Sum assured 60 lakh. So is the premium less than or equal to 10%? Yes. So is this condition fulfilled? Yes. But does the premium exceed 6 lakh? Yes. But most importantly, what did I tell you here? Here only I told you. This 5 lakh will come only and only if you have issued the policy on or after 1/4/23. If you have issued your policy before 1/4/23, this 5 lakh concept will never come, only the premium concept will come. In this example, you ignore the date of issue for a while. If you ignore the date of issue, have I breached? My first condition is what? Premium must be less than or equal to 10% of sum assured. Premium is 6 lakh, less than or equal to sum assured, 10% of sum assured, 6 lakh. 6 lakh is equal to 6 lakh. So, is the condition fulfilled? Yes. Second condition, the premium, is it more than 5 lakh? Yes, it is. But I told you that premium 5 lakh I should see only and only and only if the policy was issued after 1/4/23. In this example, policy was issued only after 1/4/2013. So that 5 lakh concept will never come. So this entire 70 lakh that you have received on maturity, that entire 70 lakh which you have received on maturity is not, is not taxable, it is fully exempt. Since annual premium does not exceed 10%, the policy has been issued before 1/4/23, limit of 5 lakh will not apply, and hence it is not an eligible, and it's not an eligible ULIP also. If it's a ULIP, then it will be taxable. Next you see, this is, first of all in the exam you should see date of issue. The moment date of issue comes now, automatically two conditions will come. Condition number 1, premium must be less than or equal to 10% of sum assured. In this premium is 5 lakh, sum assured 50 lakh, 10% of sum assured 5 lakh. Is 5 lakh equal to 5 lakh? Yes, so first condition satisfied. Second condition, premium should not exceed 5 lakh. Is it exceeding 5 lakh? No, both the conditions are satisfied. Hence, this entire 52 lakh received will be exempt. Very, very simple. Here you see, condition number 1, is it issued on or after 1/4/23? Yes. Second condition, is the premium less than or equal to 10% of the sum assured? Yes. Third condition, is the premium more than 5 lakh? Yes. The premium is more than 5 lakh and no exemption. 3 conditions in the exam. First one, is it issued after, on or after 23? Second condition, is the annual premium less than or equal to 10% of sum assured? Third condition, is the premium less than or equal to 5 lakh? If it is a yes, if it is a yes, if it is a yes, exemption. If 1 also is a no, basically the 2 and 3 is a no, then no exemption. If first one is a no, then third condition will not come. If first one is a no, means it is issued like some 2013 or something, then the third condition will never come only. On the other hand, if we have received more than one, if you have received many items, if you have applied in multiple policies, and if you have received money, what to do? Aggregate amount of the premium payable on such eligible LIPs does not exceed 5 lakh for any previous year, and annual premium is less than or equal to 10%. Same condition, such considered will be eligible for exemption. The aggregate of the amount of premium is more than 5 lakh. Consideration in respect of any of those eligible LIPs, aggregate premium does not exceed 5 lakh rupees for any previous year would be eligible for exemption. You'll see examples. Like this, if you read, you will not understand. See the examples. So you see example number 4. Condition number 1, is it issued on or after 1/4/23? Yes, yes. Condition number 2, check the premium. Is it 10%? Yes. Is it 10%? Yes. Second condition also done. Third condition you see. 2 policies you have done. Take the aggregate 5 lakh. Is it less than 5 lakh? Yes. Less than or equal to 5 lakh? Yes. So Consideration you received on 32 lakh, 21 lakh. Since it does not exceed 5 lakh and it does not exceed 10% of the actual sum assured, therefore both policy A and policy B, that is 32 lakh and 21 lakh, will be exempt under 1010D. Here you should see the aggregate, that's all. We exempt under 1010D, simple. Next you see here, 45 lakh 10%, 4 lakh 50, condition satisfied. 55 lakh 10%, 5 lakh 50, condition satisfied. First condition, is it issued after 1/4/23? Yes. Second condition, is the premium less than or equal to 10% of sum assured? Yes. Third condition, aggregate of the premium, is it more than 5 lakh? Yes. Ideally, you will not get exemption, but you see the rule here. If aggregate is more than 5 lakh, for those policies where the premium does not exceed 5 lakh, for that you will get exemption. Which means of these two, which of the items individually is less than 5 lakh? First one. So you will get exemption here. Here you will not get exemption. Figure out. LIP A would be exempt. LIP B will not be exempt. Simple. Very easy, guys. All of you with me? Yes. Next one. A, B, C. 1/4/23, 1/4/23, 1/4/23. Yes, first condition satisfied. Second condition, 10%, 10%, 10%. Second condition also satisfied. Third condition, add all the three. Is it more than 5 lakh? Yes. But I should see now individually. Is it less than 5 lakh? No. I'm sorry. Is it less than 5 lakh? Yes. Less than 5 lakh? Yes. More than 5 lakh? Yes. So will C come? No. A and B, will you get exemption? Yes. See? Very, very simple. Then you see here 23, 23, 23. This one not applicable. When it is not applicable, that 5 lakh scene will not come at all. Even though it's exceeding 5 lakh, no problem, because it is not issued on or after 23. I hope you understood. But the 10% rule will come. Will 10% rule apply? Yes. So automatically the 62 lakh fully exempt. Yes or no? 5 lakh rule will not apply because rule number 1 only doesn't apply. What is rule number 1? It should be issued on or after 1/4/23. Here you see 10%, 10%, 10%, no problem. Aggregate, if you add more than 5 lakh, yes. But then C is more than 5 lakh individually, so for this it will not come. A and B it will come. So X will come because of being issued in 22, not 23. A and B will automatically come because of this rule. So X will be exempt. A and B will be exempt. C alone will not be exempt. Very, very simple. In situation number 2, where consideration has been received by the SC under one or more eligible LIPs, again issued on or after 1/4/23, during any previous year preceding the current previous year, it has been claimed also earlier. So already you have claimed once. You have taken many policies, in that one you have already claimed exemption. How will it be for the remaining ones? So we aggregate. So what is the earlier exempt? Whatever is exempt for already claimed exemption, can you claim again? So already which you have claimed, it is called as earlier exempt eligible LIPs, EEE LIPs. ULIP, this is ELIP. Don't add one more thing. Sir, we have ULIP, this is ELIP. Like that, don't write. Okay. So earlier exempt eligible LIPs. And corresponding examples they have given. If aggregate amount of premium payable on such eligible LIP and ELIP does not exceed 5 lakh for any of the previous year, and it does not exceed 10% of actual sum assured also, it will be eligible for exemption. Aggregate amount of premium payable on such eligible LIP is more than 5 lakh and not be eligible for exemption. Same logic. Similarly, you have done more than one. This is only one eligible LIP. This is more than one eligible LIP. Same logic. Consideration, if your aggregate of the amount premium received does not exceed 5 lakh, annual premium does not exceed 10%, then it will be eligible. The aggregate amount of premium payable of such eligible LIP and ELIP is more than 5 lakh, then if it does not exceed 5 lakh for any of the eligible years, it will be eligible. Same like before, guys. Again, see examples, you'll understand. Don't worry. Let's see the examples. See the examples, you'll have absolutely no doubt. Here, 1423, 1424, 1424, 1424, all are eligible. 10%, 10%, 10%, 10%, no problem. Take the aggregate. Is it more than 5 lakh? Yes. But I should now see what? Individual. This was received on 1/12/33. This would be received in 34. Let's take one by one now. X, it's received in 33 and individually also it's less than 5 lakh. So this is 100% exempt in 33. This is what is given here. Next, if you see, aggregate of the annual premium payable for LIP A, B, C along with X exceeds 5 lakh during the term of these policies, all put together. Definitely exceeding 5 lakh, no doubt about it. Aggregate of the annual premium payable for LIP A and the premium for LIP X also exceeds 5 lakh. A also exceeds, C also exceeds. X and C, A doesn't exceed. A is just 1 lakh. This is wrong, guys. Annual premium for LIP A and premium for, okay, aggregate they are saying. Yeah, you're right. Aggregate of A and X also will be more than 5 lakh. You're right. This is correct. Aggregate premium, you see, A and X aggregate 5 lakh 50,000 exceeds 5 lakh, no doubt about it. Consequently, the consideration under LIP A, B and C would not be exempt under 1010D because it is exceeding 5 lakh. That is what it says. Now you read carefully. If the aggregate of the amount of the premium payable on such eligible LIP and earlier exempt LIP is more than 5 lakh rupees for any of the year, consideration in respect of any of those eligible LIPs, etc., where it does not exceed 5 lakh for any of the aggregate amount should not exceed 5 lakh for any of the previous years would be eligible for exemption. So, if for example, if all these put together it was just 1 lakh, 1 lakh, 1 lakh, 1 lakh, then you will get exemption. But here aggregate all put together is more than 5 lakh, hence there will be no exemption. Because for this it is exempt. Once you have already claimed exemption, for remaining you will not be able to take exemption. It is this rule. They have given very good examples, so just follow this. Consequently, the consideration received under LIP A, B and C would not be exempt under 1010D. Not be exempt under 1010D. So these examples will help you, okay? So guys, slight difference here is, in the year 34, you have to consider the earlier exempted ones. Which is the earlier exempted one? This one. So, the premium that you paid on the earlier exempted one and the current one, if it's exceeding 5 lakh, then you will not get any exemption. That's what they say here. Whose aggregate amount of premium along with the aggregate amount of earlier exempted should not exceed 5 lakh rupees. Got it? See now here. 23, 24, 24, 24, first condition satisfied. 10%, 10%, 10%, 10%, second condition satisfied. This was received 30 lakh. It was 2,50,000 rupees. Is it less than 5 lakh? Yes. So LIPX will be exempt. No tension. Then you see aggregate of A, B, C exceeds 5 lakh in terms of these policies. For sure. You see this here. What does it say? Earlier exempted policy plus current policy should be less than 5 lakh rupees. So in the year 34, this 6 lakh is definitely not possible. It's exceeding 50 lakh. So C is definitely not possible to claim exemption. X you have claimed exemption. Now if you see these two though, 2 lakh 50 plus 2 lakh is less than 5 lakh, or 2 lakh 50 plus 2 lakh 50 is less than or equal to 5 lakh. So you can definitely claim one among these two, A and B. You can claim exemption. Why? It is less than 5 lakh rupees. So if you see here also you see for that matter, 4 lakh 50 plus 1 lakh is going beyond 5 lakh. 4 lakh 50 plus 1 lakh 50 is going beyond 5 lakh. So nothing can be done. This is again more than 6 lakh, so nothing can be done. But here you see both are maturing, no? You can do a combination of X plus A, earlier exempted plus current one, or X plus B, earlier exempted plus current one. Since the aggregate is less than 5 lakh rupees here, you can go for one more exemption among A and B according to you, your choice. What would you do? Would you rather have 24 lakh exempt or 38 lakh exempt? 38 lakh exempt is better, no? You see. Consideration received under LIP A or B, anyone can be claimed as exempt under assessment year 35, 36. If the consideration received under LIP A is claimed as an exempt as an aggregate of the annual premium A did not exceed 5 lakh, the consideration of B would not be exempt. Obviously, X is already exempt. If you claim A as exempt, B will not be exempt. If you claim B, then A will not be exempt. What would you claim? B only would be better. On the other hand, if you plan properly, you need not take this exemption at all of X. And now you can claim both A and B as exempt because you have not claimed it before. If you have never claimed it before, then this will not come under this situation at all. It will not come under earlier exempt scheme. This will come under the previous one which we saw here. It will come under this. So under this we have already discussed what is the procedure. So no tension. So alternatively you can ignore X and you can claim exemption of 38 plus 24. Or you can claim 30 plus 24 or 30 plus 38. Which is better guys? 30 plus 38. Correct? So you can choose to ignore X and claim 24 and 38 as exemption. Or you take X plus A, X plus B exemption. X plus A will be 30 plus 24, X plus B will be 30 plus 38. So always better 30 plus 38. Done. Then last example. Easy guys, very easy. Cool with a cool mind. 23, 23, 24, 24, 24, all will come. 10%, 10%, 10%, 10%, 10%, all will come. No problem. Different years it's coming. LIC, this LIPX will definitely come because it is less than 5 lakhs. So this 12 lakhs can be exempt definitely. Next, Y, when you are counting this 24 lakh, you have to add these two. 2 plus 2, 4. So definitely you can claim this also. No problem. It's less than 5 lakh rupees. On the other hand, now, when you are considering A, B, and C, you also should consider X plus Y. These are earlier exempt ones. Earlier exempt ones. This anyway will never be exempt because it's more than 5 lakh. This is out of the picture. So you should do x plus y plus a or x plus y plus b. Premium should be less than 5 lakh rupees. 2 plus 2 plus 2, 2 plus 2 plus 3, never less than 5 lakhs. So A and B you can never claim. Simple. See? On the other hand, you can ignore, that is one treatment. On the other hand, so in this example, you are getting how much, guys? 12 plus 24. You can ignore this, surrender this exemption. You can take y. Then you can either take y plus a or y plus b. Y plus c is not possible only. Because if you see 2 plus 2 is less than 4. 2 plus 3 is also less than 5. 2 plus 2 is also less than 5. So you can take both exemptions, no problem. So you can take 24 plus 24 or 24 plus 36. This is better. 24 plus 36. So you see here. In every case, under C will never be exempt. We have seen that. If consideration received under B is claimed to be exempt as aggregate does not exceed, the consideration received under A would not be exempt. Same thing. And as discussed, exemption for consideration received under B is most preferred as it is beneficial. So guys, I can ignore X and take Y plus B because I'm going to get 24 plus 36. Hope you understood. These are all the provisions with respect to ULIP. Very, very important, guys. Definitely they will ask you as an MCQ or whatever it is. Interesting provisions. In all these things, very simple, it will be exclusive of the amount of GST. When you are computing the premium, GST component should be excluded. So whatever premium I am seeing here is exclusive of GST. Limit of 5 lakh of amount of premium payable would not be applicable in case of a term life insurance policy where sum of the life insurance is given to the nominee in case of the death. If it's given to the nominee can take the full amount, no problem. Any sum received under a term insurance shall continue to be exempt irrespective of the amount of premium payable. No, premium paid would not be counted for 5 lakh also. I will not see 5 lakh, I will not see anything. Let's say if I die, my wife will get 3 crore, 4 crore rupees. That is fully exempt in her hands. If anything happens to me, this video is proof. I'm just kidding, man. Right? Yes. Got it? Right. Don't go tell anybody. Okay. All dialogues are only within the 4 walls of your room. Correct? Anything is purely coincidental and it can be denied at a later stage. Done. Next. Where any sum is received, including the amount by a bonus at any time during the previous year under life insurance policy, other than ULIP or KMP, the Keyman insurance, life insurance policy, where will it be taxed is the question. I'm telling you it's taxed, exempt, tax. Where will it be taxed? IFOS. Something which is not exempt under 1010D, the sum so received as exceeds the aggregate of the premium paid during the term shall be taxable under IFOS. So you see here in this example, I have paid, for example, guys, I would have paid over the course 20 lakh as premium, but I received 80 lakhs as sum assured. Difference 60 lakh will be taxable under IFRS. Assuming there is no exemption, so 60 lakh will be taxable. If the sum is received for the first time during the previous year, A minus B, sum or aggregate of the sum received and liability during the first previous year and aggregate of the sum paid during the premium paid. Same thing I told you, 80 minus 20, 60 lakh will be taxable. Same provision. Basically, guys, all this you leave simple provision. Whatever is you have received consideration minus whatever premium you have paid, difference only is taxable. Simple. Next, 194A provides for deduction of tax at 10% by any person other than individual or HF. It is on interest other than interest on securities. So generally, anything, any interest that you are going to get, especially on deposit with post office, etc., all these things, you will have the deductor should deduct 10%. But if the aggregate amount of interest paid does not exceed 40,000 for normal and 50,000 for senior citizen, if you have made a post office scheme, etc., then no problem. No need of any TDS to be deducted by the deductor, by the post office or whatever. So accordingly, there is one scheme called Mahila Samman Savings Certificate. So under this, it is only applicable for 2 years, 1st April 23 to 31st March 25. Maximum you can deposit 2 lakh rupees in the name of women or a girl child for 2 years at a fixed rate of 7.5% per annum. So 7.5% per annum, if you compound also, it will never cross 40,000 rupees. And hence, they are trying to tell that there will be no TDS deductible. So when you are getting that interest of 7.5% compounded quarterly, no need of deducting TDS under 194A. Easy one. Next, there is a new section 194BA, which we have discussed in class also. This is for what, guys? Online game. All your online lottery, online rugby, or any online game like Dream 11, etc. will all come under 194BA. Net winnings, whatever net winnings you get in the user account at the end of the year, 30% tax rate is what they say. So there were some doubts which were raised. They are saying, sir, if the winning is 50 rupees, 20 rupees, 30 rupees, and that fellow is withdrawing 20 rupees, 30 rupees like that, should I deduct TDS that time also, is the question under 194BA. So that's why they said no. If the winnings is less than 100 rupees, no problem. Tax not deducted on account of this concession is deducted at the time when the net winnings exceeds 100 in the same month, end of the financial year. So they are trying to tell if it is less than 100 and if you have not deducted tax and in the end is withdrawing less than 100 rupees, no problem. And in case anything is payable also, like every time is winning 100, 110, 120, 90, 70 like that. And in the end you have not deducted because the amount is less than 100 rupees. But if you add everything, it is coming up to some amount which you have to deduct. Then also no problem if the deductor undertakes the responsibility of paying the difference if the balance in the user account is not sufficient to discharge the tax liability. So basically every time 100 rupees in a month, 90 rupees is winning every month, guys. He is withdrawing 90, 95, 96 like that is withdrawing, no problem. In the end, some 20 rupees balance is left. Because you need not deduct if it is less than 100, you have not deducted. But if you add everything, net winnings during the year, it is coming up to some 5,000 rupees, assume. Or it's coming up to, let's say, 1,300 rupees or whatever. 1,200, 1,000 rupees it's coming up to. You have to deduct tax. That time, balance in the account is only 20 rupees. So here they are trying to tell the deductor undertakes responsibility of paying the difference. So the deductor will tell, don't worry, I'll only pay the difference, no problem. Or I'll deduct from this 20 rupees. Or if he's withdrawn everything and it's 0 rupees, I will pay. If he agrees like that, then this 100 rupees, no problem, you can withdraw. 100 rupees in a month. No TDS. Otherwise, TDS is there. If it crosses 100, TDS is there. This is a simple, guideline, guys. That's it. You can ignore it, no problem. One more interesting point is, what if the net winning will include kind also? This fellow will win one bike, this fellow will win one car, then what to do? So generally 194BA is for cash, but in case there is kind also, very simple. If I won the car, just like lottery winning, here also he has to ensure that the deductor has to ensure that the tax has been paid on it. Simple as that. Only then you can go ahead. Otherwise, no. Now, what will be the valuation of the winnings? Very simple. If, for example, Reliance is themselves having this particular online game, if they win, the Geo Cinemas has no that if you show the next, if you predict the next thing, you will win something, you'll win something. Let's say they will win a Reliance Jio phone worth 10,000 rupees. What is the value of the phone? 10,000. Who is producing it? Reliance Jio only. So the online game intermediary, Geo Cinemas, for example, if they are manufacturing such item, for example, 10K worth of phone, in that case, price that is charged to the customer itself will be the value of winnings. You have one worth 10,000. So this will be your net winnings. On the other hand, if Reliance Jio is buying a car, Tata Neo car, it is buying and giving it to the customer who won, then it says it has purchased the winnings, then the purchase price. It has bought the Tata Neo car at 10 lakh rupees. So what will be the value of the winnings? 10 lakh. Very, very simple. So this is about winnings. And again, guys, GST will not be included for the purpose of valuation. GST will not come. Next, my dear friends, very, very, very important point on TDS and TCS. TCS especially. So under 206C1G, if you have seen the notes as well, page 15.28 in our material, we have already made this amendment here. But anyway, to add on to that, this particular notification has told some other things. So any person being an authorized dealer who received an amount for remittance outside India in a liberalized remittance scheme, as we have discussed in FEMA, there is something called as liberalized remittance scheme to the tune of 2,50,000 US dollars per annum. Every person can spend without any RBI approval. But after that, you would require an RBI approval. So up to that amount, if you are spending, no problem. But beyond that, if you spend, then you will have to take RBI approval. LRS can be used for any capital account and current account transaction. Or one more is, if you are a seller of an overseas tour program, then like for example your Chariot World Tours or your Kesari Travels, all these people, if they are organizing, if they are collecting money, they have to collect rather TCS. How much percentage etc. depended on two things. In this year, especially 23-24, split between 39-23 up to that one rate. After that one rate was there. That rate got changed, to be honest, only for other items. For everything it's the same, not kidding. 5%, 5%. Nil, 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 nil. 5%, 5%. Here also. For normal cases, it was 5% in aggregate of 7 lakhs. 20% it became in aggregate of 7 lakhs for other than the items. So to make it very simple, institute only, and of course the notification also says this is actually what it is. As I told you, before 110.23, after 123, everything is the same except this item. Everything else and this item, overseas tour package. Two items are changing, that's it. Predominantly. Here also you see, this is changing here, this one, and this one. Except these two, here also, this and this. So let's see. So check this out, buddies. Remittances for purposes of education or medical treatment. If it's education or medical treatment, up to 7 lakhs, no TCS. 5% of the amount or aggregate of amounts in excess of 7 lakhs, you should pay 5%. But if that education you have taken a loan, no. For loan, you already are paying interest. So again, if you have to pay 5% TCS, it will be a burden. That's why they have reduced it to 0.5%. Up to 7 lakh, no TCS, 0.5 of the amount, aggregate of 7 lakh is 0.5%. Other than 1 and 2, that is other capital account transaction, current account transactions, that is if you are going for a trip, etc. Or if you are going abroad for some, 3-4 weeks for some work, etc. Whatever the case may be. Up to 7 lakh, no problem. 5% of the amount in excess of 7 lakh, that is up till 1st October 23. After, on or after 1st October 23, no TCS up to 7 lakh, but 20% of the amount in excess of that. This will include credit card transactions also. Apart from that, if you are going through a travel agency, overseas tour program, earlier it was 5% without any threshold limit. Now it is 5% up to 7 lakh and 20% above 7 lakh. The biggest question people were asking was, sir, this 7 lakh should be seen each item wise or all together in a year? All together in a year. One more question was, sir, I will go to various agencies to get my, foreign exchange. I'll go to Western Union Money Transfer and buy 4 lakhs. I'll go to ICICI Bank and take 4 lakhs. They will not know where else I got the money from, no? So should it be seen agent wise? Generally, Western Union Money Transfer, ICICI Bank, they are all called authorized agent. Should I see authorized agent wise or should I see aggregate, that is the SSC wise? Obviously, the SSC wise. Then the question will be asked, how will the other person know? How will Western Union Money Transfer know that you have actually taken from Western Union Money Transfer, you have taken from ICICI, you have taken from HDFC? How will they know? Is there any place where I can get to know everything? So as of now, it's not there. RBI is still building that capability. Not there now. So best thing is you should take a declaration from that fellow. So you will get it signed saying that I have not taken money anywhere. If I have taken anywhere, these are the places where I have taken this year. If that declaration is false, then that person who's taking money, that is me, I'll be liable. Western Union Money Transfer will not be liable. If income tax department goes and asks them tomorrow, bro, how do you know he has not taken? Sir, see sir declaration. That is more than sufficient. Okay. So if you see, yeah, see whether payment through overseas credit card would be counted. Yes, it was counted for sure. It is still now counted. But for your examination purposes, you should write it as a no. No TCS shall be applicable on expenditure of international credit card while being overseas till further order. It was changed in October, again it came in November, December. For exam purposes, they are telling no, so please maintain that only for the examination purpose. For exam purposes. That is why this sheet is important. You should follow what is there in the law now, or you should follow ICAI. ICAI. So important. With a threshold of 7 lakh for TCS to become applicable on LRS, apply separately. I already asked this question. If 7 lakh is made under education and 7 lakh is made for medical treatment, 7 lakh is for other purposes, 7 lakh should each, no, combined threshold. 7 lakh shall not be liable to TDS. So subsequent 14 lakh shall be liable to TCS. And it depends on the time of remittance also, as the rates are changing from 1st October. So let us say 7 lakh was during financial year 23-24 for education or any other purpose, no TCS. Because whether it is before 110, after 110, same. Beyond 7 lakh under LRS during the financial year 23-24 on or above 30th September, if it is there, 5%. But if it is beyond 23-24, if it is education loan, 0.5%. Education or medical treatment, 5%. Any other reason, 20%. Since there are different TCS rates on LRS for the first 6 months and next 6 months of financial year, threshold 7 lakh become applicable separately. No, it is once and for all in the entire financial year. You should see when they are making the payments, etc. Is it separately through e-remittance or through different authorized dealers? No. How will the authorized dealer know about it? I already told you. Facility to provide real-time update is not yet still under development by the RBI. You should take a undertaking letter. If you've taken an undertaking, Western Union Money Transfer, ICICI Bank, etc. will not be treated as assessee in default. They can go ahead. But false information, if they have given, etc., then you can take action against the person who has given false information. There is a threshold of 7 lakh for remittance under LRS for TCS to become applicable, whereas another threshold of 7 lakh for overseas tour program package. Are they independent? Yes. These through threshold apply independently. For LRS, 7 lakh applies to make TCS applicable, first of all, because up to 7 lakhs there is no TCS. For purchase of overseas program package, 7 lakh applies to determine the TCS rate, whether it is 5% or 20%. Right? So if you see, for education or other things, no TCS, that is LRS. But overseas tour program package up to 7 lakh, it is 5%. Beyond 7 lakh, 20%. So both should go hand in hand. Overall limit also you should count, no? Either way. Yes. Resident individual spend 3 lakh for purchase of overseas tour program package from a foreign tour and remits money which is classified under LRS. There is no other remittance under LRS, whether TCS is applicable. Since for the purchase of overseas tour program package, threshold of 7 lakh for applicability does not apply. TCS will be applicable and tax is required to be collected. As I told you, there is no exemption there. 5% you should collect. There are different rates for remittance for medical treatment education. What do you mean by medical treatment? What do you mean by education? Medical treatment will be purchase of tickets to and fro for him and the attendant. Full medical expense, day-to-day expenses, everything will be counted in medical treatment. Similarly, education will include to and fro tickets, overseas education, tuition fee, and day-to-day expenses. Everything. Whether purchase of international travel ticket or hotel accommodation on standalone basis, purchase of overseas tour program package, yes. Overseas tour program package will not just include hotel standalone or standalone international travel, but at least two of the following: either international travel ticket and hotel accommodation, or any other expenditure. There you will book for some, some show there. You will book a, what do you say, a train ticket, or you will book some fantasy park entry tickets. You will pay through the agent. All that will be counted. This TCS is very, very important. Go through properly, my dear friends. Then PAN is very easy. Let's finish off quickly. PAN is mandatory in all documents pertaining to transactions entered into by him. However, that PAN is relaxed in certain cases where you just have to make a declaration under form number 60. So basically here it says any person not being a company or a firm, basically individual who does not have a PAN, who enters into any transaction, has to make a declaration in form number 60. What declaration? This one. All such transactions with respect to opening of an account in a banking company or cooperative bank, you have to declare under form number 60. Apart from that, if you make a time deposit in a banking company, post office, or a Nidhi company, the amount is exceeding 50,000 or aggregating to more than 5 lakh during the financial year. If you are making a time deposit, each time deposit more than 50,000 or overall it is 5 lakh, then you have to make a what? Form number 60, you should give a declaration. Apart from that, if you have not been allotted a PAN, you have to apply for a PAN if you intend to enter into any of these followings. If you want to deposit cash in one or more accounts of the banking company, etc. If the aggregate amount of cash deposit is 20 lakh or more, then you have to apply for a PAN. If you are withdrawing any money, the withdrawal happens 20 lakh or more, you have to quote your PAN card number. Or if you are opening a current account, your business account or a cash credit account, definitely you have to obtain PAN, is what they say. But if you are a non-resident or a foreign company, non-resident individual or a foreign company, then PAN is not required. Then you can give a simple declaration. Or if the transaction is between IFSC banking unit, this is a banking company inside an IFSC, International Financial Service Center, then not needed. Or if it's with a person who doesn't have any other income in India, but only this particular income, then it is not needed. This you can go through theory, guys. Apart from that, all other things you have covered in depth. This is a statutory update, my dear friends. Hope it is clear. Go through this at varying speeds, whatever you want. Re-study this and go. Guarantee few questions will come in the exam. Okay, on that.